Vishal, am I live? Okay, good. All right. What's happening? We have to deal with two large subjects today: derivatives and alternatives. Which one do you want to do first? Derivatives. Let's do a poll. Type it on the chat box, or we'll do hand raise here in the classroom. How many of you think we do derivatives first? Okay. How many of you think we do alternatives first? Okay.
Don't skew the data.
Anyways, what you've decided doesn't matter because I've already decided what we're doing first. Luckily for you, it is derivatives. Do you know why? Because I love that subject. Phenomenal subject. Derivatives पहले करके अपने जूस निकल जाएगा. It's a beautiful subject. Once upon a time, my idea was that I would study this subject further. In fact, I really distinctly remember the first time I studied options. I, in fact, remember the place where I was sitting, and I remember how I felt. And I read something like, you buy a call option, your maximum losses are limited, but your maximum profits are unlimited, right? And that time I told to myself, okay, this is it, right? This is what I want, those unlimited profits. This is what I'm doing for the rest of the life, though life has different plans. But it's a beautiful subject nevertheless. And level 1 syllabus is decent. I would say this, again, you'd hear me complaining about syllabus changes. In the prior regime, the syllabus was very well structured and organized, where you start with forward, and then you learn everything that's there to learn with forwards before you go to next chapter. So there used to be 4 chapters in your syllabus: forward, futures, options, and swaps. Finish, right? And I'm going to do exactly the same. I'm not going to follow curriculum sequence. I'm going to take one derivative, do everything that we need to learn there, and then move on to next one. All right? So if you're ready, should we start? थोड़ा जोश दिखाओ. Okay, ठीक. देखते हैं कहाँ तक टिकता है. Okay. Here we go. Let's have fun with this subject today. Now, I'm not going to assume too much in terms of, even though it's a crash course, but I'm going to assume level 0 type of knowledge, right? A basic knowledge of derivative. So we know that derivative is a financial instrument that derives or transforms value of underlying asset. Now, the way you learn to think is, think of derivatives as simple legal agreements. It's a much more easier way to conceptualize derivative. Don't think of it as a real asset. Think of it as an agreement, right, that two parties sign. And depending on what they sign, the value of those agreements will either go up or go down. And that's how one party makes profit, other party makes losses. Therefore, we say derivatives are always a zero-sum game. Zero-sum game means if I'm winning, then the other party has to lose. Now, within derivatives, we broadly divide the entire spectrum into 4 categories of products. We have forwards, then we have futures, then we have options, and we have swaps. Forwards, futures, options, and swap. Okay, now, within forwards, what is a forward? It's an agreement, okay, between two parties where one party agrees to buy, other party agrees to sell. The party that agrees to buy at some commodity at a future date, that party is called long. And the party that agrees to sell that commodity at a fixed price at a future date is referred to as short. How about futures? How are futures different than forwards, or do you think they're the same? They're almost the same, right? I mean, conceptually it's almost similar agreement. The difference being futures are more standardized. You buy and sell them through an exchange, right? And therefore kind of helps you reduce that credit risk a little bit. So again, an agreement between two parties. Again, the party that has agreed to buy something is long. The party that has agreed to sell something is short. Difference between the forwards and future. We know forwards are over-the-counter contracts. Futures are exchange traded. Exchange traded. Forwards can be customized. Futures standardized. And very importantly, in a forward contract, you have something called as a counterparty risk. Can anyone tell me what is a counterparty risk? The other party not paying or not following the terms of the contract. In case of future, first testable point for the day, 2 stars. In case of future, who is your counterparty? Correct. Counterparty is clearinghouse. I told you I recently took those NISM exams. I don't know if I discuss those questions, is that a violation? I have no idea. Is it? Does anyone know? Okay. Maybe in the mock, just being conservative. I did a mock exam, and in that mock exam, there was exactly this question. Okay, the question was, when you're doing a future contract, who is your counterparty? The counterparty is obviously a clearinghouse, right? Then a follow-up question a little later was, what is the risk the clearinghouse is exposed to? Are they exposed to market risk? Market risk means value of the future. Because if imagine I am taking long, if clearinghouse is taking short, do they not have risk? Yeah. They have risk, right? No, they don't. Why is that? Because the way mechanics is working is like this. There is one party which wants to take long. The trade will not happen till the time there is another party which is willing to take short. What clearinghouse simply does is it becomes short to the long party and it becomes long to the short party. It does not keep any risk exposure on its books. That means the asset price goes up or asset price goes down. Clearinghouse doesn't care because on both the sides they are completely hedged, right? So clearinghouse does not have a risk. They typically do not have credit risk also. Why? Because they work on a system of margins. Margins is basically long and short both will have to make some security deposit, correct? So margins will ensure. So what risk does a clearinghouse have? Which is the biggest risk? I'll tell you the third option, which is obviously the answer. They have operational risk, right? What is an operations risk? If their margining system is not doing correct calculations, correct, and they capture inadequate margin, or if they fail at settlement, that means something in their operations going up, then a clearinghouse can have significant risk. All right, then we go to options. We have 3 types of options: a call option, a put option, and A call option, a put option, and just two. So we have a call and we have a put. Now call option, I can have one of the two sides. I can either build a long position or I can build a short position. In the same way, put option, I can have two sides. I can build a long position or I can build a short position. The party which is long is referred to as right to buy. The party which is short call has obligation to sell. The party which is long put, right to sell. And the party which is short put is called obligation to buy. Okay. Now one common confusion people have is with respect to long put. Because all this while, every time I said long, I said I'm a buyer. Right? But in case of a long put, you're a seller. You have a right to sell. That creates confusion. Can anyone tell me why? Correct. Because that long and short is from the perspective of right. So here I have paid money to acquire the right to sell. Is that okay? And obviously short put has received money, but in return they have taken an obligation to buy at a fixed price. Okay. Now if you're a long call, you typically pay premium. Short call, receive premium. Long put, pay premium. Short put, receive premium. So pay premium, receive premium, pay premium, receive premium. And finally we have swaps. Now within swaps we can have multiple types of swaps, but we'll take an example of most popular one, which is called IRS, which is interest rate swap. Now in interest rate swap there are two parties. There's a party which is called receiver, and then there is a party which is, let me write it the other way around. Let me say payer first and receiver second. Interest rate swap. Now in the swap world, whenever I use the word payer or receiver, it's with reference to, someone said that, with respect to fixed rate. So when we say payer, that means I'm going to pay fixed rate. Okay, fixed rate on a swap. And when I say receiver, it automatically means I'm going to receive a fixed rate. So if I'm going to pay fixed rate, okay, as a payer in the swap, then what do I receive? I receive a floating or a variable rate. And if I'm receiving fixed rate, then what do I pay? I pay, bolo, floating rate. That's roughly your syllabus, and then some peripherals and theory around this. Right? But this is what you're looking at level 1. You have to do some work on forwards, futures, then a lot of work on options and swaps. Start. We're starting with options. So we'll start with options first because that has the most number of permutation combinations. We'll get options out of our way. Then we will do forwards, futures, and swaps in the sequence. All right. So let us start with options. Options, call, put, long, short, right to buy, obligation to sell, right to sell, obligation to buy. I'm acquiring a right, so I pay premium, I receive premium, I pay premium, I receive premium. Okay? Now, one trick that will come in very handy, and we'll probably connect it to the earlier flow chart. If you feel that the underlying asset value will go up, that means you're bullish. Will you go long forward or short forward? Long forward. So this is bullish. Will you go long future or short future? Long future. This is bullish. When it comes to options, you feel underlying asset will go up. Long call or short call? Bullish. And long put or short put? short put. So this is bullish. Okay. So bullish long forward, bullish long future, long call, and also short put. If you feel the underlying asset will go down, then you are looking at short forward, then let me just say bearish. This is bearish. What else is bearish? Short call is bearish and long put is bearish. Okay. So in your option flow chart, a very elegant memory technique, B, 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 and B. The two on the margins are bullish and the two in the center are bearish. Okay. A lot of people struggle on the short side, but today I'll give you some tricks in terms of how to handle them. Okay. Now what we know about options, they are asymmetric contracts. Asymmetric means when I pay a premium, I benefit massively on one direction, but I do not lose as much on the other direction. Correct? When I receive a premium, I might lose massively in one direction, but will not earn significant on the other direction. Okay? So let's start doing some basic examples. You would be surprised these type of examples might show up on the test. Okay, so let's say we have a call option. We have a strike price of 100 rupees. Strike price means the price inside the agreement. Spot price of the underlying asset is 150. And to acquire, you paid a premium of 10 rupees. Now based on this information, we need to figure out what will be the payoff on expiry and what will be the profit on expiry. We will assume it's a long call. Okay, so with long call, the song that you're going to sing is that I have a right to buy. At what price? 100. Price in the market? 150. Will I buy? Yes. Are you sure? Yes. Yes. What's the benefit? 50 rupees. That is referred to as payoff. Okay? But to acquire this right, I paid a premium of 10 rupees. So what's the profit? 40. So profit is 40 rupees. So long call on expiry, payoff is 50 rupees, profit is 40 rupees. What might happen on the exam is instead of giving you a long call, they will give you a short call. Now the moment you have to think from a short call perspective, thinking becomes complicated because you have to think from an obligation perspective, right? I have an obligation to sell. So will I have to sell depends on what the other person decides, whether they will buy or not. So very elegant technique for you. Even if you get a question on the short side on the exam, think on the long side. And then what you simply do is say that if long call has a payoff of 50, where is that payoff coming from? From the short's pocket. So short call has to have a payoff of minus 50. If long call has a profit of 40, then short call will have a loss of 40. The moment you learn to think like this, it will be extremely easier to handle questions on the short side. Okay, let's try one more. Now this next question is very likely of what you see on the exam. Somewhat like this, right? They typically use a gimmick, and I do that a lot when I'm setting questions. Let us say strike price is 137.25. Premium is 7.25. Spot price is 130. It is a short call. Figure out what is the payoff and figure out what is the profit. What is the payoff? 7.25. And what is the profit? So payoff is 7.25 and profit is also 7.25. What is the payoff? Come on, YouTube, I'm waiting for you. What's the payoff? Stop wasting my time. Just give me an answer. What is the payoff? 7.25. Give me a hand raise. How many of you are confident? 7.25. Okay. How many of you think payoff is 0? Okay. That's why I said sing a song. Let's sing a song together. And I told you, don't think from short perspective, always think from long perspective. Okay? So sing a song together. I have a right to buy at 137.25. Price in the market 130. Will I buy? What? Will I buy? I will not. If I do not buy, then payoff is 0. Right? Because there's nothing that's happening on expiry. Because nahi kharidega, right? I have a right to buy at 137. In the market, it's available at 130. Why should I buy? I will not buy. So payoff is 0. But I paid a premium of 7.25. So for long call, the premium lost is 7.25. So for a short call, now the answer is very easy. What should this be? 0 and 7.25 positive. One more. Strike price 250. Premium 12. Spot price 262. It's a short put. Please find out payoff and profit. What is the payoff?
0.
So again, the way we think, this time you would say it's a put option. We always think from long side. So we think from long perspective. I have a right, chalo gana gao. I have a right to sell at what price? 250. Price in the market 262. So something that's worth 262, should I sell at 250? No. So that means I will not exercise the option. Payoff is 0. That means whatever premium I paid, that's gone. How much premium did I pay? 12 rupees. So long put will lose the premium of 12. So when you do this for short put, easy, it simply becomes 0 and plus 12. Will you be able to handle these questions? One more. Again, don't think from short perspective, think from long perspective. It's easier that way. Sarvesh, payoff. On expiry, the value of the option is same as the intrinsic value, therefore payoff. Okay. Tell me, what's your payoff? 12 rupees. Or minus 12 rupees. For short, I'm asking for short. Minus 12. And what's the profit?
18.
Plus 18. Okay, let's do it together. We think from long perspective. We'll say, I have a right to sell at 300. Price in the market, 288. Should I sell? Yes. If I sell, I get a payoff of 12. However, beginning I paid a premium of 30. That means I'm going to lose 18. And once you have this side, then this side becomes simply minus 12 and plus 18. Easy? Now, when you ask this question, should I exercise? And the answer is no. The payoff became 0. Whenever the answer was yes, the payoff was positive. correct? So whenever you have a payoff of 0, those type of options we call out of the money options. So this is an OTM option. Here payoff is 0, this is a OTM option. Here payoff is positive for long call, and we think from long perspective, of course. So this is in the money option. Here the payoff is positive, so this is in the money options. Okay, so very easy way to figure out, will I exercise or not? If the answer is yes, in the money. If I will not exercise, then out of the money. One more. All right, someone is asking, if I'm getting negative profit, why am I exercising it? That's a great question. Why? Sorry, what is the answer? To minimize the losses. That's correct. So here, imagine if I do not exercise, then I lose the whole 30. Right? By exercising, at least I'm able to recover that payoff of 12 rupees. So I'm booking losses of 18. Next example. Strike price 300, spot price 255, premium 75, short put. Please figure out payoff, please figure out profit, please figure out moneyness. Yes. It's a put option, so I have a right to sell. I'm thinking from long perspective. Right to sell at Naneshwar 300. Price in the market 255. Will I sell? Yes. If I sell, what payoff do I get? 45. But unfortunately, I paid premium of 75. So how much loss do I have now? 30. So short put should be how much? Minus 45 and plus 30. These are low-hanging fruits on the exam. It will be a shame if you get these wrong. Just read the question super carefully. A very common trap is the question will have two spot prices. Okay, how? So then they will say, when you bought the option, strike price was 300 and spot price was maybe 200. And over the period of next 30 days, the spot price has gone to 255. Now find out what is payoff and what is profit. So you need to consider the latest spot price. Correct? The spot price as of today on the date of calculation, and then you do rest of the calculation. That's it. Is this option in the money or out of the money? In the money. Why? Because the payoff is positive. Payoff we determine from long perspective, and in the moneyness we determine from long perspective. So the general rule is, if it's a call option, okay, in call option, when do you make money? When spot price is more than the strike price. Then we say option is in the money. And if the spot is less than the strike price, option is out of the money. And if spot and strike are same, these are called ATM options or at the money. In the same way, for a put option, if strike is more, that's when you make money, because remember at strike you have a right to sell. So put option mein, in your mental framework, when you look at call option, you want S to be higher. In your put option, you want X to be higher. I should have a right to sell at a higher price. So when this is the case, option is in the money. And if it's the other way around, then the option is out of the money. When they are same, the option is ATM or at the money. This is referred to as moneyness. Are you okay with this? Moneyness. All right, next concept. There are three types of options: an American option, European option, and a Bermuda option or a Bermudan option. Now, assuming that this is where you're purchasing, this is where they expire. Okay, this is where you purchase the option. Purchase expiry. Purchase, expiry. Now tell me, if it's an American option, when can I exercise? Anytime, right? So I can exercise on any time between the date of purchase till the date of expiry. If it's a European option, I can exercise only on expiry. That's why in India, if you do options, you'll always see CE and PE written. CE stands for call European, PE put European. But in some other markets, if you do option trading, a lot of times you'll have to choose between a CE and a CA. A CE would be European, but CA would be American. How about Bermudan? How does Bermudan option work? When do you exercise a Bermudan option? On certain pre-specified dates from purchase to expiry, and of course on expiry. So Bermudan is some sort of a hybrid between American and European options. Is that okay? So now just compare American and European and think about it, that if I were to give you one of the two options as gift and I give you a choice, I'm not doing that, but if I give you a choice, would you prefer to have an American option or would you prefer to have a European option? American. Why is that? Because it gives you more? No, don't say it's liquid. See, don't mix the concept of exercising an option with selling an option. Okay? At the beginning of the session today, I told you think of derivative as just a piece of paper. Now this piece of paper is listed on a stock exchange. So when I buy an option, I maybe pay 5 rupees to buy that option, which is premium. That piece of paper I paid for 5 rupees, it might go to 7 rupees. I can sell no matter what option it is. European, American does not matter, right? So liquidity is a function of, is there a counterparty willing to take it off your hand? It is typically not a function of American or European. But from an exercise perspective, American gives me a lot more flexibility compared to European, and therefore if I were to give you a free option, you would choose American option, right? So there is a sentence that you need to know from an exam perspective. Okay, I'm going to write a sentence. You have to tell me true or false. Okay, first sentence is an American option value will be more than European option value. True or false? This is false. Okay, the correct way, okay, and that's where it gets a little academic, probably borderline stupid, but there is an academic nuance to it. The correct sentence is the value of an American option, okay, will be at least as much as the value of corresponding European option, which means an American option, let me just say American option, will be more or equal to an European option. This sentence is true. This is the correct concept, and this is how they frame it on the exam, this sentence. The value of an American option will be at least as much as the value of the corresponding European option. With me? Now, why would it be same? Why would it not be more? Because the American is giving you more feature, right? Then in what case American and European would be same? In some cases where that extra feature that American gives you is useless. What is that extra feature American giving you? Exercise early. In some cases, you say, okay, I can exercise early, but kuch fayda hi nahi hai. There's no benefit of exercising early, so I don't want to do it. So if there is no benefit of exercising early in some cases, and I'll show you as we progress, then there's no point of having that flexibility. So in that case, value of American and European option might be same. But it will not happen that value of American option will be below value of European option. Corresponding, that means everything else being the same. Are we together? All right. Now, options value, okay, is nothing but their premium. In the option world, when I say value of an option, it means premium of that option, which is same as the price of that option, the price at which I'm buying the option. So you might see these three terms being used interchangeably. Value of the option is same as premium, which is same as price. This will not be true when we go to forwards. Okay, this is true only with options. So if someone says option kis price mein kharida, at what price did you buy? They could also say what premium did you pay, or they could also say what was the value of those options you bought. Same. Okay. This premium of the option is made of two parts. Some part of the premium comes from intrinsic value, and some part of the premium comes from the time value. Now, there was an error in the CFA curriculum regarding this. For some reason, those folks carried that error for the whole 2025 curriculum. So before starting the session, I just checked. I couldn't see that formula in 2026. That means they've fixed it. So now the formula that you're going to use on the exam is what I'm showing you. Okay, unless we find something contradictory in the curriculum. I checked, I couldn't find anything. It's a very easy concept, and I'll show you an example. Let us say that we have a call option. This call option has a strike price of 100 rupees. Spot price right now is 140 rupees, and the option is trading at a premium of 70 rupees. Okay. So what you say is, you say, okay, ask yourself a question. I have a right to buy at what price? 100. Price in the market? 140. Will I buy? Yes. If I buy, how much will I get? Payoff? 40. That's your intrinsic value. But then, we are paying how much money to buy the option? 70. So how much extra are we paying? 30. That's called your time value. That's it. Okay, so 40 is your intrinsic value, 30 is your time value. One more time. Let us say I have a call option, strike price of 100 rupees, spot price of 90 rupees, premium of 25 rupees. Again, repeat the song. Now see, when I'm doing intrinsic value and time value, I'm not worried about long or short. We're thinking from long perspective, right? Right to buy at 100, price in the market 90. Will I buy? No. Therefore, intrinsic value will be minus 10. Intrinsic value minus 10? No. Intrinsic value can never be negative, right? So I will simply not buy, and that's why it's an option, right? So I will simply say my intrinsic value is 0. So this entire price that I'm paying of 25 rupees, all of that is time value. Look out for a question on the exam that says, what percentage of premium is time value? In this example, what percentage of premium is time value? 100%. In the previous example, 30 by 70. Whatever that number is. Are we together? Black t-shirt there, last row mein. Yes. Is this the first time you're doing derivatives? When are you taking the exams? Okay, good. Put option. Strike price 200. Spot price 180. Premium 30 rupees. Tell me now. I have a right to sell at 200. Price in the market 180. Will I sell?
Yes.
Yes. If I sell, what's the payoff? 20 rupees. That's my intrinsic value. But how much I am paying for the option? 30 rupees. So what's my time value? 10. So time value 10 rupees. Is this okay? Next one. Put option. I have a right to sell at 200. Spot price is 50 rupees. Premium is 140 rupees. Now tell me, is this scenario possible or not possible? Possible or not possible? This scenario. Can this put option be available at 140? Let's see if we can solve it. I have a right, chalo gana gao, I have a right to sell at 200, price in the market, 50, will I sell? Yes. If I sell, what's the payoff? 150. But I'm buying this option for how much? 140. I'm buying it for a little bit less. So my time value is minus 10. Do you think that's possible? The answer is yes. Possible. Okay? Where is it possible? Only with put options. Typically with put options. There is one more characteristic of this put option. Notice the delta is too large. Right? It's a huge gap between where the strike price is and spot prices. This we call as deep in the money. Deep ITM option. So this is a deep in the money put. Plus this has to be a European put. Okay? So a deep in the money European put can have time value which is negative. Otherwise, time values are generally positive and intrinsic value of course cannot be negative. Are we doing okay?
We can have negative time values, right?
That's what I'm saying. Yes, we can have negative time values rarely. Generally, it is with deep in the money European puts. But of course, what we cannot have negative as intrinsic value. Intrinsic value is either 0 or a positive number. Okay, so assuming you are comfortable with time value and intrinsic value, the next concept in options is repeat what, Gabriel? Okay, I'll repeat one more time. When you have a put option where you have a right to sell at 200, price in the market 50, the gap between the spot and the strike is too large. So it's a in the money put, but maybe deep in the money. There's no definition of what constitutes deep. Right? It's an approximation. Just we say, no, bahut gir gaya hai. It's fallen a lot. There's no definition of lot, right? So it's like that. So when option is deep in the money and it happens to be a put option European, in some cases you notice that the time value of those options are negative. But this is more of an exception rather than the rule. Moving forward now. Next concept. From a testability perspective, a very, very high probability. What I'm showing you here is kind of the core of options. Okay, you have to have a good understanding of what this is. There are in total 6 variables. 6 variables that affect price of the options. In that, we are going to build a table here. Once we have the table, we'll kind of build some conceptual framework, and then we have to go back and see how those variables affect intrinsic value and time value. Okay, we want to connect the two pieces together. 6 variables that affect price of the options. Those 6 variables are spot price, strike price, then volatility, time to maturity, RFR, and cash flows or dividends. Cash flows or dividends. Okay. We want to see what impact will they have on call prices and what impact will they have on the put prices. We are going to assume spot price is going up, strike is higher. Strike doesn't change, by the way, it's inside the agreement. But we'll assume what if we are comparing 2 options, one with higher strike price. What if the vol goes up? What if we are comparing 2 options with one with higher time to maturity? RFR goes up and cash flow or dividend goes up. Okay. So you tell me now, if spot price is going up, what do you think will happen to call option? Call option will go up. If strike price is higher, what do you think will happen to, in fact, let's do it horizontally. If spot price goes higher, what do you think will happen to put option? Put option will go down. If strike price is higher, what do you think will happen to call option? Lower. Why is that? Because I have a right to buy. I have to right to buy at a higher price now. And in case of put option, increase. Then, if volatility is higher, what happens to call option? Goes up. But put option? No. If volatility goes up, put option? Increase. Okay. Option traders love volatility. When markets are in a volatile regime, call option, put option, both of them will go up. When time to maturity is higher, what happens to call option? Increase. Put option? Increase. So value of both call and put will go up for longer maturities. There are some smaller exceptions here, but most of the time this logic works. When RFR is higher, and this is a tricky one, what do you think happens for call option? RFR, that means risk-free rate or interest rate. When RFR is higher, call option is higher. Put option lower. And when a stock starts paying dividend or the dividend yield goes up or the cash flow on that asset goes up, what happens to call option? Goes down. Put option goes up. This is your conceptual framework. Spot, strike, vol, time, RFR, cash flow. Each of these 6 items, you not only have to memorize, you have to conceptualize. You need to know why. Only then you will be able to handle questions on the exam. This one is fairly straightforward. I am bullish, spot price goes up, call is more valuable. But put option, I am bearish, spot price goes up, I make losses. This one is easy, strike. Strike is the rate at which I have a right to buy. So higher the rate at which I buy, the less valuable the option is. But strike is the rate at which I sell. Higher the rate at which I sell, more valuable the option is. So put option value will go up. Volatility in time, the reason for these two is because of the asymmetric nature of the options. Okay, what is the asymmetric nature? So think of a very simple case. Imagine you have a call option. Strike price is 100 and spot price is also 100. Okay, let's take 2 call options. Strike price 100, spot price 100. But this one is a very boring asset. Okay, this spot. So in some time it goes to 110 or it goes to 90. It doesn't move much. All right, the first asset. But the second asset, it goes to some 250 level or it goes to 20 rupees level. Goes up a lot, falls a lot. If I were to give you a call option on either of the 2 assets, let's call it call 1 and call 2, which one would you prefer? Call 2, because you would say, I don't care how much it falls. Doesn't matter, because worst case scenario, what do I lose? Just the premium. So I'm going to lose the same premium whether it falls to 90 or it falls to 20 or it goes to 0. Does not matter. But I will make a lot more profit if it goes to 250 as against 110. So higher the volatility, better the option, right? Because of the asymmetric nature. Therefore, high vol, higher premiums for both call and put. That is why during the times of volatility, the option prices increase. They're going up because of volatility, right? And this volatility that determines the option prices, we use that volatility, a small side track. Again, this is testable in your syllabus. There is an index called the fear index. Okay, that fear index is called VIX. VIX stands for volatility index. And if you look at this index, okay, I'm looking at wrong chart. Okay, this is a US VIX, and this is a good chart to, kind of take a printout and maybe keep it in your house if you are a participant of the financial markets. This is something that you learn out of this chart, which is historically, what are the times when the market fear has peaked? Because Warren Buffett, Ben Graham, all those legendary folks have taught us that markets are in a fear and greed cycle. And when the fear is very high, that's the time for you to be greedy, right? That's the time for you to kind of start buying. So look at this. In this chart, there was one crazy opportunity in 2007 where the index had gone to an insane level of 80. And then we had multiple smaller windows of opportunities when the index went up to the 40 level, right? After that, we had fairly good period of time with some smaller spikes, and then we have a crazy spike in when, what is this? This is your COVID, right? And then we had one more spike. This was in August last year. This was your carry crash. The Japanese-Mexican pair carry trades broke out. So then again, VIX had a spike. Okay. How are these VIX calculated? They are calculated using the volatility which is reflected by the option prices, which we would learn, which we generally call as the implied volatility. Okay. But in general, option traders love volatility. When volatility goes up, value of call goes up, value of put goes up. Now time. Time basically means the time to expiry. Okay, so imagine you have a right to buy some asset. In one case, expiry is 1 month. In other case, expiry is 3 months. Which one intuitively is more valuable? 3 months, obviously, because then it's a longer time period for your thesis to play out. Correct? So longer the maturity, higher is the valuation of the option, with some smaller exception to be dealt with later on. Why RFR higher? I'm going to give you an easier way to think. Okay, think of RFR in a country as some sort of a force of nature. Okay, whatever is the level of RFR, that is going to push value of every asset in the country up at least by that much. That's logical because RFR is a return that you earn on the safest asset in your country, which is government bond. So the thinking is if RFR is 5% on a government bond, then for other assets, I should expect more or less. More, right? Which means at least every asset this year should go up by the level of RFR. So higher the level of RFR, more you're pushing the prices upwards. Are you with me? I can prove this mathematically, but I want you to get this conceptually. So more RFR, more prices upward. That means the call valuations will go up, but therefore put valuations will come down. Okay, so that's the concept for RFR. What is the concept for dividends? It's very simple. Whenever a company pays a large amount of dividend, what happens to the stock price? It falls, correct? Because that dividend value is given to shareholders in cash. So if the stock price falls, call option will fall, put option will go up. These are your 6 variables. How comfortable are you? Online, can you give me I pass? I struggle with this concept, please. Okay. Assuming you are comfortable here. Now, the relationship between the spot price and the value of options. Okay. Value of options. This relationship is referred by a major Greek called delta. Okay. Now this part was also there in your portfolio management session. That time I told you I'll cover it elsewhere. So this is delta, relationship between spot price and the option price. Then when the spot price changes, at times the delta itself changes. So the second derivative, which shows when the spot price changes by how much delta will change, that's referred to as gamma. So delta and gamma. Then the relationship between volatility and option prices, it's indicated by vega. Then the relationship between time and option prices, it's denoted by theta. And relationship between RFR and option prices is denoted by rho. These are easy to remember: volatility, vega, time, theta, RFR, rho, right? So fairly easy. You just need to memorize these two. Delta is the first derivative, gamma is the second derivative. Delta is the rate at which option prices will change when spot price changes. Gamma is the rate at which delta will change when the spot price changes. Okay here? Fine. Now, I want you to connect this flow chart, which is option value made of intrinsic value and time value, with these, forget the 6th one, but these 5 variables. Okay? Think about it. How are these 5 variables connected to intrinsic value of an option and time value of an option? If anyone can tell me. How is intrinsic value calculated? What is the formula we used here? Payoff, right? Which is what? Difference between spot and strike. So basically, these two variables, the spot variable and the strike, these two are essentially what are determining my intrinsic value. Okay, so this is how intrinsic value is determined, which is simply spot and strike. And then these 3 variables, which is volatility, time and RFR. Okay, how volatile the stock is, how volatile the underlying is, what is the time, what is the RFR. This will determine what? Bolo? This will determine the time value of the option. Okay. Now, logically, just think about it. When I'm studying an option and as I'm reaching closer to the expiry, time becomes how much? 0. So if time becomes 0, then time value of that option on expiry will become 0. Therefore, as we are approaching towards expiry, slowly, the time value will start going towards decreasing. It will start going towards 0, which we call as a time value decay. And then, therefore, on expiry, the option will trade only at the intrinsic value. Are you okay? Now, in what situation time value of an option will be higher? If that option has, if the underlying asset is high, bolo, volatility, or if there is a long time left, or if it's a call option, RFR has just gone higher. These factors will typically increase your time value. Correct? When will your intrinsic value be affected? If it's a call option, intrinsic value will go up when spot goes up. If it's a put option, intrinsic value will go up when the spot, okay, strike is higher or the spot goes down. With me on this? All right. Okay. So now a simple binomial model for option valuation. We're making great progress. Binomial model of option pricing. It's a fairly simple model. We will create 2 or 3 smaller examples and then we will layer up. First example. If I tell you that today there is an asset available for 100 rupees and there is an option also available at 100 rupees. Okay? And what we think is that this spot price from today till expiry can take one of the 2 routes. This 100 rupees can become either 150 rupees or 100 rupees can become maybe 70 rupees. This is my expiry scenario. And if I told you that there is a 70% chance that it will go into this route and 30% chance it will go to this route. Okay, somehow we knew. Then, additional piece of information, let's say risk-free rate of return is 10%. Okay. Now, think about it. If you are the owner of this call option, okay, it's a long call. You have a right to buy at 100. On the day of expiry, we have two scenarios. Either underlying asset has gone to 150 or it has gone to 100. You tell me, if you have a right to buy at 100 and price in the market 150, will you buy? Will you buy?
Yes.
You have a right to buy Siddhi at 100, whereas the underlying asset has gone to 150. Will you buy?
Yes.
Yes. So it will give you a payoff of how much? 50. But payoff means intrinsic value, right? How about time value? Option will have some time value also, no? How much will that be? That will be 0. Why? Because today is expiry. At expiry, no value is left. Intrinsic value is same as the option value. Second scenario, I have a right to buy at 100, price in the market 70. Will I buy?
No.
Buy? It's out of the money, right? I don't want to buy. So option value will be how much? 0. So we have two scenarios. 70% chance option value is 50. 30% chance option value is 0. Do you think I can figure out a weighted average value? Sure. So how will we do it? 70% into 50 plus 30% into 0. This is the weighted average value. How much is this? This is 35. Which means, on an average, 1 year from now, or whatever the time period is, expiry, let's assume 1 year, my option is worth 35. But is that the value today or in the future? Future. So is there a way I can figure out the value today? Sure. I can simply take a present value of 35. Present value of 35 is simply 35 divided by 1 plus 10% raised to 1, which is how much? 31.81. That's it. This is binomial model. It sounds fancy, it looks fancy, there are formulas, but at the core of it, this is what you're doing in a binomial model. Easy? One more scenario. Let us say stock price today is 300 and we have a call option for 200. Okay, we have 1 year expiry. Now 1 year from now, the stock price will become either 400 or 240. Okay, this is expiry in 1 year. And let's say if I told you that probability is 60-40. And RFR, we assume constant 10. Do you think there is a way you can value this option? Yes, be mindful of the strike price. I want you to try this time. Which option is this? It's a call option. All right, help me out. What do you think is the value of the option if I have a right to buy at 200, price in the market 400, how much? 200. And in this scenario, right to buy at 200, price in the market 240, 40. So value of the option is either 200 or 40. Is it possible to do a weighted average? So 60% into 200 plus 40% into 40. So 136. So your weighted average is 136. And this 136 is the value of the option when? Today or in the future? In the future. So what do I need to do? I need to discount it backwards. So 136 divided by 1 plus 10% raised to 1. How much is that? 1? 20 point? 0.63. Easy? Okay. One more, and then we'll scale up a little bit. Spot price 500, strike price 700. This time it's a long put. 500 will become either 650 or 350. The probability of that happening is 80% and 20%. Expiry this time, just throwing a little complexity, 6 months. Not 1 year, 6 months. RFR per annum is 10%. Please value the put option. How much? So again, what's the option value on expiry? So option value will be right to sell at 700, price in the market 650. Will I sell? Yes. What's the option value? 50. Right to sell at 700, price in the market 350. Option value 350. So weighted average 80% into 50 plus 20% into 350. So that's 40 and 70, 110. This 110 we need to discount backwards for half of the year. So 110 divided by 1 plus 10% raised to 0.5, which is 104.88. Okay, now one variation of this question. These probabilities might not be given to you directly on the exam. You might be required to compute them. If you are required to compute the probability, okay, this 80% and 20%, you need to know what these probabilities are called. These are not your usual probabilities. These probabilities are called risk neutral probabilities. Remember from portfolio management, what is What is risk neutrality? What was the risk aversion score of risk neutral investor? 0. Which means investor does not care about risk. They only look at the return. Which means no matter what the risk is, investor is okay if they are earning RFR. Yes or no? No matter what the risk is, they'll be happy with RFR. Every time you do discounting of some cash flows and derivatives using RFR, okay? Here, think about it now, it's an option. Why should I discount with RFR? It's riskier. With equities, we had cost of equity. With bonds, we had YTM. But options, we don't have anything. We simply discount with RFR. And that is because we assume risk neutrality. Okay? So, risk neutral probability. So, how does a risk neutral probability calculated? P is equal to 1 plus RFR minus something called as a downtick factor. Downtick means by how much the stock price will fall, divided by U minus D. Uptick factor minus the downtick factor. Now, technically the formula is 1 plus RFR raised to the time period N. Okay, but if it's 1 year, then it's simple. 1 plus RFR minus D divided by U minus D. Let's do an example now in integrating this formula. Okay. So, stock price is 100. Strike price is 100. This 100 can go up to 150 or 66.67. Okay, in 1 year. So this is expiry in 1 year. RFR is 10%. RFR is 10%. Now please value the option. Now this time what I have not given you is I have not given you probabilities. Now you can easily calculate probability if you use this formula. 1 plus RFR raised to N minus D divided by U minus D. But the question is, what is my U and what is my D? So how do you get your U minus D? Very simple. 100 rupees of asset went up to 150. It went by how many times? 1.5 times. So U is actually 1.5. 100 rupees of asset went down to 66.67. It fell down by how much? It fell down. What is the multiplier factor to 100? It is 0.667. I'm just going to round it to 0.67. That's D. Generally, okay, this is the rule I want you to remember for the exams. If nothing is mentioned, then U and D are inverse of each other, which is true in this example. Take an inverse of 1.5. 0.667. Okay. So on the exam, if the question doesn't mention this and they give you explicit U and D and they're not inverse of each other, okay. But if the question gives you only U and does not give you D, then what will you do? Take an inverse of it. Okay. Now once you have this, everything else is easy because all that you need to do is figure out the probability here. How will you figure that out? You will use that risk neutral probability formula, which is 1 plus R minus D divided by U minus D, which is equal to 1 plus 10% minus 0.67 divided by, help me out, 1.5 minus 0.67. How much is that? 51%? 51.8. So we'll round it off to 52%. That means probability that the asset will go up is 52%. So probability that asset will fall is how much? 48%. And then everything else is same. Then all that you need to do is figure out, let's assume this to be a call option. Okay, so what is the value of the option now? Right to buy at 100, price in the market 150. Will I buy? Yes. How much is the value? 50. Will I buy here? No. And then weighted average, 52% into 50%, 26. And then this 26 you discount backwards. Okay, so that will be 26 divided by 1 plus 10%. So 2.6 gone, 22 point, 23.463. Okay, 23.63. Are you comfortable here? Last example, then I'm going to move on. Uptick factor of a stock is 1.8. Risk-free rate of return is 10%. Stock price is 100 rupees and strike price is 100 rupees. Expiry is 1 year. Expiry is 1 year. Here's what I want you to do. Question number A, find out risk neutral probability. Okay, it's a call option. B, find out value of the call using single period binomial model. Question number C, which is a new entrant now to our learning list. Please find out what is the hedge ratio. What is the hedge ratio of the call option? Hedge ratio, by the way, is also called as delta. I've started getting answers on the chat box. Done? Step number 1. 1 plus R minus D. Now, how do you get your D? Inverse of 1.8. Help me with that. 0.55 divided by 1.8 minus 0.55. 1 plus R here should be 1 plus 10 percentage. How much? 44? Okay, so round off 44%. Then let's build the tree. 100 will go up to 100 into 1.8 or 100 into 0.55. So that's 180 or 55. I'm making use of this uptick factor. And then these are my spot prices on expiry. What should be the value of my option? Value of the option is right to buy at 100, price in the market 180. Should I buy? Yes. What's the value? 80. What's the value here? 0. What is the probability? Probability of it being here is 44. That means this probability has to be 56. So easy. Then we'll say 80 into 44% plus 0 into 56% divided by 1 year. So 1 plus 10% raised to 1. How much is that? 32. So 32 is the value, present value 32, right? So 32 is the value of the option. Okay. Now the last concept, which is your hedge ratio or delta. Hedge ratio or delta. I'll give you a simple framework to memorize the formula. The simple framework is change in option price as a ratio to change in spot price or underlying, but let's call it stock price. Change in option price as a ratio to change in stock price. Okay, so how do you get that change in option price and stock price? You actually get that here from the tree. Okay, so here this is your value of option. Option value was 80 and then it became 0. So then in the numerator, option value is 80 minus 0. That is the change in the option price. It changed by 80 rupees. 80 and 0. Stock price changed by 80, 180 and 55. So that's your denominator. 180 minus 55. So that becomes 80 divided by whatever this delta is. 125. How much is that? 0.64. So 0.64 is referred to as the hedge ratio or delta neutral portfolio. Is that okay? Now, slightly technical but testable, it's there in your syllabus. How do you build a replicating portfolio? Replicating portfolio using the hedge ratio. What do you mean by replicating portfolio? On one side, I have one option. Okay. On the other side, I'm going to create some sort of a mixture, khichdi, masala, where I'm going to mix 2-3 things, but the two portfolios should be exactly the same. उसको हम लोग क्या बोलेंगे? Replicating portfolio. Replicating means it's replicating the option. Okay. Now think about it. If you buy one option, what is the amount you have to pay? What is the fair value of this option today? Option का value कितना था? 32 rupees. So if you buy one option, you have to pay 32 rupees. The rule is, when you build a replicating portfolio, you have to pay a net 32 rupees only. Otherwise, how are they same? है ना? And this replicating portfolio has to behave exactly like your call option portfolio. Have you understood this? So now the rule is, I'm going to design a portfolio. That portfolio is going to behave exactly like a call option, and I have to pay how much? 32 rupees to buy. If you keep this logical framework in mind, you'd never struggle with replicating portfolios. I'll show you how. Now, after this, you just calculated your hedge ratio, which is what? 0.64. Do you know what is the meaning of this? Meaning of this is that when I buy 0.64 stock, okay, the delta of my portfolio is equal to one option. ऐसे क्यों? Because a stock, one stock, okay, will always have a delta of 1. A stock will always have a delta of 1. That's obvious. Stock price went up by 1 rupee, my profit is 1 rupee. Stock price fell down by 1 rupee, my loss is 1 rupee. 1:1. But that's not true with option. Option has a delta of 0.64, which means if stock price goes up by 1 rupee, my option profit is only 0.64 rupees. Okay? So क्या करना है फिर? Here, what is the delta that I have on this side? I have an option, right? What is the delta of the option? Here I have a delta of 0.64. So somehow I have to ensure that delta of this mixture portfolio is also 0.64. How can I achieve that? Simply by 0.64 stock. Because one stock has delta of how much? 1. So if I buy 0.64 stock, then what is the delta of my total portfolio? 0.64. That's it. So buy 0.64 stock. Just by doing this, you've replicated the delta. Now delta on both the sides is same. But when I buy 0.64 stock, मेरे जेब से कितना पैसा जाएगा? How much money will go out from my pocket? So the stock is worth how much today? 100 rupees. So which means how much money will go out from my pocket? 64 rupees. But remember, what is the other rule I put in? I said maximum money that can go out from your pocket today is how much? 32 rupees. But right now, to buy the stock, 64 rupees are going out. So what do I do? Just borrow the rest of the amount. Borrow how much? 32 rupees. Job done. This is called your replicating portfolio. Am I the only one who enjoyed this, or आपको मजा आया? The beauty of this portfolio on the right is, if you buy this portfolio, your portfolio will exactly behave as if it's a call option. It will give you the same money that you otherwise would make on a call option. And why do we need these replicating portfolios? For building arbitrage type of strategies. See, this is theoretical. Someone saying, can I buy stocks in fraction? We don't care, right? We're just building a theory. Do it in hundreds. Buy 100 options here. Buy 64 stocks here. Do you want to try one more? Okay, let's try one more. We'll directly reach to the last stage, so that will save time. Stock price 100 is going to, let us say, 150 or going to 70. You have a call option with a strike price of 120. So the value of the option is value, and let's assume probability of 60-40 just to save time. So value of the option is, help me out. How much here? 30 rupees. And how much here? 0 rupees. So let's do a weighted average. 60% into 30. That's equal to 80. 80, let's discount at 10%. Help me out. How much is that? 16.3. 16.36. 18 rupees discounted at 10% is 16.36. Okay, now we have all the information. Please build a replicating portfolio. Okay, as I told you, on one side, what do we have? On one side, we have purchased one option. To purchase this one option, how much did we pay? Help me out. How much money are we paying? 16.36. So when I build this replicating portfolio, it has to follow the same rules. I have to pay 16.36. This one option has a delta of how much? Please calculate the delta of the option. Delta is the hedge ratio. How will you calculate the delta? It would be 30 minus 0 divided by 150 minus 70. How much is that? 0.375. So this replicating portfolio needs to have a delta of how much? 0.375. So you figure out how will you achieve that. If the hedge ratio is 0.375, you figure out how will you achieve that. Correct. Very simple. You will say, what I'll do is I will buy 0.375 of the stock. Because remember, stock has a delta of 1. When I buy it in 0.375 quantity, I have 0.375 as delta. But to buy 0.375 of stock, which is available at 100 rupees, how much money will go out? 37.5. But how much money are you allowed to spend? 16.36. So difference amount you borrow, right? So we'll borrow how much? The difference? 21.14. This is your replicating portfolio. So on the exam, the question will be, they'll give you 3 options. Figure out which one is replicating portfolio. This is the one you have to select. Buy 0.375 stock and plus borrow the difference. And with this logic, you can also do put options. Okay. Do you want to try one put options? One more. It's okay. We can afford to spend time on this. After this, options are more or less done. Okay. Now, strike price of 200, spot price of 220. 220 goes up to, making up some random numbers, let's say 300 or 150. Okay, we'll assume probabilities of 60 and 40%, doesn't really matter. So how much is my put option worth? This is a put option now. I have a right to sell at 200, price in the market 300. How much is it worth? 0. How much is it worth now? 50. So weighted average will be 60% into 0 plus 40% into 50. What is the weighted average? 20. 20 discount backwards at 10% for 1 year. How much? 18.18. Okay. So what is the hedge ratio here? Hedge ratio is you take the differences in the price of the option. Okay. Now, here the formula becomes 0 minus 50 divided by 300 minus 150. We're still taking the difference, but my hedge ratio here will come in negative because the delta of the put option is negative. Why is the delta of the put option negative? When the stock price goes up, on put option you make losses. Call option deltas are positive, put option deltas are negative. So this is 50 by 150, that's 0.33. Negative 0.33. So how do I build replicating portfolio? You follow the same logic. Here, I have long position on one put option. Correct? And here, the delta of my portfolio is minus 0.33. And to get that, how much money I had to pay? 18.18. Pay means negative, right? Now you need to be a little careful with. Now the rule is I have to achieve the same thing here. I have to ensure that delta on this side is 0.33 and I have to also ensure that I'm paying 18.18. Okay? Now, I told you that if I buy a stock, my delta is 1 rupee. But if I want negative delta, what do I need to do? I sell the stock. So now this time I will sell. This time I will sell 0.33 stock. If I sell 0.33 stock of 220 rupees, how much money will I receive? So 220 into 0.33. How much money I'm receiving? 70? 72.6. I'm going to receive 72.6. Is this correct? 72.6 है ये ना? Okay. I'm going to receive 72.6, but what was the rule? Rule is मेरे जेब से कितना पैसे जाना चाहिए? How much money should go out of my pocket? 18.88. But then I have received 72. So what do? Then I will this time invest in RFR. Invest in RFR. Okay, and how much will I invest in RFR? So we'll take the difference of 72.6 plus 18.18 total कितना आता है? 54 नहीं मैडम. See, I have received 72.6. Now I'm plus. 18 rupees need to go out of my pocket, so I need to invest more than 72. So 72.6 plus 18.18. See, बाप बोलो. 90.78 and done. That's your replicating portfolio. This is also called delta replicating portfolio. Here you are receiving 72.6. And at the end of the day, that 18.18 needs to go out of your pocket. You need to have a net negative outflow. So then how much will you invest in RFR to ensure that 18.18 is going out of your pocket so that the two portfolios are same? So then you invest 90 rupees. No, interest is captured automatically. So when you go on expiry, this is the portfolio I'm designing at time 0. When you go on expiry, these two portfolios will give you the same RFR. Because right now, 18.18 is going, right? But on the expiry option is worth more. On the expiry option is worth 20 rupees. So automatically RFR will ensure that I get 20 rupees in this portfolio. Okay, so derivation is not necessary. It's there in my main videos. You can see the derivation. Just learn how to build replicating portfolios. Do you think you would be able to build it? You should be able to replicate a short call portfolio also. Okay, you should be able to also replicate a short put portfolio. And it's not that difficult. Just build a long call or long put replicating portfolio and change signs. Is it okay? Good. Now you've earned your break. Options are over. After the break, we'll start with forwards and futures. 20 minutes. चलेगा? Yeah, you're right. I forgot put call parity. We'll do that. Some questions on the chat box. Someone is saying cancel the break. It was fun. Okay, there are two separate comments, but too late. Has CFA offered you a position with them? I'm sure that's a joke. No, I haven't. If I get derivatives above 70, it will be because of you. Okay, thank you. Let's hope you get above 70. I'm scoring 60, 64 in the CFA mocks. Is it a safe score? You can do better. Just keep on working on your mistakes. Keep on improving by 2-3% each mock. LIFO to FIFO conversion is still there. No, it's not. Very helpful crash course. Thank you very much. I am glad it's helping you. What's a safe score in the mocks? 70 is decent, 75 is really, really nice. Thank you, sir. Offer us a job with you, भाई मैं आपके पास आ जाता हूँ काम के लिए. I scored 88 on FinTree mock, 70 on CFA mock. What to do? Celebrate. Did you see the silver prices today? And why did they fall? I was trying to search in the morning. Why did they fall? I don't know. I think I mean, whatever little I read, I think it fell because I think that Davos conference, right? Trump went a little soft on NATO. Earlier, people were thinking that he would go aggressive, but now probably he's not. So, which means no World War III happening, at least till the time he doesn't change his mood or flavor, which can be any time in the next couple of hours. Where can we get the notes? After the session, I'll upload the notes in the description. But we were talking about, it's ironic we were talking about the type 1, type 2 error in the previous class, right? With current pricing, I think there is no adequate margin of safety because there's no definite way of determining what's a fair value for silver. Shriyan, sure, you're welcome to reach out to us. We'll work out something. Where can we get juice notes? I think you can't. We used to put up juice notes separately on the FinTree portal a few years ago. We stopped doing it. So now juice notes come blended with some of the other products. If you need juice notes, you have to purchase any of those products which we have there. Sir, is short put just sign change at the end? Yes. Short put is just sign change at the end. See, in RFR, whenever you are investing, the sign is plus. So plus bond. Whenever you are borrowing, the sign is minus. Selling the stock, sign is minus S. Buying the stock, sign is plus S. So you should be able to invert the signs easily. Any option trader here? Come on, you should be, give me a hand raise. You should be proud of it. Nahin? Since how long you've been trading options? 2-3 years. Buying or selling? What strategy do you follow? More or less buy. And do you take, do you run strategies or you take directional bets?
Based on strategy.
Strategy. What are your favorite strategies?
They are momentum based mostly.
Momentum based. But then, are you building some spreads or pure positions?
Naked call. In the money.
So you buy in the money calls and puts also, or no, just call?
Mostly because the markets were bullish in the past 3 years. So,
Yeah, so markets were bullish, so you were doing mostly calls.
so I used to avoid buying put because the overall market was bullish.
Understood. So general sentiment of the market was positive, so you were mostly on the call side. Did you make any money? Good. Sharma ke bol raha hai. Yes. Good. Someone says ex option trader. You can also say ex rich person. सर समवन सेइंग ट्रेडिंग में स्ट्रैटेजीज तो एग्जीक्यूट नहीं हुआ है बट मैं ज़रूर एग्जीक्यूट हो गया. आई यूज्ड टू डू निफ्टी एंड बैंक. सब फेकू है ऑप्शन ट्रेडर्स. ओके. ऑलराइट, लेट्स स्टार्ट. सर आप करते हो क्या? नो. I mean, very few, maybe 1 or 2 option bets a year, mostly directional. My favorite used to be ITC, but this year, I mean, I was busy with this crash course, so I did not spend time on ITC, and I got lucky. And thank God I didn't do ITC because we saw what happened to the stock price. So very rarely, I mean, very rarely, if I have very, very strong directional view on some asset, that I want to express with options, I would do that. What excites me is in the US you got those leaps options with expiry of 1 year, 2 year, 3 year. Like you get long-term expiry options. Some of those options have been very exciting, but I haven't done a lot of those. I would like to do them at some stage. Okay, let's start. Options, I forgot to cover one important concept. Sip, Pepsi. Does anyone know? Be cool. You don't become cool by the way of sipping Pepsi, but somehow this kind of fitted the equation I was trying to work on. This will make your put call parity very simple because sip Pepsi be cool is SPBC. S plus P is equal to B plus C. This is stock, this is put option, this is bond, this is call option. Now, rule 1, put call parity works only and only on American options. Put call parity works only and only on American options. No. Put call parity does not work on American options. Put call parity works only for European options. Okay? Now, this option here, S plus P, this portfolio, S plus P, this is given a name. Does anyone know the name? The name of S plus P is protective put. Protective put. The name of B plus C is fiduciary call. Why fiduciary? Because you can trust the call. Why can you trust the call? Because you have bond that will give you cash to exercise the call. The idea is, if you design a portfolio of S plus P on one side and B plus C on the other side, the value of the two portfolios will always be same. The value of the two portfolios will be same on expiry. The value of the two portfolios will be same before expiry. Condition being the maturity of the call put is same, right? Those are European options, same underlying asset, obvious conditions. This bond is actually a zero coupon bond. And this bond, the face value of this bond has to be equal to similar to strike price of call, which obviously has to be same as strike price of put. That's your condition. That's called a simple put call parity. Now from this, at times you can create some synthetic structures. A synthetic stock is equal to, very simple, B plus C, P on the other side minus P. A synthetic put is equal to B plus C minus S. A synthetic bond is equal to S plus P minus C. And a synthetic call is equal to S plus P minus B. When I have a minus B on the sign, what does it mean? Selling a bond means what? Borrowing. When I have a plus B, that means I am investing. Okay? Look out for questions on the exam where they'll ask you, using put call parity, how can you build a synthetic short call position? Okay, so synthetic short call means you want to build a minus C. So minus C is going to be negative sign on S plus B minus B, which means it will be minus S minus P plus B, which means the option that you want to select is going to be, please short the stock, then please have a short position on put option, and plus B, that means invest in RFR, a zero coupon bond. Okay, so you'll have to answer questions like this. Do you think you can answer them? You should be able to figure out plus minus sign. I think that's fairly basic. Let's do one practice question. We'll do total 2 of them. First one I'm going to solve. Second one you're going to solve. Stock price is 100 rupees. Strike price is 100 rupees. Risk-free rate of return is 10%, 1 year expiry. Call option is available at a price of 35. What should be the price of put option? So all that you need to do is just sing S plus P, sip Pepsi, be cool, and start filling in the blanks. Stock price is 100, put option I don't know. Bond is a zero coupon bond with a face value equal to 100. So 100 divided by 1 plus 10%, the present value of the strike price. Call option is given to you as 35. So put option is equal to 90.90 plus 35 minus 100. कितना आता है वो? 25.90. That's the value of your put option. It's that simple. Okay, now variation in this would be the expiry could be less than 1 year. They might give you a call option, ask you to figure out put option. So you should be able to handle those type of variations. Do you think you can handle that? Okay. I saw one question in your learning ecosystem where the 3 options were find out the difference between call and put. So simple. You anyways have the call option value, which is how much? 35. Put option? 26. Difference 9 rupees or 9.1, right? So the answer that you had to select was 9.1. Difference between value of call, value of put. Now I can see why they've put it this question, because there is an equivalent put call inequality for American options. That's not in your syllabus. But in that American option put call parity comparable formula, we don't get an exact value of the option, but we get like a range. We typically get the difference between the call value and the put value there. Okay. Now, Sure, someone is asking put call forward parity. Let's do put call forward parity. S plus P is equal to B plus C. Okay, this is my usual equation. Now, some of you might remember that what is the relationship between spot and forward? A forward price is equal to spot price multiplied with 1 plus R raised to N. This is called what? No arbitrage forward price under cash and carry assumptions, right? If I revise this equation, S is nothing but F divided by 1 plus R raised to N. That's it. That's your forward parity. Forward price divided by 1 plus R raised to N plus P is equal to, what is B? B is present value of strike price. So strike divided by 1 plus R raised to N plus C. Now, some theoretical questions that might show up, maybe they'll just give you a forward price and then give you put price. You have to figure out call price, which is easy. You know? Instead of using S, you replace S with present value of forward. Okay, so you should be able to handle that. The lady in specs there, this side. Ma'am, are you comfortable? Yeah. Okay. What's your name? Mehak. So Mehak, now another question that might show up on the exam. Okay, very unlikely it will show up, but it will work like this. If I move both of these numbers on the left hand side, so forward minus strike divided by 1 plus R raised to N, okay, is equal to C minus P. So what is the difference between the price of a call and the price of a put? That difference I can calculate if I take the difference between the forward price and the strike price and then divide that with 1 plus R raised to N. Just take the present value of that. That will directly give me the differences of the call and the put. Are you comfortable? Okay, good. All right. Let's switch gears. Let's go to how comfortable are you with options more than 80% or 50 to 80 or below 50? Let's start with more than 80%. Okay, 50 to 80 and below 50. Below 50. Achha. ठीक है. Online, if you could give me a feedback, please. How comfortable are you with options? Yeah, below 50, are you doing options for the first time? Okay. Now we go to forwards. Difference between forwards and options is forwards are symmetrical, options are asymmetrical. In forward, you don't only have a right or you don't only have an obligation, you have both. You have a right and obligation together. Okay. So one very popular question on the exam is integrating forward and options, which looks like this. This is options, we have call, we have put, then we have long call, short call, then we have long put and short put. With forwards, we have long forward and we have short forward. When I'm dealing with options, okay, a long call means right to buy. Okay, and what does short put mean? Obligation to buy. Short put, obligation to buy. What is a long forward? Long forward is right to buy plus obligation to buy. The two things together, combined. Right and obligation to buy. In the same way, what is short call? It is obligation to sell and long put, right to sell. And what is a short forward? Right to sell plus obligation to sell. So, if I buy one call option, okay, if I buy one call option, and if I sell one put option on the same underlying asset and same strike price, combine these two, which is long call plus short put, actually I end up getting a long forward. This is actually called a synthetic forward. So I can create a forward position using the options. How can I do it? I can buy a call option and I can sell a put option together. Long call plus short put will give me long forward. Long forward is symmetrical. Options are asymmetrical, but when I combine two asymmetrical products, one gives me upside, which is long call, one gives me downside, which is short put. Combine the two, it creates a forward. In the same way, if I combine a long put, which gives me right to sell, and along with that, if I sell a call option, which is obligation to sell, the combination of these two is going to give me a short forward. So how do you replicate a short forward? So you take two in the center. Two in the center of your flowchart, two options. How do you replicate a long forward? You take two on the margins, long call, short put, or either long put and short call. Long put, short call. Is it okay? Conceptually comfortable here? Good. Then, you have to learn to distinguish between the price of a forward versus the value of a forward. What I told you earlier, the price and the value and the premium of option were same. That's not true here. Okay, here price is different and value is different. What is the price? Price means the amount return inside the forward agreement. So in the forward world, that forward price is kind of similar to your strike price in option. Does that change? No. So in the same way, you have a right and obligation to buy. So let's say a forward price of 100 rupees. This is written inside your derivative agreement. This is not going to change. So this does not change. Forward price does not change. Okay, once inside the agreement, it will remain the same till expiry. Whereas value means either you're making profits or you're making losses, okay, on your contract. And obviously, as the underlying value changes, your profit or loss will keep on changing. So this, does it change? Yes, this does change. And how does it change? Based on the movement of, based on changes in underlying asset. Underlying asset. So another theory question. Does the price of a forward contract change? No. Does the value of forward contract change? Yes. What is the value of forward contract? Profit or loss. Okay. Let's work a little bit on pricing of forward first. How do you price a forward? You simply use a no arbitrage forward price formula. The general equation is forward price is equal to spot, okay, plus you add all elements of cost, minus you deduct all elements of benefit. The most important cost is going to be interest cost. At times, if you're dealing with commodities, there could be storage cost. And the most important benefit is going to be dividend if you're dealing with equities, and convenience yield. Okay, so convenience yield is another testable section. Convenience yield. Does anyone know what convenience yield means? It's an intangible, unmeasurable directly. Unmeasurable directly. Benefit of holding commodity. Okay, in a simple language, instead of buying a future contract on gold, you decide that I will keep the gold, buy the gold and keep it in my house, and then every day in the morning you go and stare at your gold and you feel good about it, right? That it brings you some happiness. That's kind of what the convenience yield is. In a business context, which is a real world context, yeah, I think in the class we did milk example for those of you who attended the class, right? You're selling chai, and imagine suddenly you generally keep only 1 liter of milk with you. And suddenly a big political rally is crossing and someone comes and says, can you make 1,000 cups of tea? But if you don't have the milk, you can't take that business. But imagine someone else who stores large amount of milk in refrigerator, they can take that business, right? So there is some benefit of holding that raw material or inventory with you. That is referred to as convenience yield. Convenience yield are very important when something is in short supply. So something is in short supply, the convenience yields typically tends to spike because there is a benefit of holding them. Okay. Now, there is some time value component to it, which basically means if I have to refine this equation, this spot price has to be the future value of spot. Okay. But because I have taken interest cost here anyways, so I will not write future value. But this cost, you have to take future value, which means on a time value adjusted basis on expiry. And these benefits also you have to take future value. I'll show you 2 or 3 examples, you will get it, it's fairly simple. Here's example number 1. Spot price is 100 rupees, RFR 10%, maturity of the contract 1 year. Okay, please figure out no arbitrage forward price. So you would say, easy question, it would simply be 100 rupees into 1 plus 10% raised to 1, which is equal to 110. That's it. Just take future value of spot. Example 2. Spot price 100 rupees, RFR 10%, maturity 6 months. Figure out no arbitrage forward price. Now you would say, okay, it's only for 6 months. So 100 multiplied with 1 plus 10% raised to 0.5. Okay. Or if you're given a MRR on the exam, MRR means market reference rate, then we can't do raised to 0.5. So then we will say 100 into 1 plus 10% into 6 by 12. Okay, the answer will change in decimals. This will be 105.4.8 and this will be 105. So just the compounding frequency will change, but conceptually the answer is there. Are you okay? Then example 3, spot 100, storage cost, okay, of 5 rupees, let's assume paid at time 0. RFR 10%, maturity 1 year. Find out no arbitrage forward price. Now when you start getting questions like these, here's what I want you to do. All these questions, I want you to solve on a timeline. Okay? So time 0, today the spot price is 100. Then the storage cost I have to pay today itself. Okay? My job is to take this 100 forward from today to 1 year and take this 5 forward from today to 1 year. I can just do a combined thing also, and whatever that number is, how much is that? 115.5. Okay. Had the storage cost been paid here in 3 months, for example, then we would have taken it forward for how many months? 9 months. That's it. Is that simple? Make sense? One more scenario. Example 4. Now I'll just build a timeline for you. Let's assume at time 0 some underlying asset is 100. In 3 months, you're incurring a cost of 10 rupees. Okay. In the 7th month, you're getting a benefit of some cash flow from the underlying asset of 12 rupees. What is the no arbitrage forward price in 1 year? Now how would you solve this? Again, simple time value of money question. This 100 you need to take forward at the rate of 10%. For how many years? 1 year. So this will be 110. This 10 rupees you need to take forward. Tell me for how many months? 9 months. Why? Because 3 to 1 year, right? 9 months. So help me out. How much is that? 10% is the RFR. So 10 is the present value, 9 by 12 is the N, 10 is the IY, compute future value. Come on, pick up some speed. 10.74. Good. And this 12, you need to take forward for how many months? 5 months. 5 months, right? So, karo. Second clear TVM. 12 present value, 5 by 12, N, 10 is the IY, compute future value. 12.48. Now, should any of these have negative sign? Which one? Benefits. Benefits should have a negative sign. Cost adds to the forward price, benefits reduce to the forward price. So how much are you getting? 108.26. There you go. That's your no arbitrage forward price. If you've understood this, pricing is done. What do you think? Easy? Good. Now, what if your no arbitrage forward price is 100 rupees, but for some reason, the dealer quotes you a price of 120 rupees. Okay, dealer quote is 120 rupees. That means dealer is not quoting you an arbitrage price, dealer is quoting you some other price. What will you do in this case? You will exploit an arbitrage. What type of arbitrage will this be? Second scenario. No arbitrage forward price is 70 rupees. Versus the dealer is quoting you at 70 rupees. Dealer quote. Okay? What will you do in this case? Run an arbitrage. How will you exploit the arbitrage? Now just tell me the name. Which one? First one? In one case, just please answer the first one. How much, Sai? What should I do? First one. Okay, I'll give you a hint. For the candidates who are writing exams, how to think. See, the dealer is making a mistake. Dealer is quoting higher price. At this price, do you want to buy or sell? Obviously, I want to sell. Now, I want to sell in the future. है ना? To sell in the future, I need to have the asset. बराबर है ना? अगर मेरे को future में, if I want to sell, then I need to have the asset today. That means today I need to buy the asset. So whenever I'm going to buy the asset and keep that asset with me for 1 year or 6 months, okay? That means I'm going to carry the asset with me for 1 year or 6 months. Then this arbitrage becomes a cash and carry arbitrage. I will use the cash, I will buy the asset, keep the asset with me, and then sell after 1 year at a price of 120 rupees. Is it okay? Now here what will happen? If the dealer is quoting you 70 rupees, so in the forward market, do you want to buy or sell? In the forward market, do you want to buy? So that means I don't have to buy today, I have to actually sell today in the spot market. So this becomes an opposite of cash and carry. This is referred to as a reverse cash and carry. This becomes reverse cash and carry. Okay? What are the exact steps? For theory questions, testable, juicy area, easy. I don't want you to be losing points on this area. How will I exploit cash and carry? Let me show it to you. Step number 1, A certain set of actions I will do today. A certain set of actions I will do in the future. What will I do today? So the set of actions I will do today. Okay. Step number 1, I will borrow the underlying asset. So maybe in this example, approximately borrow 90 rupees. Why is that? Assuming 10% RFR, if no arbitrage is 100, that means spot price today is about 90 rupees. So I will borrow some amount. Then step number 2, I will buy the spot at 90. And step number 3, I will enter into short forward. Okay. What actions will I do after 1 year? After 1 year, I will sell my asset at what price? 120. And then I will repay loan of 100. And that's how I will carry that profit of 20 rupees in my pocket. This is referred to as a cash and carry arbitrage. Is it okay? How about here? How do I execute a reverse cash and carry? I do exactly the opposite steps. So certain set of actions today, certain set of actions after 1 year. What do I do today? What do I do after 1 year? Today, step number 1, I will short sell the asset at approximately 90. Step number 2, I will invest that 90 into a bank. Step number 3, this is in RFR. Step number 3, I will enter into a long forward. Then after 1 year, I will collect 100 from my bank. You remember last year I invested 90. So today they have become 100. Step 2, using that 100, I will buy what? Buy the asset. Buy asset at 70. And then I will do a cover my short position. That means just whatever asset I borrowed, I will give it back to them. That's called short covering. And how much is profit is left for me here? 100 minus 70, 30. This is referred to as a reverse cash and carry. Look out for questions that ask you to figure out whether it's a cash and carry or reverse cash and carry. Look out for questions where they ask you to demonstrate the process. What will I do now? Right? If you know this page, you should be able to answer those questions. Can we move forward? Okay. Now, the second part of forward contract is valuation of forwards. Valuation of forwards means I want to figure out a profit or loss. I would strongly encourage you, okay, to follow our method called make a phone call method. Do not follow the process in the CFA curriculum. I feel this is a much more easier way to deal with those questions. Make a phone call method. I will show you one demonstration and then I'll give you 2 questions to practice on. Make a phone call. The question will look something like this. Spot price is 100 rupees. RFR is 10%. Maturity is 1 year. Okay. You decided to build a long position. Just a minute, I have to fix my camera. Okay. So, spot price 100, RFR 10%, maturity 1 year, you have a long position. Now, you build a timeline like this. Okay. Time 0, time 1, and I would strongly encourage you to follow the same drill on the exams. They give you a rough paper there. Make this price, which is your no arbitrage forward price. How much will that be? 110 rupees, 100 plus 10%. On this, you're building which position, long or short? On this, you're building a long position. Okay? Now, let's assume if they come and tell you that, hey, listen, after 3 months, okay, the spot price has become some 150 rupees. When you entered into the contract, spot price was how much? 100. In 3 months, it became 150. What is your profit or loss? What is the value of your contract? So what you need to do is you need to make a phone call. To whom? You need to make a phone call to whom? To the dealer. In the forward markets, you have a dealer. So call dealer. And what will you say to the dealer? You will say that 3 months ago, I booked a forward with your help. Now I'm looking to do one more. Okay, which one? On the same asset. But this time, the new forward that I need it for how many months? I need it for 9 months. So dealer will say, sure, I've learned the formula in my CFA level 1 class. I'll quickly quote you a price. 150 rupees into 1 plus 10%, but this time 9 months by 12 months. That means 0.75 of a year. So the dealer will give you a new price which is equal to, anyone? 160? 161.11. So dealer will say, see now if you have to do a forward on the new price for 9 months, it's going to be 161. You just suck the oxygen in my class, ma'am. Control karo. हाँ वो बाजू वाली आपकी. So it's 161.11. Now this is, what you say dealer is, okay fine. On this new price, please book an opposite trade for me. Please book a short for me. So now what happens? 9 months from today, what are we doing? Are we buying or selling? First we are buying on the old contract. At what price? 110. And on the same day, with the help of new contract, we are selling. At what price? 161. So the difference of the two, is that my profit or loss? Profit. And is that profit locked in? Yes. Which means after this, I don't care if the spot price goes up or goes down, because my profit is locked in. My profit on this trade is going to be 51.11. Okay? But is that profit today or is that profit 9 months from today? 9 months. So I simply discount this profit backwards for 9 months. So 51.11 divided by 1 plus 10% raised to 9 by 12, or do TVM row? 47.5. This is the value of the forward contract. That means the profit I've made. What was the price of the original forward? Price kitna tha? 110. What was the price of the new forward? 161. But what is the value of the old forward today? Is 47.5. That's the profit I've made. Okay? Now, am I actually doing this? Am I really calling the dealer again and getting the price? No. This is all a what if scenario. I'm not booking my profits today. I'm saying if I had to book my profits would have been worth 47.5. Why do I need to do that? Because I need to prepare my profit and loss account. So when I need to prepare my profit and loss account today, I need to know if I'm making profit or loss. Here I'm making a profit of 47.5. Now, had the question been for short forward instead of long forward, good news for you. Same calculation, just the final step. Instead of profit of 47.5, it is a loss of 47.5. That's it. That's how you value a forward contract. There are shortcuts to do it. I can show you the shortcuts. But I want you to follow the same drill. Make a phone call. It's a little lengthier. It's actually a little less efficient. But there's a reason why I recommend this method, because this method is versatile. It works across the board. It works in equities, but very importantly, it works in bonds or interest rate contracts, and extremely importantly, it works with currency forwards. Make a phone call method. You don't have to memorize 10,000 different formulas, just one mental framework and you're done. Do you think you can handle this? Okay, let's try. You try one. Let us say you have already entered into a forward contract. I'm adding some complications with timeline, okay? 15 months. You've already entered into a contract for 120 rupees and you have taken a long position. The expiry is 15 months from today. Today we are at the 4th month. Today the spot price is 200 rupees. Let's assume RFR is 10%. Please figure out the value of the contract. Where are we with this? Step number 1, call up the dealer, ask them for a new forward price. That will be 200 multiplied with 1.1 for how many months? 4 months to 15 months is 11 by 12. How much is that? 218.25. Now, on the old contract, you had long position. On the new contract, you should have short position. The difference of the two is your profit or loss. In this case, profit or loss? Profit. How much is the distance? 88.25. 88 or 98? 98. 98.25. This calculation is correct, right? Now, once I have this 98, then I take it backwards for 11 months. 98.25 divided by 1.1 raised to 11 by 12. 90.03. Done. So valuation is also done. Are you with me? Are you comfortable here? Can I do what? Can I use a different color? Which color should I not use? Green? Okay, is it not visible? You don't like green? You can't see green. Can you see? Okay. So you have a problem with green, is it? Or is it, no, is it projector problem or? Acha, okay, my apologies, sorry, I didn't know that. Okay, I'll be careful. 98.25 here, which I need to discount backwards. Equation will be 98.25 divided by 1.1 raised to 11 by 12, which gives me 90.03. Not divide by 15, that 10% is per annum, Ritesh. Why short, please? Because I am taking an opposite direction. If I have long here, I will build short here. Why not divide by 15? As I said, 10% per annum. I am left with 11 months. So 11 by 12. कुछ बताओ भाई, कुछ आ रहा है नहीं आ रहा है, क्या चल क्या रहा है? आ रहा है? Are you can you handle this? Okay. Can I make some progress? Okay. Now there is one part that I need to cover. Okay. Someone again is asking, how did you get 98.25? I took the difference of these two. Some of you are not listening to me when I'm explaining. Just the difference of 120 and 218, that's my profit. This profit I take backwards. That's it. Chalo. I'm sorry, but I have to keep on throwing at you. It's already 5:15. I hope to finish derivatives at least by 7. You know? So, next concept. Are you enjoying this? It's all maths, right? At least calculations are fun. Now, now this question that I'm showing you, this can be tested in derivatives and it can also be tested in economics. Okay, it's cross-sectional. This is your forward contract on currencies. Now I need your 100%. So, for next 10 minutes, 100% focus. This part repeats in level 1, level 2, level 3. What I'm showing you now, if you get the crux of the technique, for the rest of your life, you'll never struggle with currencies. Okay, but you have to focus a little bit. See now, they might give you a question which looks like this. Let us say a spot price, okay, is USD 3 per, let's say, a euro. And interest rates in US are, and let's call them MRRs this time, a 360-day MRR. So we change the compounding fashion a little bit. Interest rate in the US is 6%. Interest rate in Eurozone is, let's say, 2%. Now, question number A. What is a no arbitrage forward price for a 90-day contract? Now, when we were doing other currencies, the formula was simple. Spot into 1 plus R raised to N. But here we have 2 R's. So what we need to do is, we need to put 1 R in the numerator, 1 R in the denominator. Okay? What is that R in the numerator and R in the denominator? It will be like this. It will be 3 multiplied with 1 plus some interest rate divided by 1 plus some interest rate. This interest rate is per annum, whereas my contract is for 90 days. So I will have to modify the interest rate by multiplying 90 by 360. Why am I not doing raised to this time? Because the rate which is given to me is MRR. With MRR, we don't do raise to, we adjust the rate. Okay? The question is which rate in the numerator and which rate in the denominator. So, there is a numerator denominator rule, which is not like an official rule, just made up rule. What is numerator denominator? In the CFA exam, the currency you see in the numerator, that currency's rate goes in the numerator. The currency you see in the denominator, that currency's rate goes in the denominator. That's it. Okay? Now, this is true only for CFA exams. In real world, currencies are not quoted like this, but CFA tries to simplify, at times maybe oversimplify. Okay, so because I have some CA students listening to me today, this will not work in your CA final. There you'll have to be a little careful with. Anyway, so now, which means US rate 6%, so 6%. Euro rate 2%, 2%, and then done. Whatever the answer I get, that's my no arbitrage forward price. How much is that? So, solve for numerator first, then solve for denominator. Karo, saath mein karo. 6% into 90 by 360. 6% into 90 by 360. Plus 1, STO1. 2% into 90 by 360. 2% into 90 by 360 plus 1, STO2. 3 multiplied with RCL1 divided by RCL2. 3.00 or single zero? Single zero. 29. Gaurav, this is less than a year I'm using a MRR. If I'm using MRR, I'll solve it like this. Are you comfortable? Okay. Practice 1, but this is not the real question. The real question will be the third one from here, or the second one from here now. I want you to practice one more in the interim. Let us say now rupees 5 for a African rand. That's the interest rate. Let us say interest rate in India is 10%. Interest rate in South Africa is 4%. Find out no arbitrage forward price in 1 year. Simple, straightforward. Now it's 1 year, so whether you compound, don't compound, doesn't matter. So the numerator currency of rupees, numerator interest rate India. Denominator currency Africa, denominator interest rate Africa. So it will be 5 multiplied with 1 plus 10% divided by 1 plus 4%. How much is that? 5.28. Okay. Are you with me on this? Now, if I were to frame a question for you, I will actually try to link this formula with the first formula we learned, which is spot plus all the cost minus all the benefits, right? This is equal to my no arbitrage forward price. Now, connecting this formula to this formula, this clearly is my cost. Yes or no? Which means the interest rate of the price currency is the numerator currency. This is called the base currency. The interest rate of the price currency is actually the true interest rate. But by putting that 1 plus 4 in the denominator, is it like doing a minus or is it like doing a plus? When I put it in denominator, geometrically I'm deducting it, right? So this denominator interest rate is actually to be perceived as a benefit. And therefore it's reducing the forward price. So the interest rate of the price currency is your cost of carry, and the interest rate of the base currency is your benefit of carry. Have you understood this? Okay. Now I told you the real question comes in here. If this shows up on the exam, hopefully this will put a little smile on your face because it's a tough question. Let us say, we'll use some different currencies. Let's say you get 10,000 Indonesian rupiahs for give me some other Asian currency. Okay, let's do Thai baht, THB. So one Thai baht gets you 10,000 Indonesian rupiahs. Okay. Interest rate in Thailand, okay, is 5%. Interest rate in Indonesia is 20%. Question number A, that's easy. Find out 1 year no arbitrage forward price. That's fine. That should be okay. But the second real question. Let us say you have built a long position on the forward contract for 10 million Thai bahts. You have built a long position on forward contract for 10 million Thai bahts. And after 3 months, the spot price is IDR 11,000 for a THB. Determine value to the long. That's the real question. Subpart B. RFR will keep same and will use annual compounding just to keep things easy. So that means you can do raise to whatever number you want to do. Are you done? Okay. I'm solving this now. I want you to observe this carefully. Just get hold of the concept. All right. Step number 1. Sir, is this red is okay, right? So, no arbitrage forward price is equal to spot of क्या था यार 10,000. So 10,000 multiplied with 1 plus. Whose interest rate should I put in the numerator? Indonesia, right? Because that's my price currency or numerator currency. So Indonesia 20%. Divided by Thailand 5%. Which one of this interest rate is a cost? 20 or 5, which is the cost? 20. Which is the benefit? 5. Okay? That would give me no arbitrage forward price of how much? 11,428. Forget decimals. 11,428. Okay? Now, a timeline for part 2. This is time 0. This is 1 year. I have built a long position. The forward price is 11,428. But in which currency? 11,428 of what? Indonesian rupiah. Okay? For what? For 1 Thai baht. Now, the mental model that I want you to use is this base currency. Just learn to think of it as an apple. Okay? Once you develop that kind of a thinking, that base currency is not a currency. It's an apple. One apple you have a right to buy at a price of 11,428 IDRs. Okay, that's your mental model. Now, the moment you learn to think like this, it becomes easier. Let's see what's happening. After 3 months, so this is today now. Now, today the spot price has become how much? 11,000. So, spot price today has become 11,000. Okay? So then, what do? You do the same drill. You call up the dealer and you ask them what's the new price. So dealer says, sure. 11,000 multiplied with 1 plus, which rate in the numerator? 20%. So 1 plus 20%, 1 plus 5%. But this time we'll do it for how many months? 9 months. So 9 by 12. What is the new forward price now? How much? 12,158 IDR for 1 Thai baht, and we know that Thai baht is same as 1 apple. Okay? Now, on the previous contract, you had long position or short position? Long position. New contract. Someone asked on the YouTube chat box that why short? Because previous one was long. So in the new contract I built short. Then the difference between long and short could be either profit or loss. So now the thinking is, if I buy 1 apple, I get to buy it at 11,428. The same apple now, I get to sell it at 12,158. So per apple, what is my profit? Difference of these two? 730 IDRs. Per apple, I'm going to make 730 IDR. But I have made contract for how many apples? 10 million apples. So if per apple I make so much of money, if per apple I make this much money, then how much money will I make for 10 million apples? Base currency is an apple. So 730 into 10 million would be 7,300 million IDR. So my profit is 7,300 million IDR. Okay? Now, once you've reached here, final step, you need to take the profit backwards to 9 months. The only question that remains, and that's why make a phone call method is so elegant. When I discount it backwards, should I use the Thai rate or should I use the Indonesian rate? So simple, my profit is in IDR. That Thai was nothing but an apple. I bought apples cheap, I sold them expensive. I made profit of 7,300 IDR. Obviously, I will discount at IDR. So my final solution, 7,300 million divided by Indonesia rate kya tha? 20% for 9 months, 9 by 12. How much are you getting? 6? 6.3? आप बोलो 6368 million IDR. That's it. That's your profit. That's your value. This is how you will handle currency under no arbitrage forward price regime. How comfortable are you with this? Do you think you will be able to handle? Good. So then, more or less, forwards are done. I mean, some smaller interest rate nuances are left, but we'll deal with them a little later. Now I would like to go to futures. Good news with futures, almost everything is same, except we have to learn one new concept, which is margin calculations. Let's do margin calculations now on silver MCX contract. अरे यार Okay. So now I'm going to do a future contract on silver. Okay, with an expiry available option of 5th of March 2026. That silver is available. The contract value is, क्या number है ये? 308538. This is per kg of silver. Yes. Unit is per kg. But I cannot do a contract just on per kg. There would typically be a lot size attached to it. The lot size is, I think, I know the lot size is about 35 on this contract, I guess. आप दिख रहा है कहीं पे? कहाँ पे? हाँ. Okay. What does it mean? It means you want to play silver. Okay. Right now the price is, and it's crazy by the way when you look at this number, right? 3 lakh per kg of silver is insane. Silver used to be like a cheap commodity of sorts, right? I've been to restaurants where they serve, they have that thali, right? गए हो आप कभी? They have silver thalis where they'll serve that food. I wonder what are they doing now? Must have put them in lockers, right? Now, I want to do this trade. Okay? We'll round off the number. We'll say, today the silver price, okay, price of silver in Indian rupees is 300,000 rupees. But the lot size is 30 kgs, this is per kg, which means one contract becomes how much? One karo math? 90 lakh Indian rupees. Okay, so that's 9 million. So let's stick to CFA convention. 9 million rupees per contract. काफी ज़्यादा है यार. It's a sizable trade, 9 million. Now, you have to take one of the two sides today. It's a 9 million contract. You have to decide whether you want to be on the long side or whether you want to be on the short side. Do you want to be long or short? Short. How many of you would go long if you have to take one of the two? How many of you are going long on silver? How many of you are going short on silver? Come on, give me hand raise. ठीक. Now, there would typically be an initial margin that one will have to deposit when you go long on silver. For a trade like this, my guess is initial margin should be, let's say about 1.5 million Indian rupees. Okay. So, in your margin account, those of you who are going long, you'll have to deposit 1.5 mils. Those of you who are going short will also have to deposit 1.5 mils. मतलब 15 लाख रुपए. Has anyone traded this future before? No. Okay. Now, let's assume you get lucky, and tomorrow, you get lucky depending on which side. Tomorrow, the price of the future contract goes to 9.1 mils. Okay. So what clearinghouse will do is, at the end of the day, clearinghouse, who's making profit when the silver is going up? Long, right? So clearinghouse will deduct that 0.1 from shorts account, and shorts margin now will become 1.4, and that 0.1 will be deposited in whose account? Long's account. So long will now have 1.6. Yeah, I've approximately taken 15 to 17% margin, so that gives you a 6x leverage, I think, which is fair, I guess. Okay, so 1.6, 1.4. Now, when you enter the contract, your broker will tell you that, sir, the variation margin, the maintenance margin on this account, maintenance margin in this account is going to be 0.9 mils, which means at any point of time, you cannot allow the margin value to fall below 0.9. Let's say that the price went up again and now it became 9.8, crazy next day. And by the way, silver has been insanely crazy. I generally don't like to look at stock prices every day. I try as much, but off lately in the last 2-3 months, I just cannot resist. Right? Get up in the morning, I want to look at what happened to silver prices. Is every day there has been 2, 3, 4% type of rally, right? So let's say it goes to 9.8. Now what? Who's making profit? Long. So what exchange will do is it will deduct 0.7 on this account and it will add 0.7 on this account. So then after this adjustment, what are you left with? 2.3, and what are you left with? 0.7. The moment it falls to 0.7, the broker will trigger a call. This is where you would receive a margin call. The broker will say, please deposit. How much? To bring it back to the initial margin level. Which means, I have to deposit how much? I have to deposit plus 0.8. So that now my margin is replenished to 1.5. Okay? And then, from 9.8, it went back to 9.2. Now what will the clearinghouse do? Deduct from long's account, because now it has fallen. So it will deduct how much? 0.6. So now how much are you left with? 1.7. And 0.6 will be added here. So how much short is left with? 2.1. I have analyzed the CFA exam question patterns. These are the questions they like on M2M. Now, I can see why do they like it, because they will ask you what will be the margin value left on day 4. Okay, let's assume this is maybe day 0, day 1, day 2, and day 3. They will ask you what is the amount of margin left in day 3. Okay. Now, for long side, it's very easy. Why? Because when I started the trade, it was 9 mils. When I ended the trade, it's 9.2. It went up by 2.2. So my 1.5 became 1.7. Logically, for short side, it should have become 1.5 minus, bolo kitna? 0.2. It should have been how much? 1.3. So 1.3 will be one of the options on the exam. But that will be a trap. Why is that? Because beach mein, that margin call is getting triggered. Right? So on the exam, you'd have to be very careful. You just cannot take the difference between opening and closing price. You'll have to do it this way so that you understand how the margins are flowing. Are you with me? Do you think you can handle these questions? Okay. Someone is asking why 0.8, why not 0.2? That's because once you have breached the maintenance margin level, you need to bring it back to the initial margin level. Where do we use 1 minus initial margin formula? That is in equity. That's inverse of initial margin is your leverage formula that we learned in the equity class, Pooja. Okay. Baki future mein same hai. Default risk is mitigated and everything else is manageable. Theory, I'm assuming you know the difference between forwards and futures. Do you want me to repeat this example or can I go to the next one? I mean, have you understood margins? Yes? All of you? Okay. So finally allows us to go to swaps. Within swaps, there are 2-3 variations. The famous one obviously is interest rate swap. Okay, some folks are struggling here. This is called mark to market. What is mark to market? This process. Every day some margin is deducted and that margin is added to counterparty's account. This process is called M2M, mark to market. Break चाहिए आपको अभी? नहीं no? Let's do swaps now. Now, we have interest rate swaps. Then we have typically equity swaps. Okay, there are multiple swaps, but I'm just covering the important one. And then there is something called as a total return swap. TRS. IRS, equity and total return swap. Here we have two parties. Okay, one party is called pair. Yeah, I mean there is a CDS, but CDS technically is not a swap. Though it's called a swap, but it's not a swap. CDS is not a forward commitment. CDS is a contingent claim. CDS is more like an option rather than. तो वो नाम confusing है. It sounds like it's a swap, but it's more like an option. Credit default swap. There is one party which is pair, one party which is receiver. Pair will pay fixed rate and receiver will pay floating rate. Swap will have a notional principal. Notional principals are not exchanged. So as a pair, what are you hoping? Interest rate will go up or go down? As a pair, do you want interest rates to go up or go down? What do you think? So think of it this way. I am a payer. Every year I will pay you 5% fixed, and you will pay me whatever is the rate in the market. Now, whatever is the rate in the market, should that be higher or lower for me? Higher. So I'm hoping that interest rates will go up. So I'm kind of bullish on the interest rate of sorts. Okay, let's not use the word bullish. I'm hoping interest rates will go up. That's the correct word. If I'm a receiver, every year I'm receiving 5% fixed and I'm paying you whatever is the rate in the market. Do I want whatever rate in the market to be higher or lower? Lower. So I will profit when the interest rates are going down. Don't memorize, conceptualize. इसको दिमाग में डाल लो, right? You can always figure out on the exam. I'm paying fixed, receiving floating, so obviously floating should go up. I'm receiving fixed, paying floating, so obviously floating should go down. That's it. What happens in an equity swap? Generally, there are two parties. One party will pay returns on equity, and the other party will pay fixed rate. Okay, or floating rate. There can be multiple combinations of this. So, let's say this party is pay equity, receive fixed party. Okay, think about these guys. You have to pay returns on Nifty, and in return you receive fixed 5. So let's assume I am that fellow. I am receiving 5% every year, and whatever is the return on Nifty, I have to pay to the other party. Now, would I hope Nifty to go up or Nifty to go down? Down. That means I have a short position on equity here. I am hoping that Nifty will go down. Think of the other party here. Let's give them name X and Y. Okay, the other party. This party is receiving, so now me on the Y side, I'm receiving Nifty returns, I'm paying 5% fixed. Do I want Nifty to go up or go down? Go up. So that means here I am long on equity. And finally, a total return swap. Actually, even equity is a total return swap where I will pay return on some X asset. I will receive or I will pay on some Y asset. Could be anything. You can swap whatever you want. I can pay returns on gold, you pay me returns on silver. Total return swap. आ रहा है समझ में? I pay returns on copper, you pay me returns on equities. Total return swap. So the two legs are flexible, you can keep whatever you want. And at the end of the day, remember, swaps are not exchange products, they are OTC products. So two parties can come, negotiate and customize the contract. Are you okay here? Now, we have to do a little bit of work on swap pricing. Okay, so let's first I will do total of 3 examples with you. First example, swap cash flows. Figuring out swap cash flows. Let's say there is a swap which has a notional principal of $100 million and which has a fixed rate of 8%. The floating side is MRR. Okay, or let's say MRR plus 1%. Now, this party is a pair. On one side, we are going to think from pair perspective. The MRR rate turned out to be like this. This is time 0, this is time 1, this is time 2, time 3. It's a 3-year swap. Okay, annual reset. At time 0, MRR is 10%. Then MRR became 15%. Then MRR became 6%. Then MRR became 12%. Okay? We have to think from pair perspective. At time 0, notional principal is 100. Your pair, how much will you pay? Nothing. Notional principal is not exchanged. Okay, which means वो सिर्फ agreement में ही रहता है. We do not have to exchange that 100. I mean, why would you do it? It's like I'll give you 100 rupee note, you give me 100 rupee note. Stupid, right? Makes no sense. There's only one swap where notional principal is exchanged. No other swap notional principal is exchanged. Does anyone know which one? सिर्फ एक ही swap है. There is only one type of swap where NP is exchanged. I'll be impressed if you answer. Think about it. What can be that swap where it's necessary for you to exchange notional principal? TRS? No. It's not one of these three. It's a fourth one. Some people on the chat box have already got the answer. Super impressive. Currency swaps. Because there are two currencies. I will pay you dollar, you pay me euros. Okay? But all of the swaps, notional principal is not exchanged. Now, what happens at time 1, time 2 and time 3? Okay? What happens at time 1? Every year, remember I am a pair and what do I pay? I pay this fixed rate, which is 8%. This fixed rate into a swap is one more name. This is called as the price of the swap. So 8% वो उसका price है, price of the swap. Correct? So every year, 100 million into 8, how much do I have to pay? Pay 8, pay 8, and pay 8. Every year, I will receive something. Time 1, time 2, time 3. What will I receive? First year, I will receive the floating rate. Floating rate is how much? You know, for simplicity, let's ignore this MRR plus 1. Let's just keep it MRR. Tell me, in the first year, how much will I receive? In the first year, I will receive, bolo? 50. Not 15. In the first year, I will receive 10%. That's the trick. This is what you need to know for the exams. In the swap, on the floating side, we use 1 period earlier rate. Why? Because this product is referred to as an advance set product. Okay? And it's logical. It's like when you go to a bank today and you make an FD of 100 rupees and they tell you interest rate is 5%. You say, okay. After 1 year, you go, that time interest rate is 7%. Will you get 5% on your FD or 7%? 5%, which means the rate that existed a period before, right? So on time 1, when you're doing the settlement, you will use 10% interest rate. Then at time 2, which interest rate will you use? 15%. And at time 3, which interest rate will you use? 6. So I will pay 8, receive 10. Obviously netting hoga. That means I will receive, here I will receive 2. Pay 8, receive 15. That means I will receive 7. Pay 8, receive 6. That means I will have to pay 2. And what happens at the termination of the swap? Any cash flows? No. Why? Because we did not exchange the notional. That's it. That's how a swap works. So one party benefits when the rates go up, the other party benefits when the rates go down. Who's benefiting when the rates are going up? In front of you, no? Who's benefiting? Pair. Because pair is receiving floating. And who's benefiting when the rates are going down? Receiver. Because in the last sequence, the receiver is getting a cash flow of 2. I think you should take a break now. Look at your faces, poor kids. Huh? Take a small break. After the break, we have to learn a little bit about valuation of swaps, pricing and valuation of the swaps, and then we are good to go. कितना टाइम चाहिए आपको? Okay. 20 minutes.
दिसत नव्हतं.
हो अच्छा, आय एम सो सॉरी, आय डिडंट नो दॅट.
त्या लाईटवर
लाईटमुळे का अदरवाईज? अच्छा अच्छा, फक्त लाईटमुळे दिसत नव्हतं. ओके.
नहीं पका रहे लास्ट पुश डेरिवेटिव्स पहला टॉपिक होता है कवर होना बेटिंग वाला पॉइंट ये पीछे से लॉस हो गए तो कुछ तो क्या टाइप करके कैलकुलेट करके रैंडम नंबर आते थे ओके नहीं इसलिए अपना भूल गए मैं पढ़ चुकी थी
Pricing, price of a swap. Price of a swap is equal to that fixed rate in the agreement. It's a fairly complicated formula to do it. There is a good news for you. You know the formula already. The price of the swap is nothing but the concept of par rate will earned and fixed income crash course. Par rate formula is if there are 4 years, then 1 minus Z4 divided by plus 2 plus 3 plus 4. So this fixed rate in the agreement is not a random number. On the exam, in all likelihood, you might get something like this. 2 variations of the questions. They will give you discount factor, year, 1, 2, 3, 4. I'm going to make up some random numbers here. 0.9, 0.8, 0.7, and 0.6. They will ask you for a 4-year par rate. It's an annual reset swap. Annual reset means what? थोड़ा जोश चाहिए भाई, ऐसे नहीं चलेगा. Annual reset means reset once in a year. That means settlement once in a year. Very simple. Just take a total of this. So this is 17 is these. So please cross check. 1 minus 0.6 divided by 3. How much? That's the price of the swap. Discount factors is given, everything is given, life is easy. You should pray that you get a lot of questions like these. Simple formula, 1 minus last discount factor divided by total of all the discount factors. Easy? Okay. Second variation of this, there is a little trick here. Time, 0.25, 0.5, 0.751, discount factor. Okay, let's keep it same. What is your answer now? Same discount factors. So it will be 1 minus 0.6 divided by 3 multiplied by 4. Why? Because this formula gives you a rate per period. How is that per period determined? The delta between the time. So in the previous example, it was actually this number into 1. Because the delta between time was 1 year. But in this example, the delta between the time is how much? 0.25. So it's giving you 0.25 rate. That means quarterly rate. How do you convert that to a year? Multiply with 4. Ritesh, I've read your query. Can you thoda patience rakho bhai, main karunga. We haven't finished derivatives yet. I still need to do theory with you. If you're doing it, we'll do it properly. We'll do it nice. We should, right? Which means it doesn't matter how long it goes in the night. We want to do it perfectly. Okay. What if you get something like this? It's a 2-year swap, semi-annual reset. 0.9, 0.8, 0.7, 0.6 discount factors. Now what would be your answer? 1 minus 0.6 divided by 3 multiplied with. What is the distance between time period? 0.5 means half of the year. So multiplied with 2. That's it. That's how you price a swap. Is it okay? All right, so now the broader structure is built. Now we have to go and do some finer theory. 10 LMs. But we'll be fast. What's a derivative? We know. Of course, we should know what is an embedded derivative, which is what? Come on. Derivative embedded into some other product. So a callable bond, puttable bond, convertible bond, all these are embedded derivatives. Derivatives are typically liquid, and believe it or not, you should know this. Derivatives liquidity in most of the market is more than the spot market liquidity. Which means if you want to trade copper derivative is way more liquid than spot copper market. Okay? That is the reason why a lot of ETFs on commodities, now giving you a head start on the alternatives, a lot of ETF that you see on commodities, they're actually made of the future contracts, not the spot price. So if you go to the US and you say, oh, you know what, I want to play this whole copper theme, you would see that most of the ETFs on copper are actually capturing the future prices, not the spot prices. Why? Because futures are liquid compared to spot. This is just theory, so I'm going to skip through this. Different types of derivatives, OTC versus exchange traded, you know the logic here. This clearing process has this concept called novation. Okay, so that I would like to take a little minute and explain how novation works. There is a concept called bilateral trades. A bilateral trade is like this. There is a party A, there is a party B. They are trading with each other through an OTC derivative. Obviously, A is exposed to credit risk of B, B is exposed to credit risk of A. Now, let's assume there is one more counterparty C and D, they are also entering into a trade. After a while, all these four parties decide, you know what, makes no sense to trade directly with each other. We should have someone in the center who's going to act as an intermediary. That party in the center is referred to as CCP. So CCP is called centralized counterparty. How we have clearinghouse in the exchange, like in a exchange traded derivative, that's how we have CCP in a OTC derivative. What will happen now is that A will have a direct trade with CCP, CCP being the counterparty. So the old trade between A and B will be cancelled. This trade will be cancelled. Okay? And instead of that, a new trade will be built, a new agreement will be built where the counterparty of A is who? CCP. This process is called novation. Novation matlab naya banana. So let me naya banana. ऐसे होता है? नया बनाना. So you are cancelling out the old contracts, creating the new one. Process is called novation. Same will happen. C will have counterparty as CCP. Then your B will have a new contract with CCP. And D will have a new contract with CCP again. Have you understood this? Now, expect a question on the exam where they say, identify whether the contract is a commitment or contingent claim. So no, wherever you have a right and obligation both, it's a commitment. Whenever you have only a right or only an obligation, it's a contingent claim. So what is a commitment? A forward contract is a commitment. How about future? That's a commitment. How about swap? It's a commitment. But what would be a contingent claim? Options. How about CDS? Contingent claim. Why? Because how much I pay is contingent on default happening. Difference between forwards and futures we know. One point I missed, very important point actually I missed. The value of the forward contract, okay, at different point in time. At inception, the value of the contract is 0. During the life of the contract, the value of the forward contract is calculated using make a phone call method. We've learned the method, no? And at termination or maturity, value of the forward contract is the difference between the spot price and the forward price, or forward price or spot price, depending on whether you are long or short. I have a right to buy at 100, market price became 150, great, my profit is 50. Difference between spot and the forward price. Do you know the difference between cash settlement versus delivery? Cash settlement versus delivery. So, someone in my family, extended family, called me. They said, Utkarsh, everyone is talking about copper. So, this gentleman is working in copper related industry, and they're saying कि copper का price बढ़ने वाला है, so can I do some copper future? So I said, you can go on MCX, you can go to your Grow app, enable the commodities account. आपको करना है तो करो, वहाँ से कर सकते हो. So then he said, okay, but when the contract will mature, so will I have to go to Bombay to take that 30 kg of copper? Right? And that's a legitimate question. And I said, yes or no depends on what? How do you decide to settle your contract? if you decide that I want to do a delivery, which some people do actually, then what happens is that the raw material or whatever the underlying asset is, that's deposited into a warehouse. And what you get from the warehouse is you get a warehouse receipt. So you go to the warehouse, you give the warehouse receipt, you take physical delivery of your material, whatever. Some people do it, right? But it's not very popular. This is called as a delivery settlement. Okay? If you do a delivery trade on stock, then you get delivery of those shares. But in most of the cases, the popular settlement is cash settlement. Okay? Cash settlement simply means whatever is the difference, profit or loss, will pay you in cash. Know that all interest rate derivatives, okay, all interest rate derivatives are always cash settled because it's very difficult to, this what do you deliver, right? Then in the same way, all index based derivatives are cash settled. But not necessarily all commodity based derivatives are cash settled. At times, some commodity based derivatives you can also take delivery. So commodities can do either of the two. Okay. Open interest means what? Open interest means the number of derivative contracts which are open at any point of time. If you are doing a call option and if you write one call option, write means sell. See, for open interest to be created, someone needs to be creator of that option first. Creator means seller. Okay, so let's assume I am the seller, you guys are the buyers. I sold 5. You bought 5. What is the open interest? 5. What is the volume? 5. We don't count volume as 10. Volume is 5, no? Only one trade happened. Now, let's assume the 5 were purchased by Siddhi. She sold that to Siddesh. Siddesh? Huh. So Siddhi sold 5 contracts to Siddesh. What is the volume now? 10. Open interest 5. Open interest means kitne contracts zinda hai? 5 contracts only, no? Now Siddesh sold that to Ankit. Kya naam hai unka? Devam. So Siddesh sold that to Devam. What is the volume now? 15. But what is the open interest? 5. Because I have created only 5. Okay? So I am in a way the one who's on the short side determines what the open interest would be. Now Devam has those 5 contracts. If I go and buy 2 back from Devam. Now, I was the one who created originally. Now I took 2 back. So 2 are deleted now. So now open interest has become 3, but volume has become 17. Okay? Then tomorrow morning I came and I sold 10 more. Now open interest is 13. Now those 13 you kept on selling within yourself, open interest is not changing. Then if I go in the market and buy 6 back, then the open interest left is 7. That's how open interest works. So open interest is created by the short side when they are creating a contract and selling it in the market. Alright, this is the options flow chart we've already discussed. The seller of the option is also called writer of the option or creator of the option. All these terms we use interchangeably. This part we've already covered. Remember this? Probability of default and loss given default. Yesterday I told you, when I do PD into LGD, कल परसों ही क्या नाम है fixed income? हाँ. So when I do PD into LGD, it gives me what? Expected loss, which is an estimate of the spread, credit spread, right? Now, credit spread is nothing but the spread you pay on the CDS. I give you that example of Tata Motors in the synthetic CDO example towards the end. ऐसे ऐसे मत याद है कुछ? So 3% कुछ था उसमें, है ना? So same thing. So if they ask you to figure out what is the CDS spread, okay, there would be a PD in the question, LGD in the question, just multiply the two. If PD is 5%, LGD is 20%, 5% into 20%, 1% is the spread. That's it. Now derivative benefits, derivative risk, all of that stuff you can look up yourself. For most of the Indians, I don't think there are any benefits. You know? बेनिफिट्स वुड भी कि आसानी से डिवोर्स हो गए काफ़ी लोगों के. There's some technical stuff on hedge accounting, but again, probability of that being tested is very low, so I'm going to skip through that. Then, for something to be considered as an arbitrage, there are two conditions. Condition one, मैं अपने जेब से ₹1 भी नहीं लगाएगा. Absolutely zero capital. Condition two, I should make profit, but I don't want to take any risk. So no capital, no risk, but then also profit. That is called arbitrage. Replication we discussed. We in fact replicated a call option today using a combination of stock and bond. This part also we discussed, right? All the cost and all the benefits. So what you want to do is spot plus cost minus benefits, but all of them you want to take future value. Okay, there's one piece, very important actually, I missed. But there's something very interesting happening in the copper futures. It might have corrected today a little bit. What is happening in the copper future is, let us say that today the price of the copper is 100 rupees. Okay. If I want to get into a future contract with 1 month, 1 month means write an obligation to buy 1 month from today. That future, the immediate future, is actually trading at a crazy cost of, or it was trading sometime back at a crazy cost of 120 rupees. That means the future prices were significantly higher than the spot prices. If I were to go a 2 month or 3 month future contract, maybe this will be something like 135 or 140 rupees. So when you have a future prices like these, which are higher than the spot prices, so your graph kind of looks like this, right? Today it's 100, but if I want delivery after 1 month, then future is 120. If I want delivery after 3 months, the future is 135. This type of market is referred to as a contango market. क्या बोलते हैं? Contango, where the future price is higher than the spot price. Now, typically, if you think in the context of that formula, future price is equal to spot price plus cost minus benefit, right? If the future price is higher, that obviously means that your cost of holding the future is more than the benefit of holding the future. This is when markets go into contango. Conceptually, when the markets are in contango, and if you're long on the future, okay, which is, and I came across this because I was actually evaluating some ETFs in the US. And some of those copper ETFs, which I was considering building a trade on, but I decided not to. Some of those ETFs, what they do is they keep on buying future and keep on rolling them forward. Okay, so when you build a long future and when the markets are in contango, you would have a significant rollover cost. Okay, what is the rollover cost? See, today copper is 100. One option is I just buy copper and relax, right? I don't have to do anything. But then if I buy copper, then I have to figure out a way to store it, and it's a headache, right? So what I instead do is I take long future on 120. Within a month, my exposure will get over because the contract will mature. So what I'll do is at the end of that month, I will close this contract and take the next one. This is called rolling over. Abhi wala contract band, and then I will buy the next one. But imagine if the markets are in contango, right? Then the next future that I'm buying will also have a higher price. So every time I'm rolling over, I'm some sort of paying a higher price. So therefore, in contango market, if you go long, you have a very significant rollover cost. So in this market, strategically, if you want to capture that carry, you should be shorting the copper. Because just think about it, right? If this is the current situation, a smart guy, what will they do? They will buy copper today in spot market, sell copper in the future market 120 rupees, एक महीने में 20 रुपया कमाई आपका. Is it okay? So when the markets are in contango, strategically makes sense to short from a carry perspective, not from a spot. Because you short and suddenly copper went up, you'd book losses, right? But that delta between spot and future that you get to capture. Then, during COVID, what happened? And this might happen again. I think about a month ago, I did some basic research on oil. And I thought oil is one of the kind of a hated asset for last 3-4 years. No one has made money on oil. So maybe the cycle will revert in the 3-4 years. So I made a small position. But if you remember what happened to oil during COVID. What happened during COVID is that suddenly the oil consumption went down dramatically because India mein dekho sab raste khali the. So no petrol cost, so you don't need oil. But those oil companies, they can't stop production of oil just like that. Right? There's a very lengthy process to do it. So they kept on extracting the oil. And then barrels of oil, they're trying to store to a point where they don't have a place to store anymore. So there is a concept called on the sea en route oil, which is you put all your oil in those shipping containers, but wo bhi bhar gaye and no one is taking the delivery. So now it reached to a point where that storage of that oil became a headache. So for a brief period of time, and one of the rare examples in the world where oil prices actually became negative in the future market. Okay? So if you have a market like this, where something is available for 100 rupees and 1 month future is available for 80 rupees and a 3-month future is available for 60 rupees, here the graph will be like this. 100 rupees today and then 80 rupees and then 60 rupees. This type of market is referred to as backwardation. Okay? And how does the backwardation work? So that equation, spot plus cost minus benefits. Now the future price is lower, that means benefits has to be higher than the cost. So that's when you would enter into a backwardation market. Okay, this thing we've already done, make a phone call and all those things. Okay. Some very basic discussion on the concept of FRAs. FRA stands for Forward Rate Agreement. What is this? This is a simple forward contract. What is the underlying asset? On interest rate, or you can think of it as loan. Okay, if you think of it as loan, it's a little easier for you to think. Now, in a FRA, there are two parties. Long, short. Long means I have a right and obligation to borrow. So buy, borrow. Aasan ho jayega, yaad rakhna. And short means right and obligation to lend. Opposite direction. So when you're building a long FRA, how do you profit? You profit when? Bolo? Interest rates goes up or goes down? So imagine you entered into an agreement that lets you borrow at 6%. Now would you prefer after you entered the agreement, the market rate go to 20% or 1%? 20, because you are borrowing at 6, right? So which means you profit when interest rates go up. Here you profit when interest rates have gone down. With me on this? Enjoying it? Now, we follow certain conventions with FRA. Okay, for example, you might see FRA which looks like, let's take some examples here itself. Let's say an FRA which looks like 1 into 3. Now, typically FRA is done for number of months. So 1 means 1 month, 3 means 3 months. It simply means I will borrow after 30 days, that 1. Okay? But for how many days? So you take the difference of the 2. 3 minus 1 is how much? 2. 2 means how many days? 60 days. So I will borrow for 60 days. But after how many days? 30 days. So where is that 3 coming from? 60 plus 30, 90. 90 means 3 months. So the second term is inclusive of the first term. That's called 1 into 3 FRA. Okay? So by that logic, what should be 2 into 5 FRA? After 60 days, but for how many days? 90 days. If I'm long, borrow. If I'm short, lend. What would be a 2 into 6 FRA? After 60 days for 120 days. 4 mahine means 120 days. Okay. Now, how do you create a synthetic FRA? A synthetic FRA. Let's say if I ask you to do a long 2 into 5 FRA synthetically, how can that be created? So, क्या सोचना है? If it's a 2 into 5 FRA, which means after how many days? 60 days. For how many days? For 90 days. And what do you want to do? Borrow or lend? Borrow. Okay? How do you create a synthetic structure? I'm giving you a trick. If you're listening, you'd never get these questions wrong, but I want you to listen to this carefully. 60 दिन के बाद 90 दिन का लोन लेना है. After 60 days, I want to take a loan for 90 days. What you do is today itself, you take a loan for the whole period, which is 150 days. Okay? By doing that, is this part taken care of? Yes. But were you required to take a loan here? No. But आपने ले लिया अभी, है ना? So what you do is whatever money you've got, just invest. So invest for 60 days. Automatically synthetic 2 by 5 is created. See, what was the end goal? आपकी शक्ल देखो क्या हो गया है. Are you absorbing? What's your name? नाम नहीं पीछे वाली. Disha. K. Krisha. Okay, Krisha. Did you understand this? Matlab? What does this mean? Okay, one more. Now Krisha will teach us. Krisha, how do you create a synthetic 2 into 5 long FRA? अच्छा चांस है, हेल्प कर दे. सामने वाला F&O ट्रेडर, वहाँ पे तो चला नहीं, इधर चल जाएगा, कोशिश कर. हाँ बोलो. 2 into 5 long FRA. हाँ after 60 days. After 60 days for 90 days. But to do what? Go on a vacation. No. After 60 days for 90 days, what do I do? Take a loan. Take a loan. So, after 60 days, you want to take a loan for 90 days. Now, Krisha, how do I create that synthetically? Nice. That +1 is helping you. Huh? Borrow for 150 days. So this borrowing is taken care of. And you don't need money here. So take that money and invest for 60 days. Okay, let's try one more. Let's say you want to create a synthetic 1 by 4 short FRA. synthetic 1 into 4 short FRA. How would we do it? वो green color problem कहाँ पे गया? हाँ, sir, what's your name? अर्जुन दिख रहा है आपको ये? शाबाश, तो बताओ कैसे? 1 into 4 short FRA. How will I do it? हाँ? क्या बोल रहा है? No, you explain me. So again, 1 into 4 short FR is what? After how many days? After 30 days. 90 days. What do we want to do? We want to invest or lend? Invest. Invest or lend, both. Same. So I want to invest. So what I will do is, I will actually invest for the whole period. Okay? So I will invest for 120 days. बट मेरे पास सब अब वापस कृषा वापस पूछूंगा आपको, ध्यान दो. आई विल इन्वेस्ट फॉर 120 days. But I don't have money to invest for 120 days. My plan was to do it after 30 days. So what will I do? Borrow for 30 days. This automatically creates that synthetic structure for you. Is that okay? Are you confident about this? Let's try then, Krisha. Krisha, please create a 5 into 2 synthetic long FRA for me. Let's put Krisha on screen. Yes, waiting for you, Krisha. उसको माइक दे दो. Where's the mic? Please pass on the mic. If you could also raise your hand so that you're visible on the camera. कुछ नहीं, थोड़ा नींद उठाने के लिए आपकी. हाँ, बोलो.
After 150 days.
After 150 days.
For 60 days.
For 60 days.
90.
For 90 days.
So it's 5 into 2.
5 into 2 long FRA does not exist. The second term will be larger than the first term. Okay, and last question. Now I'm kind of bored of this, but let's say a 1 into 5 synthetic short FRA. If any one of you can confidently give me the answer, give me hand raise. Who can give me 1 into 5 synthetic short FRA? Okay, let's go to her. Sorry, क्या नाम है आपका? प्राजक्ता. ऋतुजा, yes, ऋतुजा. 1 into 5 short FRA.
For 30 days.
So after 30 days.
After 30 days, for 120 days. 20 days.
120 days. What do I want to do?
For 120 days, you want to lend.
Oh, okay. Invest or lend?
Invest.
Correct. Right.
So you will invest for the whole 150 period.
Correct. Invest for whole 150 period.
And
but
borrow for the 30 days.
Borrow for 30 days. Fantastic. That's how you create synthetic structures. Good. I hope most of you got the logic right. Krisha, I'll check back with you again in some time. वो यॉर्निंग वाली लड़की गायब हो गई है पीछे से. वो है क्या अभी भी? हाँ, शी वेंट होम ना. अभी घर पे ऑन करेगी जाके. चलो यार. Okay, now the interest rate future and forwards actually work in the opposite way. remember what I told you, when I'm long on FRA, I'm hoping interest rates will go up. But in the future, it works the opposite way. An interest rate future contract, it works the opposite way because the underlying asset behaves differently. So if you're going to do an interest rate future, then you have to be short on the future. So short on the future is going to give you a long on FRA exposure. Okay? And here, long on the future is short on the FRA exposure. And that's primarily because underlying asset behaves a little bit like bond, and bond has an inverse relationship with interest. But for all practical purpose, as far as your exams is concerned, remember this, interest rate futures will behave in a different fashion. Okay. Now someone has been chasing me on the chat box for this point. Finally, we have reached here. It's testable, so I'll tell you what it is. It's basically depending on the correlation, okay, between the underlying asset and interest rate, your preference for forward or future will change. ठीक है? जैसे let's assume that your job is to you want to take a long position. You have two options. You have a forward position or you have a future position. Okay? Now, think of what happens in future. You have a long position, underlying asset goes up. If underlying asset goes up, will you receive money or pay money? Receive money. You will receive money. If you receive money, then you get to invest that money at an interest rate which has also gone up. How do I know interest rate has gone up? Because there is a positive correlation between the two. Okay, so here we are assuming a positive correlation between what? Between underlying asset and interest rate. Then obviously it benefits me because that margin money I get to invest at a higher rate. If underlying asset goes down, then what happens? Then I pay money. But luckily for me, that time interest rate has gone down. Which means in either case, if the correlation is positive, and if I'm trying to build a long position, I'm better off using futures than forwards. Because it gives me that right to invest margin at a higher price, but borrowing margin will happen at a lower price. If I am building a short position, okay, and if the correlation is positive or negative, so let's assume positive correlation. Now see what happens. Sorry, now we have to assume negative correlation. Now see what happens. If I build a future contract and underlying asset goes up, I receive money, but now this money I get to invest at a lower interest rate. And if underlying asset goes down, then I have to pay money or pay margin, but now my borrowing happens at a higher rate. So which means in this situation I should not prefer a future. Sorry, मैंने यहाँ पे long ही लिखना चाहिए था. Long. Underlying asset going up, I'm receiving money, but interest rates are going down. Underlying asset going down, I'm paying money, interest rates are going up. So what is the summary here? Summary is, we have this beautiful table for you in the juice notes. If it's a positive correlation and you're going to do long, then prefer futures. But if you're going to do shorts, then prefer forwards. If it's a negative correlation, you want to be long, then prefer forwards. And you want to be short, then prefer futures. You can build this entire table by yourself on the exam, and I'll tell you a very simple technique if this question comes up on the exam. I just want you to remember this part. Okay, this you can logically derive. Simple scenario, positive correlation. If I do future, underlying asset goes up, I receive money, invest at a better rate. underlying asset goes down, I pay money, I borrow at a better rate. Okay, which means positive correlation, I am building a long position. Recommendation here is future. Once you just figure out one value in this quadrant, everything else you can figure out easily. This has to be forward. This has to be forward. And this has to be future. That's it. So you should be able to rebuild the table by yourself. Okay, there's some technicality on convexity bias, but I don't think that's worth time in the crash course. That's the difference between your FRA versus an interest rate future. With this, I'm going to skip. Okay. Now, I'm covering theory on derivatives once. Swaps, typically interest rate swap. We have a payer side and we have a receiver side. Okay? Now, when does payer benefit? Payer benefits when interest rate. Payer benefits when the interest rates goes up. Receiver benefits when the interest rate goes down. Okay? So conceptually, think of this as a swap agreement. Now what you want to do is you want to replicate the swap. And you want to replicate which swap? You want to replicate pair swap. Using what? Using FRA. One swap agreement you can replicate by buying a series of FRAs. Okay, so maybe when I combine 2 or 3 FRAs together, they behave as if I have purchased the entire swap. And which FRA is that going to be? So think of which FRA benefits when the interest rate goes up. Long FRA, right? So a pair swap is equal to a series of long FRA combined together. Are you with me on this? Long FRA. And in the same way, if I have a receiver swap, okay, so this is my receiver swap. Receiver, this is a pair swap, receiver swap. This I want to replicate. Now, give me a hint. How will I do it? By building a series of short FRA. So when I combine multiple short FRAs together, okay, exactly how to do it, you don't have to worry about that at this level. But when I combine them together, it replicates a short receiver swap for me. All right. Quick question. If RFR goes up, front row, what happens to put option? If RFR goes up, what happens to put option? If RFR goes up, what happens? I think I'm going to do some jamming with you. नहीं सबके साथ ही अभी नहीं once I finish this. RFR goes up, what happens to put option? Goes down. If time to maturity is higher, what happens to put option? Goes up. Okay. Do you remember formula of risk neutral probability? 1 plus R minus D divided by U minus T. ठीक है. Then we've also learned how to build replicating portfolio, and congratulations. As we decided, 7 o'clock derivatives is over. 8 minutes later. Okay, sir. Can we turn on some lights here? We have some buttons. है काफी अंधेरा दिख रहा है आपके पास. आपके आसपास कोई बटन हो गया तो शुरू कर दो सब. नहीं पीछे वाले बंद है. I'm sure कुछ ना कुछ बंद है. हाँ तो बंद करो फिर, नहीं दिख रहा है तो बंद करो. आपको माहौल बना के बैठना ना. Have you ever gone to a movie so that you could get some good sleep? Have you done that? Have you gone to a movie for any purpose other than watching a movie? काफी लोगों का लेट बत्ती चला. I'm invested into a company. Those guys make lounger type of, chairs like in a movie hall, mostly in tier 2, tier 3 towns. My guess is a lot of their audience is not necessarily going to watch movies. Some folks are saying eating popcorn. माइक लेके डाउट करो.
In the US, there's like a platform called Kalshi now. Kalshi, have you heard of the? Even on Robinhood now, you can basically. It's almost like a bet, but it's like in the future. Say, for example, if there's like the Super Bowl, or who will become the president. Is that?
Oh, yeah.
Yeah. So there's a app now. It's called Kalshi. So
Yeah,
is
I've
that
heard of
also a
it.
derivative product, or what would you look at it as?
I don't know. That's a good question. I think those are called binary derivatives.
Right.
Who's going to be the president, X or Y?
Right.
Based on that, you get your payoff.
Correct.
We have similar binary derivatives in financial markets also.
Okay. So that's considered a derivative itself.
I would consider that a derivative because the underlying asset becomes a binary event.
Right.
Like how weather derivatives exist, same.
So uska price, you can see how many people are going to get. So you have like a momentum.
Even on Robinhood or prediction
Yeah.
market का वो आ गया.
हाँ.
How does it differentiate from betting on a match?
माइक यूज करके बोलो, जो भी बोलना है माइक में बोलो.
I saw this reel. It was like this person was betting on whether Trump, someone would say some word in his speeches in the next few months, and he did. So he made money. Like, how is this different from just plain betting?
There are also bets on every time Powell speaks. If he would start his speech by good morning or hello. Every time he says good morning, he is cutting it.
And people are actually making money on that.
What's the difference between speculation and then betting, pure betting? What's the difference?
See, if you're a gambler, okay, a sophisticated way of saying that to your friends is you can say, I am a market speculator. There are three uses of derivatives: speculation, hedging, and arbitrage. Three types of players, right? Speculators, hedgers, and arbitrages. So it's up to you how to use derivatives. Technically, derivative definition is anything that derives its value based on some underlying asset. So technically, what Trump says is not an asset, right? But then some folks have extended that definition. Now we have weather derivatives. Is weather a asset? I mean, I don't know, right? So I'm not sure if we could call them as derivatives or not in the traditional sense, but a lot of derivatives are structured like that, especially binary derivatives where there are knockout, knock-in options, binary options where it's like I'm betting on copper. If copper goes from 100 to 150, I get 20 rupees. If it falls, I lose 10 rupees. Right? A simple binary derivative, yes or no type of situation. All of these look like the same. ट्रम्प के लिए कौन सा वर्ड है वैसे? Which word does he use?
Misuse those words.
You misuse those words?
Miss those words.
You miss those words?
words.
Greek words.
Yeah, the ones you can't say
F. Funny words.
क्या मेरे को समझा नहीं क्या बोल रहा.
Sayable on camera.
Mic पे
अच्छा कर्स वर्ड है, मैं बोलना नहीं चाहिए ऐसे. हाँ. ठीक, तो नहीं बोल रहा हूँ ना मैं.
आप रुकिए.
हाँ जी. Do you want a break? Do you want to start?
No, wait for some time. कितना टाइम है?
Tell me, I'm just breaking the monotony. Tell me the most interesting place you've traveled to. One or two of you, whatever place you've traveled to where you found it was very interesting or you had an interesting experience. Bihar? Anyone wants to share their traveling experience? My experiences, I think I've already spoken some of them. 8 o'clock break, data transfer program. Someone is saying Vietnam. Koh Samui, kahan pe Koh Samui? Some island somewhere, right? Is it Thailand or Philippines? Thailand. Oh, it's that moon party place. Koh Samui is that full moon party place, right? Yeah, I've heard stories. Someone in the chat box says Hakkomi, Japan. I don't know what Hakkomi is famous for. Now, a lot of Indian students are attending, they're typing in Thailand, which... Sir, do you attach the handmade notes after the lecture? Yes, I do. I think I'll tell you my favorite place of travel. I've traveled a little bit here and there. But I'm a big fan of Himachal. And I think maybe last year or so I haven't traveled as frequently. I've been there only once, I guess. But I think every year I'll make at least 2 to 3 trips to Himachal. I love riding motorcycle in that region. I think it's a lot of fun. And Himachal has a lot of these small hidden villages where I think you still do not have mainstream tourism. But then there are no places to stay, so these are all day trip type of places. I also loved Sri Lanka when I was there a few years ago. Though I had a very crazy experience. I was in a group and they have this place called Adams Peak, which is like the tallest point and which is honestly just like Sinhagarh Trek types. Okay, maybe a little more than Sinhagarh Trek. But you have to go there. You have to start your trek at, I think, 12 or 1 in the night. 5 घंटे लगता है पहुँचने के लिए ऊपर, so that you get to see the sunrise, which I've heard is great. And I was in a group. And what happened is we had a Tamilian guide. Okay, and he couldn't speak much of English. So we started, and there were a few folks in the group, and one person asked, Andhera tha, there was a river flowing on one side. We honestly couldn't see much, and it was raining insane that night. So हम बारिश में ही चल रहे थे. I was probably the most motivated one कि ऊपर जाना, and I was hoping that by the time rains will subside, so I'll get to see the sunrise देखने को मिलेगा. And then I think someone in our group started speaking with the with the guide. उसको सवाल पूछा कि do you speak English? He was like, yes sir types. Huh? थोड़ा थोड़ा क्या? Then I think someone asked, are there any, I think, so this guy didn't know English, right? So whatever question he asked, I think he must have learned with experience कि ऐसे ऐसे करके कुछ हाँ. Someone asked, are there any animals here? So he was like, yes. And then someone asked कि यहाँ पे कोई, are there any tigers here? So he said yes again. It was interesting, and by the time I reached at the peak, it was 8:30 or 9 in the morning. और वो बारिश में इतना हालत ख़राब हो गया था, वो कपड़े, वो जैकेट उठ गया मेरा, so मैं जैकेट निकाल रहा था, टोपी निकल गया, सब निकल गया. It's beautiful place though. Sri Lanka is very interesting. Meghalaya is nice. I think India has such phenomenal places. Right? Every time I go to some part of India where I've not been to, I'm very surprised on how different our country is, right? South feels so different than North. And I think Northeast is a completely... Has anyone been to Northeast? Which place? Assam. Okay. Huh. Oh, you're from Northeast? Which place? Oh, you're from Darjeeling. Okay. Nice. क्या बोलते हैं उसको? चिकन नेक? Yes, sir. Chicken neck, है ना? Okay. I think we should take a break. 20 minutes break. Then we start with alternatives. I did ride once. I went from Pune to Himachal. जो पता नहीं कितना 1200 कुछ याद नहीं है, but it took me good time because मैं ऐसे रुक के जा रहा था. Most of the time I rent, but अभी मेरे दोस्त हैं काफ़ी वहाँ पे, so उनके बाइक्स वगैरह है तो वो उठा लेता हूँ. बट हाँ, रेंट भी करता हूँ काफ़ी बार. आपने चलाया बाइक? आप चलाते हो? अच्छा, यहाँ से गोवा. हाँ.
You're on my team. You must go.
I wanted to do a quick poll. Maybe this is a good time. How many of you think that the number of minutes or hours you listen to music on an average in a day or in a week? अरे रुको भाई. I really want to know this. There's something interesting I'm working on. Yes, it is with respect to Saregama, yes. How many of you think the number of minutes you're listening to music is going up? Give me up on the chat box or give me a hand raise. You're listening to more music than what you used to listen before. Okay. And how many of you think the number of minutes you listen to music is going down? Okay. It's a little, I'm a little surprised. Why is that happening? Why? Reels. So what time otherwise you would have spent on music, you're spending on the Instagram now?
I realized this yesterday only.
Anyone else can explain me why is it going down? Exam hai, huh? Today's songs are not. आप क्या दादी जी हो? Today's songs are not good. Vibe भी नहीं आता. Okay. Someone is saying it's going down because of this course. Okay. So, there is something which is really baffling me. You're right that the active music consumption is going down, right? It's basically कि चलो बैठ के एक घंटा गाने सुनते हैं ऐसे. I don't think people do that anymore. But my hypothesis always was that whenever you're doing something else, now music is so easily accessible. Like if you're working out or you're working in the kitchen, going for a run, you listen to music, right? ऐसे होता है ना? So, in general, the direction in which world is headed, what do you think people in the future will listen to more music or less music? Especially in India, I don't care about world, but it's more, less, or cannot say. More music.
Like the younger kids today, like in 11 or 12, they don't care about music as much as we do.
Really?
Yeah. सब पहले टीवी पे म्यूजिक चैनल्स आते थे. Exactly.
हाँ.
Major source of
हाँ माइक लेके बोलिए ना. हाँ टीवी पे जो म्यूजिक चैनल्स आते थे.
like recently VH1 got shut down.
Yeah.
That was like when I was in school, that was the only source I knew that I could listen to Hollywood music. The kids today don't have anything. They won't explore on their own, obviously.
But I was under the impression that the kids are probably a little more deeply rooted
Just
in.
listen to the songs that are on reels. That's
So it becomes difficult for you.
So they listen to the songs on reels but don't listen to music per se.
like their music
that's not
taste is confined to the music they listen to on reels. They are not expanding their taste.
I feel as if.
How old are you, by the way, when
you
you saying kids? Huh?
Trust me. People are in school and like
Achha.
colleges. Like I was better.
Your
Okay, you were saying something.
From user count perspective, right? There's the metric that you look at is daily average users and monthly average users for like an app like Spotify. So usually we calculate churn. So the churn rate is reducing. So whoever is actually signing up onto the app and paying for the app, you're not losing that customer, but the rate at which you're actually getting new customers signing on is now going down.
No, that's fine. I think what generally I was thinking directionally on whether people are listening to more music or less, because the normal hypothesis is people are spending time on reels. So I don't know if they're listening to more music, because I hope they're listening more because mera paisa laga hai, so. But I'll tell you what's baffling, and I don't have a lot of time today. So, but I'll still love to do this case study with you before I take you to alternatives. It will take 5 minutes. and it should be fun. I am really, last night, I was running AI on this question, trying to find some solution. And I spoke to someone in the morning today also, asking them, boss, what do you think about what's happening? Okay, so we have two folks here. We have Saregama and we have Tips Music. Okay. Now, their accounting practice is very different. It's a technical case study. सुनना है क्या आपको? या नहीं? Okay. Their accounting practice is very, very different. Tips, whatever money they spend on acquiring new songs, they expense it out right away. So जो भी पैसा नए गाने के लिए खर्च किया, right? Whatever money you spend, nothing goes to balance sheet, everything goes to P&L expensed out. Whereas Saregama capitalizes the money they have spent on new songs, and then they amortize it typically over a period of 10 years. Now, classic CFA level 1 FRA exam question. One party is expensing, other party is capitalizing. The party that's expensing, their profit should be higher or lower? Their profit should be lower. But Tips profit are not lower. In fact, Tips profitability is double that of Saregama, which is really baffling. Okay, so if you look at the P&L differences between the two, I think we'll do that comparison here. Okay, this is the comparative metric, Tips and Saregama. I want you to just look at the operating profit margin, and that should blow away your mind. Look at Tips from 2021. 60, 64, 55, 65, 67, whereas Saregama is in the range of about 25 to 30s. So how is it possible that Tips is expensing everything in the first year, but then also the margins are higher, whereas Saregama is capitalizing, then also margins are lower. So I was doing some work on it last night. One of the things I found with Tips, it's a very interesting what's happening to Tips. So beach mein, I think 2 decades, the 2000s and 2010, 1990 to 2000, 2000 to 2010, Saregama had given up on this market. So Saregama was not buying any music. And but Tips was buying music, and some of the Tips music looks like is extremely popular with certain segment of population. I don't know which one, but I looked at which songs, and some of the popular, I'll show you, famous songs owned by Tips. दिल है तुम्हारा, रेस, अजब प्रेम की गजब कहानी. Do you listen to these songs? Yes? अच्छा, okay. मैं सोच रहा था सिर्फ रिक्शा वाले वगैरह सुन रहे नहीं. अच्छा, I'm sorry. I'm really sorry. In my head I was thinking पहली नज़र में छम्मा छम्मा, बे-इम्तिहान, sorry, जीने लगा हूँ. Okay, anyways. So my guess is maybe this legacy portfolio that they had, जो पुराने गाने खरीदे थे, that's actually making them 200 odd crores a year. Okay, just the old songs. If they decide that, look at the revenue, sales, Tips is doing about 300 crore last year, right? 250 previous year. I think it's mostly the old songs that's getting them the revenue. And even if they decide not to acquire new music, till the time these songs are popular, they will keep on making this revenue with some level of growth. right? And what they're doing now is they're taking a little bit of money out of it and very minimum, like 30, 40, 50 crores, and then acquiring new music on that. So either it means Tips is a spectacularly smart company in acquiring music, and therefore they have such kick-ass profitability. Or maybe they're kind of eating away their assets slowly, and because they're not acquiring new music, maybe 5 years, 10 years out, the business longevity will be lower, right? Either of the two interpretation. Whereas Saregama spends crazy amount of money. If you look at, it's really baffling if you see the valuation of the two companies is exactly the same today, 6,900 and 6,350. But if you just look at the sales number, 350 crores and 1160 crores, right? There's a massive difference in sales compared to what valuations they have, primarily because of the margins. Tips has double the margin of Saregama, so market is willing to give it a much more higher valuation. So this is a thinking exercise. I don't have an answer to it yet, but I would like to dig a little bit more on what's really happening. If I find the answer, I'll tell you. Right now, I'm very happy with Saregama, and all the more happier since the price have corrected, because then that means you can buy a little bit more. Is Tips undervalued? No. Tips, in my opinion, if I look at Tips as a pure growing annuity product, एक asset है, it's like real estate. Every year you get rent. They have songs. Every year they get revenue, but growing annuity, growing at 6-7%. So I ran some number on Tips. I feel the stock is worth about half of what it is now. I don't think it's worth 500 rupees. It's probably on a DCF basis, it's worth 300 rupees. Saregama, maybe now Saregama is more complex to value because there are too many moving pieces, right? I mean, these folks keep on doing anything. They'll get into YouTube business. They have this very famous channel. Which kids listen to these or it's called Filter Copy. Has anyone? Do you know Filter Copy? How many of you know Filter Copy? Okay, I'm surprised so many of you know it. Is it famous now or is it COVID mein? It's not famous now. How many of you like this channel now? No. How many of you like them back in the day? Okay, that's not a good sign. Yeah, so they have Filter Copy, which is they do this. And now recently they partnered with Bhansali production, and I've never understood his movies. Sanjay Leela Bhansali, right? But they've partnered with him, yeah, those grand movies and all of it. So Saregama is kind of, and Saregama now has built a very kick-ass business on your events. So वो जो टोपी वाला हिमेश रेशमिया, he's doing that thing these days, right? The concert or shows that's arranged by Saregama. फिर I think दिलजीत या अरिजीत कोई एक singer है, they've done show with them. So that's your event business. So we'll have to see how it works. Anyways, alternatives. Are you excited? Are you Are you excited? Okay. It's not that big actually. If you give me your 100%, we'll finish it in 2 hours. It's just 50 pages in the juice notes, and many of them are flowcharts and random theory, so we should be able to finish fast. And I'll tell you some stories to help you memorize stuff here and there. Okay, so if all of you are ready, start. This session I'm going to do purely from the juice notes. All right, here we go. So first, general, why do you need alternative investments? You need alternative investments for, do you know who made alternative investments popular? The fund manager, huh? क्या? Bill Ackman? No. The fund manager for Yale endowment. ठीक है, उनका नाम शायद Swenson या ऐसे कुछ था. I forgot their name. Forgot his name. So he built a model which was called Yale model. Okay, it was an endowment fund. Do you know what endowment funds are? They're run by the universities. Now, the idea of an endowment fund is, imagine now if tomorrow FinTree becomes a university. Okay, which by the way is our vision. That's the direction in which we want to build India's best finance college. So let's assume tomorrow if FinTree becomes a university, and some of you leave some wealth for us, right? Which again in India is not very common. But in the US, it's a fairly common concept to give something back to the education university. Now, that money would be used for the current generation of students and future forever. So an endowment fund has a lifetime time horizon. You don't want to make money in the quick short term. And generally we say in finance, you should always play by your strength, right? Which means whatever you're good at, you leverage on that. So what this gentleman thought, he thought that if my strength is a long time horizon, then why should I invest into liquid assets? Let me go and invest into illiquid asset. Generally, if there are two assets which are exactly same risk return profile, except that one of them is liquid, other one is illiquid, illiquidity premium is in the range of 1.5 to 2.5% per annum. Which means illiquid asset खरीदने से 1 से 2% ज़्यादा कमाई होना चाहिए. You should make 1 to 2% more. So then he designed a portfolio which is very different than conventional wisdom, where 70-80% would be deployed to alternatives and 10-20% would be deployed to traditional. So they were the ones who bought large volume of real estate, timberland, farmlands, your private equity funds. And the fund did reasonably well, and that's how it became a Yale model. Have you understood this? So that's the whole idea of alternatives. Alternatives are gaining popularity in India. They're gaining massive fantastic career revenue for all of you. Just look at the SEBI data, it will show you. This industry is growing at about 35 to 40% per annum. In the last it started in 2014 in India, so about 11 years. What areas within alternative? So obviously the most popular area is real estate. Okay, real estate, you have commercial, you have residential, but you can also play through REITs, real estate investment trust. What's India launching now is something called as a micro REITs. Okay, that's will start coming in very aggressively. What is a micro REIT? It's a fantastic business opportunity. If there is a standalone building, let's say with 20-30 floors, let's say valuation is 70-80 crore rupees. Now you can actually get that building's REIT listed. That means you can raise 30-40 crores from the market, and whatever rent you get from that building, you pass it on to your REIT investors. So once these micro REITs come and flood the market, imagine in your city, if there's a building or a mall which you feel is always crowded, very populated, you can actually go search if there's a REIT available, right, and go and purchase, because then you get an exposure to one specific asset. So that's the whole REIT market. In India, we also have a parallel InvITs market, and infrastructure is also a beautiful asset. Okay, so look at Adani, what he's doing. Adani is doing compared to what Ambani is doing, right? Ambani is basically, in the last few years after Jio, the focus has been a lot more on retail. The thing is, retail is not a longevity business. दुकान कभी भी बंद हो सकता है, brand कभी भी खराब हो सकता है. But infra is a fantastic business. Telecom is an infra business, right? Then, what Adani has been doing is Adani ports have been going and buying airports in India left and right. Now they own some 10-11 airports. The new Bombay airport is Adani airport. Now airport is a phenomenal business. Because once you build and once you know that this airport is going to work, then you make money through a lot of sources, right? Parking ka bhi paisa lo, then you charge rental to all the restaurants. Now Adani is running many of those restaurants themselves. Then obviously every time a flight lands or takes off, there is a, if you ever you purchase a air ticket, read the components carefully, there would be a passenger fee or an airport fee component there. That money is directly going to the airport, right? So those are your infrastructure assets. Then we have what? Private equities, right? Private equity in India is not that dominant yet, but obviously as the markets become more and more mature, we'll have more and more private equity happening. Some people think VC and private equity is same. Okay, and I just had someone in my neighbor actually, his son wanted to study CFA. And I didn't know, so I just bumped into my neighbor here. The kid said that I want to work in private equity. And I said, great, but I told him, as you learn more and more finance, you discover what you really want. Private equity is very different than venture capital. If you work in private equity for most part of the time, you're actually sitting on a computer and just crunching numbers. Whereas in venture capital, if you work with a VC fund, 90% of the time you're actually talking to startups, right? So the nature of the profile, the type of companies you invest in is very, very different in private equity and venture capital. Private equity, you invest in large, mature companies, whereas VCs, you invest in startups. Then obviously after this, we have hedge funds, right? In India, we have hedge funds brother, we call them as AIFs, Alternative Investment Fund. And then you have some commodities. Now obviously, today is the time of commodities, right? So everything is rallying, gold, aluminium, copper, silver. So those are one asset classes. And this is largely and then there are exotics also here. So exotics is some people invest in watches, which I think is a really stupid thing to do. Because it's like a lot of people justify buying an expensive watch because they feel it's an investment. It's a highly cyclical asset class where it does really well for some time and then does really, really bad for some time.
Every month the prices of watches.
We'll debate on that. If you want to debate on watch, we'll do it. Another exotic asset class would be a lot of women would purchase those Birkins, right? It's like some 50, 70. And then people will purchase those LV wale, they will purchase those LV bags and this brand, that brand, thinking valuation. Some people invest in wine. Okay. Exotic whiskies. Kya? Wine barrels? As in you buy the whole barrel with wine, right? Or just the barrel? No, wine barrels, okay. Yeah, so variety of different exotics, all of them fall into alternatives. In general, why do you want alternative? You want high return, diversification, but they are illiquid. You want to invest in alternative, you have to have access to very skilled talent. Once one of our students, he taught me how he was trading on certain category of numismatics. Numismatics are coins. He was doing that specialty coins launched by football clubs in Europe. Okay, so he had deep expertise where he explained me how he was doing an arbitrage where buying somewhere cheaper and selling somewhere expensive. So you have to be expert in that particular domain. Then very complex comm structures to the fund manager, right? Less transparency, less regulation. Then whether your fund manager has done good or bad, very difficult to say. In equity, your fund manager is not doing good, you compare with benchmark. With what do you do that with a hedge fund? Right? Can you compare with Nifty? No, not necessary. Then most of the fund managers will take money through incentives And obviously, investment structures are not your typical mutual fund. They are typically partnerships. Then we go to private company or private equity. I told you before, which is, now I'll show you some private equity deals so you'll understand. Some of the ones I know, right? One is I was invested in this company for a long period of time. It was a multi-bagger. Now it's called Cohance. Okay, earlier this company was called Suven. And then Suven was split into two parts. So now the current Suven is a smaller Suven. This was taken over by a private equity firm. Look at the size of this firm. How much is that? 14,000 crores. The most recent deal that I studied, or a deal in the pipeline, was this one. All of you know this company. Which one? VIP Industries, right? These guys are the legacy largest your travel VIP bag suna hai na apne? Haan. So this company, but the promoter, if you look at the performance of this company, it was a sleepy dead company of sorts. Look at this. The promoter was not really motivated to do much. Okay, and promoters made good money. I mean, in India, you make 200-300 crores, you're living a good life. Promoters made good money, their children were not interested. So, apna kaam chala rahe the. They made some wrong investment. They invested into soft luggage. Soft luggage means, jo suitcase hota na kapde wala. But right now the trend is hard luggage, right? People want those polymer suitcases. So then a private equity guy will come. They will buy such a large company, and then they will have a time period of 7 to 10 years. Usme us company ko revive karna hai, you have to put energy. So private equity is not about talking to a startup or too many startups. It's about, one, crunching the numbers. Second, maybe you're on the part of the execution team. So you're an operator in a private equity company. So some CEO, some specialist, turnaround specialist will be put on board of this company. Then that person would be responsible for turning around the business, getting the growth momentum back so that you increase the valuation and then sell the company after a few years. That's the private equity business. Most of the private equity deals in the US happen through something called as a LBO structure, leverage buyout. In India, legally, this was not allowed due to banking regulations until 6 months ago, but now the regulations have changed. This is called acquisition financing, where a bank can lend money to you to acquire some company. This was not allowed earlier by RBI, but now they do, which means we are expecting a lot more LBO deals to happen in India going forward. Do you understand LBO? I will take a loan to buy a company, right? Very broadly, that's how it works. Whereas VC is a very different ball game. When you are buying a private equity deal, you want a profitable large company. But when you're buying a VC company, you don't want a large company. You want a small company, but with a very, very large TAM. Right? So the way a venture capitalist thinks is that I'm investing into 100 companies. It's okay if 90 of them fail. I don't care. So you would take very, very high risk bets, right? So, but the 10 that survive, I want them to become 50x, 100x, 200x type of potential. So that's how a VC business, that's how a VC guy thinks. So therefore a VC guy will not invest into a small, profitable but not scalable business like consulting. Highly profitable business but not scalable. A VC will invest into something which is generally revolving around revolutionary tech. Okay, so VC is all about tech investing. So if you're someone who's very deep into tech, whatever tech it is, right? It could be fintech, biotech, health tech, med tech. If you're someone in tech, then VC is the game for you. All right, then private debt, which is again picking up venture debt. Instead of giving venture equity, you give venture debt, or distressed debt means jo company trouble mein hai, you buy their debt. These are your real assets. Real assets is commercial, residential, REITs. Infrastructure, Public use, provide essential services, roads, bridges, highways, all of those. Natural resources, you buy farmland and timberland. Do we have farmlands in India? Do we have timberlands in India? Actually, I recently saw one. I was traveling in the Chennai region, and there I saw they had conical trees. Okay, in South India, I was surprised because conifer trees, right? You see them in the snow region. So then I asked the driver, and we used ChatGPT to translate our languages. But I found out there's a particular species of plant that they do there, जो ऐसे पतली वाली लकड़ी बनाता है, right? Not very thick wood. That wood is used as a alternate for bamboo, right? And acres and acres of land I could see on both sides of the highway having planted that kind of a tree. That is your timberland. But of course, India is not a timberland country per se. The biggest reserves of timberland in the world: US, Canada, Australia, New Zealand, right? These places, and Eastern Europe. Then commodities, this is what you'd hear: commodities does not generate cash flows. We say commodities are not yielding assets. Why do you want to do commodities? Because they typically have inflation protection built into them. Then you can do collectibles, art, wine, rare coins, or you can also do patents, right? Some folks only specialize in buying patents. They do that. So there are some certain funds focused only on acquiring patents. And then of lately, of course, we have digital assets. I heard story of some, I think two stories I heard. One is the New York mayor. He created some, no, not the recent one, I think the old mayor. He created some digital token or something and sold it on his, he started selling it. The New York mayor. He sold some, kya naam hai? The new one or the old one? I think the old one did this, right? So, and he sold these tokens, and while he was streaming live, apparently he sold, when the token value went up some crazy multiples of the initial value, while he was streaming live, he sold some of them. Then another 19-year-old kid, I heard this story, my brother was telling me. What he did is, he did a live stream, he created his own token. Okay, and apparently some popular gamer or something. And while he was streaming, he started selling those tokens, which went multifold. And then while streaming itself, he sold all his tokens, right? And obviously his fans bought it because he was proposing them. And then he said something like, feel sorry for you suckers or something, and ended the stream. But those are your digital assets. Of course, we have bitcoins and whatnot here. Then we have hedge funds. Okay, this is your first testable point called co-investing. Okay, co-investing is generally popular in the VC world, not so popular otherwise. Okay, how does co-investing work? See, think of this as a great startup. Okay. Now, this is a venture capital fund. This is an investor in the venture capital fund. He's one of the many investors. Now, this investor has given money to venture capital fund. VC fund is going to put that money into startup. Now, this is your usual structure. Now, if the startup makes money and if startup becomes a great investment, then whatever profits that will come, about 20% of those profits will be taken by whom? The VC fund manager. Usko kehte hai GP. GP is general partner. And investor is called limited partner. But then, once in a while, the VC fund manager will request this LP. He'll say, listen, the company I'm investing in, that is a very deep tech company in, let's say, some med tech space. Okay, so it's doing some research on med tech space, and I know that you run a company in med tech, so you're an expert in med tech. So why don't you advise us on the deal? And what I'll give you an option is that some part of the money you can invest directly into the startup. I'll give you a co-investing option. Now, what is the benefit of co-investing option? The benefit of co-investing option is that when you sell the startup and then the profit that you make, on that profit, you don't have to pay GP a 20% share. Then the entire profit you get to keep with yourself. Correct? So the idea is that venture capital fund manager or GP will do all the hard work. They will initiate the deal. They will do the due diligence. But if they give you an offer of co-investing, at least the money that you co-invest here, on that money you don't have to do profit sharing. That's called co-investing. Have you understood this? Okay. Then we know that AIs are typically structured as partnerships. Fund manager is GP and investors are LPs. Yeah, this for a theory question you might want to know this. There's a concept called side letters. Okay. What is a side letter? Imagine I have 10 investors. Now with all the 10 investors, I want to have equal terms. So I will sign 10 agreements with each one of them. They have to look same. But one of the investor is a special one. मतलब वो मेरा close है. So I want to give that investor some extra rights. So with that investor, I will prepare one more agreement, which will be called as a side letter. In that agreement, I'll give them certain rights. Okay. Typically, this is a very useful right. This is called the first right to refuse. Right to refuse means if I am selling something, I will give you first option that hey, I am selling for 100 rupees. Do you want to buy? You have a right to refuse. If you refuse, then only I will go and sell someone else. Understood? So these are some of the side letter terms. Then hurdle rates. Let's do some work, calculations on hurdle rates now. Hurdle rates is what? Now, I'm giving you more perspective from a hedge fund perspective. Private equity is slightly different. We'll go there when we go to that trading. There are two types of hurdles. There's a soft hurdle and then there is a hard hurdle. Now, what do you mean by hurdle rate? Let us say that, who is this? A fund manager. Now, fund manager collects 100 rupees from an investor. Fund manager says, listen, I will apply a 2/20 structure. I will charge you 2% management fee, 20% incentive or profit sharing. Okay. Now imagine I launch a fund and I somehow convince all of you to invest into my fund, a 2/20 structure. And what I do is I take all your money and go and not even put effort, just go and make FD in ICICI Bank. Now, every year I will earn 7%. Right? Out of that 7%, I will take how much? 20%. So 1.4 free of cost for not doing anything. So obviously, it's a crime to have a profit sharing, but not have a minimum return threshold. So you will tell me, Utkarsh, aisa nahi chalega. You have to earn us minimum of 10% per annum. Then only we will pay you incentive, otherwise we will not pay you incentive. So I said, okay, fine. Let's keep a hurdle of 10%. Okay. Now, this year, I converted your 100 rupees into, let's say, 115. Now, I'll come to you and I'll say, listen, see, I have crossed the hurdle. how much profit I made? 15 rupees. Please give me 3 rupees as incentive. You would say, okay, no problem, take your 3 rupees. But if it is a hard hurdle, and if I tell you, listen, I made 100 rupees is 115, you will say, Utkarsh, I will pay you incentive only on excess over and above 110. Because up to 10 was anyways hurdle. So over and above hurdle, how much profit have you made? 5 rupees. So you will get incentive only on 5 rupees, which is 1. That's how hard hurdles work. So in a soft hurdle, you pay incentive on the entire profit, whereas but the condition is you should cross the hurdle. In a hard hurdle, you pay incentive only on incremental profit. Now, Warren Buffett, when he started his partnership, he popularized this model, 0-6-25. So when Warren Buffett got into this business of asset management, he said, I will charge 0% management fee, 6% hurdle. But once I cross the hurdle, then whatever profit I make, on top of it, I will take how much? 25%. Crazy 25%. Now, there's a gentleman who's famous on the internet and in the world because he just copies whatever Warren Buffett does blindly. Okay, he calls it as the shameless imitation. I will just copy what he does because he is successful. And this investor has been also very successful. His name is Mohnish Pabrai. He's also a hedge fund manager. What is his achievement in life? He's copied Warren Buffett. So when he launched his fund, he just replicated 0-6-25. And just last week I learned that one of the famous legendary investor of India, when he launched his PMS, he also copy-pasted the same model. You'll not believe who, but all of you know his name today. Parag Parikh. Have you heard of Parag Parikh Mutual Fund? So Parag Parikh passed away a few years ago. In fact, when he was going to Berkshire meeting, there was an accident where he passed away. But when Parag Parikh launched his PMS in India, back in the day, they also copied the same model. Nevertheless, I hope you've understood this structure. Okay, let's look at this example. If a fund earns 18% over period and receives performance of 20%, in excess of the hurdle rate of 8%. So hurdle is 8, you have earned 18% and incentive is 20. So how much incentive will you pay? 18 minus 8 into 20%. How much is that? 2%. Okay. Then there is a clause called the catch-up clause in the private equity world. I will have to do an example of catch-up clause with you. Okay, I think we'll keep this on hold. Catch-up, we'll do all of that together in one go when we do the waterfall structure. I think it will come in the next reading. Next concept is called high watermark. This is also important. How does high watermark work? Imagine your fund is 100 rupees. Okay? From 100 rupees, it went to 120 rupees. Your fund manager will come. He will say, hey, you have to pay me incentive. How much is the profit? 20 rupees. Let's ignore hurdles. You please pay me 20 rupees into 20%, 4 rupees. You said, okay, fine. Then 120 rupees became 150 rupees. How much is the profit? 30 rupees. So fund manager will come. He will say 30 into 20%. How much? 6 rupees. Now what happens is 150 rupees becomes 90 rupees. Now the fund manager will not come. He'll probably also not call you. You will call the fund manager. He will say, don't worry. At least good news for you is this year I will not take any incentive from you. I said, okay. Now next year, 90 rupees became 130. Now fund manager proudly called you. He said, I told you. Now please pay me incentive on 40 rupees into 20%. Will you pay? No. Why? He'll say, oh, same profit में कितने बार लेगा? है ना? Because I started with 100 rupees when it went up to 150, I've already paid you incentive. So I will not pay you incentive again till the time you don't cross 150. That is my high water mark. Only when your fund will exceed 150, let's say it goes to 190 now, next year, then I will pay you profit on that differential of 40, because 150 high water mark is set. That is how high water mark conceptually works. Now what you need to know for the exam is high water mark is actually calculated on the fund value minus all the fees that you've paid. So the true high water mark is not 120 rupees, because if I'm paying 4 rupees here, then true high water mark is 116. Okay, so high water mark is not just the fund value, it is fund value minus the appropriate fees from an exam perspective. Okay. Then a clawback provision. Does anyone know what a clawback provision is? Yeah, so typically in a private equity deal by deal structure, sun lo. Let's say this is a private equity fund and there are 4 companies in the portfolio, each worth 100 rupees. Okay. The fund manager sold first company from 100 rupees to 120 rupees. How much is the profit? 20 rupees. Fund manager came and said, hey listen, 20 into 20%, give me an incentive of 4. You said, okay, first company is gone. The fund manager now sold the second company, 100 into 130. How much is the profit? 30 rupees into 20%, fund manager took incentive of 6. Then third company, 100 into 110, 10 into 20%, 2. Now the fourth company, 100 rupees, he sold for let's say 10 rupees. Okay. So now what you would say is, you would say that something looks off because I invested 400 rupees with you. And what's the total now? 250, 360, 370. On net basis, मेरा तो loss हो रहा है. But you've already taken commission from me or incentive. So after the conclusion of the last deal, you will go to the fund manager, you will open the agreement, you will show him the provision or her the provision, clawback. And you would say, everything that you've taken so far, please return. So now the fund manager will give you those 12 rupees back because the incentive would be clawed back, taken back. This is called as a clawback provision. Yes or no? Yes. Easy? Okay, what's a waterfall structure? There are 2 types of waterfall structures now. We'll do this in the subsequent reading. There's a deal by deal American structure or whole of a fund, European structure. Okay. So after every deal, if I'm sharing the money with GP and LP, that's called as a deal by deal structure. If after every deal, I'm sharing money with only LPs, not giving any money to GP. And GP will get money only when the whole LP capital is returned, then that's referred to as a European structure. So if you're a GP, a better structure for you is American, deal by deal, because after every deal you get little bit of money. But if you're an investor, a better structure for you is LP, because GP does not get any money till, till the whole capital is not returned. Samjhe? Let's do an example on this so that you would also understand the catch-up clause also. This is slightly technical example. I need you to be alert. 10 minutes mein samajh jayega. So we are learning the waterfall structure. I told you in the fixed income class, anything where money is shared step by step to different people, we call it as a waterfall structure. We have 2 structures. We have a American structure. We have a European structure. Okay. We are going to create a portfolio. In our portfolio, we are going to have, let's say, 3 companies. Each company we are going to have worth 100 rupees. Okay, so total investment or committed capital in the business is 300. We are going to replicate exactly the same example in European, so you can compare the difference. 300 rupees of capital invested into 3 different companies. Let's see what's happening in European. In year 6, the first company is sold. 100 rupees company is sold at, let's say, valuation of 150. Okay. So your job is to distribute that cash of 150 rupees. Under American structure, the cash would be given to 2 parties. Some cash will be given to LP, some cash will be given to GP. How much will GP get? So what is the profit here? 50 rupees. Let's assume a 20% sharing. I'm ignoring management fee. So GP will get how much? 10. Okay. LP will get how much? LP will get 140. So जो 150 रुपए आए, 140 will give to LP, 10 rupees will give to GP. Let's look at the second year. Year, let's say 7 now. One more deal. 100 rupees of company now sold at 200 rupees. In fact, 200 भी ज़्यादा करता है. Let's say 300 rupees. Okay, crazy profit. Again, some part of it you will give to LP, some part of it you would give to GP. First we figure out how much to give to GP. So what is the profit here? 200. 200 into 20%, how much? 40. So GP will receive 40. But out of 300, if 40 is given to GP, how much LP receives? 260. 300 रुपए आया ना? थक गया, कॉफी मंगाओ तेरे लिए? नहीं. वाह. 260. Are you with me? Now, year 9, okay, maybe the last final deal. 100 rupees we exited at a price of, let's say, the best deal ever, 5x. Again, we distribute between the 2 parties. We distribute between LPs and GPs. How much LP will get? How much GP will get? So 400 into 20%, 80. 422 LP. That's it. This is called American, this is called a deal by deal structure. Have you understood this one? Yes. Okay. But the same deal flow, but in European, the maths will look very different. And this is what I want you to learn. So I hope you're with me. Now listen to it carefully. In year 6, when that 100 rupee company is sold to 150, okay, what will happen is, entire 150 is given to LP and 0 is given to GP. So what is the logic in European? You would keep on giving money to LP first till the time you don't repay the whole capital. Okay? Now, year 7 is where the maths is going to get super interesting. I need all of you to be alert now and listening. I want you to get the hold of it. This is where, in year 7, the catch-up clause will come into play. Okay, so if you want to learn what catch-up is, you'll understand now. This 100 rupee is sold at what price? 300. Okay, so how to distribute this 300? This 300 would be distributed in a European waterfall structure. Step 1, out of 300, first, without thinking, 150 we will give to LP. So last year, in the year 6, you gave to LP how much? 150. Now out of this 300, 150 you gave to LP. So whatever capital you had taken from LP, you've been able to return that. Okay. Now finally the fund manager will say that let me do my catch up now. Catch up means all this while whatever was my share, right, I was letting it go. So now let me capture the whole share. Alright, samajh mein? How much is my catch up share now? So in the first deal, how much money you had made as a GP? 10. But was it paid to you? No. In the second deal, how much money as a GP you are going to make? 40. Has it been paid to you? No. So now GP will say, please give me incentive up to 50. Okay. Then, once the incentive of the second deal is paid, then whatever is money left, how much is money left? 100. So this 100 I will give to LP. So what you're doing is you're catching up. First, you paid 150 to LP. Then abhi tak jitna bhi profit aapka due tha, because now the capital is returned. Now the first priority is GP. Whatever capital was due, pay that to GP. Then whatever is left, you give that to LP. Finally, what will happen in year 8 now? Once the capital is returned, then you become an American waterfall. Right? So in year 8, what's happening is 100 becoming 500. So simple distribution. LP and GP in their respective sharing ratio. So GP will get 80, LP will get 420. After this, the sharing will be same. So it's only to the point LP does not receive capital, LP gets the whole of it. Once LP has recovered the whole of it, then GP will say, let me catch up. Let me collect whatever is due to me in one go. Tab tak LP ko nahi denge. Now priority is GP after the catch-up clause is triggered. And after that you do regular sharing. This is referred to as a catch-up clause. What do you think? Have you understood this? Yes. Okay, nice. Next reading. Same. Okay, this is typically how is the time value considered when GP is paid? No, generally not. You could have invested the 10 in year 6 and made some return in year 7. You can't invest in private equity fund directly in year 6. I mean, unless it's a secondary, so you participate in the whole year. Okay. Catch-up clause is relevant only in the European, because if you're doing deal by deal, then there's nothing to catch up for a GP. This is typically how most of the alternative products will work, typically all the more with private equity and venture capital. What you do is, and I hope some of you know this, that there is a concept called committed capital. Okay, so I'll show you a very good private equity fund in India. Again, I'm giving you example because it's theory, so maybe some visualization would be helpful. There is a firm called Multiples Capital. I don't know how many of you have heard of them. I hope I've taken the right website. Yeah. They've invested into, have you seen this one? Yes. Now, it's run by Renuka Ramnathan, or Renuka Ramnath, I don't know what's her exactly name. Now, let's say you want to invest in our fund. The minimum regulatory ticket size is 1 crore. Okay, but some of these folks will not accept a check less than 10, 15, 20 crores. But let's assume they agreed for 1 crore. Would you pay your entire 1 crore in one go? No. At the time when you sign the agreement, you actually write check typically of only 20 to 30 lakh rupees. Then how about that remaining 70 lakhs? That is called as a commitment. 30 lakhs that you've already paid is called paid in capital. What happens with commitment? As and when they find good companies to invest in, they'll give you a call and they will say you need to deposit more, maybe give me 20 lakhs, maybe give me 30 lakhs. So whenever they send you the requisition, you get 7 days to give them that money. If you do not give them money within 7 days, your entire capital gets forfeited. So सोचो कि आपने 1 crore fund, you invested 30 lakhs 3 times, only 10 lakhs is pending, and they sent you an email, but somehow you missed your email, or somehow you were traveling, and you could not deposit the money in 10 days, then as per the agreement, the entire 90 crore is forfeited. Right? Of course, now these guys will not do that to you because they have a reputation to keep. So someone will call you, double check with you, and do stuff like that, right? But when they call you for money, it's called a capital call. Okay? So you have committed capital, then you have paid in capital. The amount of money which is not called yet, we generally call in industry that amount as does anyone know? It's called dry powder. Dry powder. Why? Because it's not liquid yet, no? So opposite of liquid, you create dry. So whatever money is already called, that's called paid in capital. Whatever money is uncalled, we typically call it as a dry powder. Now, I want you to understand how this investment will work, okay? So typically you invest into a private equity fund. It's a 7 to 10 year product. First 3 to 4 years, those guys will keep on calling you, you keep on sending them money. 30 lakhs, 10 lakhs, 20 lakhs, up to total 1 crore. Then after 3rd or 4th year, there will be no direct activity that you have to do for a couple of years, up to 5 or 6. 6th or 7th year onwards, those folks will start paying you. Right? So you might receive a check of maybe 50 lakhs, 1 crore, 2 crore, depending on what companies are selling in the portfolio. So and you would keep on receiving money up to year 10 or up to year 9 when the fund is closed. So from a cash flow perspective, first few year money is going out, and then the last few year money is coming in. How do you calculate the return? So in a private equity fund, we generally calculate something called as multiples. Generally, we don't calculate return in percentage, we calculate multiples. Multiples is, I invested total 100, over a period of time, fund gave me 500. So that means I made 5x. Okay, so this is a rough structure. So initially money is going out, okay, and then money will start coming in. So that's how your returns will look like. There's always a J-curve effect. Now multiple of invested capital, I told you, I have invested 100 rupees. The fund has given me so far 400 rupees, plus fund is left with assets of 100 rupees. So MOIC becomes 5. What MOIC is ignoring? MOIC is ignoring time value of money. Okay. Let's do the math here. A private equity firm makes initial investment of 3.8 bills. In year 0, 8 years later, it sells it for 8.5 billion. So 8.5 divided by 3.8. Additional capital investment were made in year 2 and year 3 for 1.2 and 200. So 1.2 और ये billion है तो 200 million कितना होगा? 0.2. Calculate MOIC. So whatever that number is. What I got divided by what I invested. Okay. This formula we've done multiple times, levered versus unlevered return formula. If I tell you that my unlevered return is 10%, my cost of borrowing is 4%, and my debt to equity ratio is 5. Can you calculate the levered return, please? Okay. 10% plus difference of these two. 6% multiplied with debt equity ratio of 5, that is equal to 40%. कैसे चलेगा भाई इसे? Do you want to break or something? Do you want to go home? There's an area called fund accounting. Does anyone know? Anyone has heard of this area? There's a lot of demand in the industry for fund accounting professionals, but market में supply नहीं है फिलहाल. Especially skilled fund accounting. One of our students, he runs a firm that calculates NAV of most of the important mutual funds in India. जो NAV होता है ना, and net asset value, and they upload those NAVs by 11 o'clock in the night on the Amphi portal. So he has that firm in Bombay. So he'd come to meet me sometime. He's a charter holder now. So we were just chatting up, and he was telling me to calculate NAV. One of the things you need to do is to calculate fair value of assets, because you need to figure out valuation of assets, right? Now, it's easy to do that if you have a mutual fund, because holdings are typically stocks. So stocks का fair value मिल जाता है. But imagine you have to calculate an NAV for a private equity fund. Now, private equity fund is holding shares of some private company. How will you find out valuation of those assets? So under IFRS, there is a valuation hierarchy. Level 1, level 2 and level 3 asset. Okay. You need to know this from an exam perspective. This is tested in both FRA as well as alternative. Think of level 1 as a public equity, easy to value. है ना कि उसका market price available है, so you value it. Level 2, ready-made prices are not available, but you do have observable inputs. For example, YTM is available, so you can value a bond. You're getting hang of it? Or you can value a derivative using everything that we learned today in derivatives class. But when no observable inputs are available and you have to make assumptions, then the valuation in the IFRS hierarchy is referred to as a level 3 valuation. These are the most complex valuations. There is a large consulting business for the guys like KPMG, PwC, Deloitte. I worked in somewhat similar for some time when I was in Deloitte. Same work. You have to value certain assets which are not directly valued, right? So that valuation goes into computation of, bolo, NAVs. So you invest into a private equity fund. How do you know what's the NAV? Right? You invested 100 rupees. How do you know whether valuation today is 150 or 120? Because they invested into private companies. So someone has to sit and do valuation of those private companies on a quarterly basis. That's your level 3 valuation. Samjhe? So if I'm valuing bonds using metrics pricing system that we learned in fixed income, is it level 1 valuation or level 2 or level 3? It's level 2 valuation because I have observable metrics. If I'm valuing a bond based on the most recent price at which it got traded, level 1 valuation. But if I'm valuing a bond and I'm making some assumption about what should be YTM given the risk, then it becomes a level 3 valuation. Okay, then redemption fee. If you give money to a hedge fund and tell them कि 3 महीने में पैसा वापस चाहिए, they'll charge you a hefty fee. Generally, if you want to take money out, you have to give them a notice that I'm planning to take my money out. Here's my advance notice for 3 months. Then they will not let you take out money for the first 2 or 3 years. So you typically sign an agreement, एक बार hedge fund को पैसा गया वापस नहीं देगा, right? At least for lock-up period. And even if they allow you to withdraw, there would be gating provision there where you cannot withdraw all the money in one go. धीरे धीरे आपको withdraw करने देगा. So those are called gating provisions. So redemption, notice period, lockup, and gates. Okay here? Okay, this part I'm going to skip. Let's do this example. Opening AUM 200 million. Fee structure 2% management on opening fee, 20% incentive, net of management fee. Hard hurdle 6%. Ending value 240, year 2 ending value 250. Calculate total fees and investor net return. I want you to make an attempt, all of you. Start. It should be mentioned Shashwat Srivastav. Typically the question will tell you opening or closing. Okay. So what's happening here? First year was the management fee. 2%, right? So that's 4 mils here. Then what's the incentive? How much profit have you made? 40 mils. But out of 40, you want to deduct those 4 million first, right? So that becomes 36. 36 multiplied with, we have to also consider hurdle. Hurdle kitna hai? 12. So 36 minus 12, 24. 24 into 20%, 4.8. So total fees 8.8, which means end of the value is 231. And for investor return is 15.6. Can you please calculate for the second year? Replicate the same model. Now please take the net value of the first year and the ending value of the second year. So 250 minus kitna ye? 231.2. So how much is the gross profit? Karo na kitna ye? 18.8. 18.8. Okay. What's the management fee in the second year? So 231.2 into 2%. Help me with the math. 4.624. So management fee is 4.624. What would be the incentive? So profit is 18.8 minus 4.624, which is management fee. Hurdle is 6%. 6% on 231.2. Help me out. How much is that? 6% of 231.2. 13.872. This into 20%. कुछ ज़्यादा बच नहीं रहा है. 18.8 minus 4.624 minus 13.872. How much is that? Is that an incentive value? Into 20% करना है. How much incentive? 0.0608. So second year Incentive is 0.06. Management fee is this much, and then you can compute the net returns. Okay, let's see if we can do this one. 2%, 20%, hurdle rate before incentive starts at 4%, current high water mark is 610. The fund has a value of 583.1 million at the beginning of the year. After 1 year, it has a value of 642 million before fees. Calculate net percentage return to an investor. So again, we'll do the same math. Ending AUM is 642. साथ में करता है. Management fee is how much? 2% on 642. How much is that? 12.84. Okay. Let's compute incentive. Now incentive I have to take from the previous high water mark, right? So 610 to 642. What is the profit? 32 million. Is the incentive net of management? Does it say anywhere? It should be. So let's assume management fee of 12.84 minus hurdle. What was the hurdle rate? 4%. So let's apply hurdle on the high water mark. I'm not sure hurdle should be applied. Logically, it should be on high water mark. Yeah. So 610 into 4%, please. 610 into 4%, how much? 20? 4.4. So that should give you incentive of 0. Enough? So let's see if our calculation is same. No, something has gone wrong. What has gone wrong? I think they've not deducted the management fee. Okay, if I don't deduct the management fee, then do the math, please. 32 minus 24.4 into 20%. 1.52. Okay.
It also doesn't mention that it is a hard hurdle or a soft hurdle.
कहाँ पे लिखा है हर्डल के बारे में? It's a hard hurdle. Look at the language, right? Hurdle rate before incentive fee collection starts. So that's a hard hurdle. Okay. Two biases that you need to be aware of: survivorship bias and backfill bias. On an average, the impact of these biases is in the range of 1 to 2%. Survivorship means over a period of time. Bolo? Only the best companies will survive in an index. So if you just do look at returns on S&P 500 or Nifty, not necessarily had you invested in the same companies, then you would have made the same return, because some companies died and the new companies kept on coming. And what's a backfill bias? When you start computing, you create a new index in 2026 today, but you create as if the base value was 2020. You go in the past and start the index. That's referred to as a backfill bias. Okay, I think we should take a small break. This is not going well. We've done half of AI. I just need 1 more hour, but 1 hour of concentration. So we'll take a 10-minute break, do whatever you need to do, come back in 10 minutes. All right, while people are coming in, I'll answer a few questions on the chat box. Shashwat has given a question to us. We'll try and solve that together, Shashwat. Shashank Naidu says, I'm a CA final student. I have exam on 6th Feb. My fixed income AI derivatives are still pending. I am watching the crash course and studying from Schwezer. Is it fine? सुन के stress आ रहा है ना? But he's a CA finally. I mean, he is खतरों का खिलाड़ी maybe. Okay. Shashwat, I think the crash course would cover reasonable syllabus for you. And then spend time in practicing as many questions as you can. Since you don't have a lot of time, my recommendation is start with CFA mocks. And after that, if you get some time, maybe practice curriculum questions. Ritesh question is, I scored 81 in FinTree mocks and 75 in Institute mock. Are FinTree mocks easy to compare to Institute? No, not necessary. Whenever you write an exam, there is always a sampling bias. So quite possible that you're scoring a little bit higher or lower. Shashank Naidu says, I still need to solve questions for LES. Okay. Understood. How to calculate DOL if income statement is given, sales, COGS, GP, OPEX format. Neither variable cost or contribution are available, no other data is available. Then you will have to figure out which of the cost on the income statement is variable and which of the cost is fixed. You might have to make some assumptions. Eco with Gecko says, my exam is on 6th, I'm left with derivatives, forward swap, pricing, FSA revision. Okay. Sir, talk ethics. Okay. What do you want me to tell you about ethics? What do you want to know about ethics? See, I'll tell you very easy way. At least if I had to prepare, this would have been my simple strategy on ethics. This book that CFA Institute gives you, this is called CFA curriculum. Okay. Now, here, if you go to your main ethics is your LM3, right? By the way, there can be questions on LM1 and LM2. Those of you who attended class with me, some of them are tricky questions as well. So make sure you spend some time on LM1, LM2. LM3, I'll tell you the smartest way to prepare. For every substandard, they have these 7 or 8 examples. Okay, so this is example 1. Now, I can't show you the whole curriculum here, but they have some examples here, right? We can maybe see one of them. This is a CFA curriculum example. I feel there's a lot of learning here. Okay, so if you just do these examples really, really well, and maybe copy paste them and put them in GPT or Gemini and say, create more questions.
GPT does not do well on ethics, unfortunately.
GPT doesn't do well on ethics. Every AI gives a different answer. Okay.
This is one place that GPT is not doing well. I mean,
So figure out a way to maybe just read them comprehensively, just the examples and questions. I think you should be all right. That's a very simple, elegant way. In the ethics juice notes, for those of you who have access to juice notes, the last 2-3 pages, if you've noticed, we prepare a large chart of recommended versus required. We feel that's an important area. That's our guess, but make sure that you kind of remember what is recommended and what is required. Those nuances are necessary. Uh, Sir, I scored 77 in practice pack. Is it good enough? Yes, decent. Jatin. Mike pe pucho, please. GPT does bad in every subject. Okay. I'm preparing for level 1. Where should I start? I'm a beginner in finance. Mountaineer development. Okay. Mountaineer development on the FinTree portal. We have a course called Level 0. It's a free course. No, it's a series. It's a free course. You can go and sign up and then just start watching videos there. That should be a good starting point. I'm done with lectures, but my question practice is left. I have my exam on 4th. Find the best temple in your city, and go and pray. But see, it's doable. I don't want to discourage. I've seen people pulling off CFA exams in crazy amount of time. So maybe you can still pull it off. Again, just optimize your learning. Spend a lot of time on practicing questions. Learn from your mistakes. In quant relation of SD, I don't know what you mean by that, Bhupati. Do you have students from Pakistan? Yes, we have a few of them. Yeah, we do. We have a few students from Pakistan. Crash course for level 2, please. I've already recorded. I think I'm happy with what we have, except one subject I want to re-record in level 2. But otherwise, I think we have a fantastic course. Last year, I re-recorded FRA, corporate issuers, 4-5 subjects, and I feel the crash course videos were as comprehensive as main videos, but in less amount of time. What should be the last day strategy if questions are done? See, there are 2 ways in dealing a day before. How many Feb again here? So what will you do a day before? What's your plan? Chill. Badminton? So one of the 2 options. Some candidates like to revise. By the way, I've ordered food for you. I didn't know how much to order, but I've ordered some pizzas for all of us. It'll come in 30-40 minutes. Some people like to revise through all the juice notes once. Okay. If I were taking the exam, I probably would write a mock on the final day. Yeah, because the thing is, like, I don't feel the need for completion. I don't need to feel that I've completed everything and then only I'm ready to write an exam. So if you're that kind of a mindset where you're like, okay, I know a little, I can improvise, I can figure out, then maybe it makes sense to just do a mock, right? Just get a feel of how tomorrow is going to be. But if you're someone who has a need for completion, that I need to finish and feel that psychological satisfaction that I've revised, then I think juice notes would be a great revision. And yet don't study after 6 p.m. Fir khelo badminton. How many questions should be write in ethics to pass? I don't know. The CFA Institute does not have a subject-wise passing, so we have no idea. Let me get CFA curriculum out of it. Yes. Last, sir, हमें पार्टी कब दोगे? आप आ जाओ, अभी चल रहा है. चाहिए तो आ जाओ. Last 5-day strategy according to you for Feb candidates. See, it varies for everyone. But in general, the idea is to revise, crash course, juice notes, and then just do practice questions. Solving premium practice pack for last 2 years can increase accuracy. No questions will improve. Any practice will improve accuracy. Nothing special with those premium practice packs. Passed L1 because of juice notes and crash course. Thanks a lot. Okay. Thank you for the feedback, Parth. If I defer, can I take your course on CFA level 1? I have completed syllabus, but not enough practice. Sure. If you defer, but decide if you want to do it. See, this deferral made things so complicated, no? Earlier there was no deferral. Like earlier, if you signed up for CFA exams, there was only one type of deferral, which is an emergency deferral. If there was some accident or some death in the family, you had to produce a certificate and then send them, and they would not charge you, they'll defer you to the next attempt. Since the time this deferral option has come, I think somewhere at the back of the mind, in the final month when students are preparing, they always feel like I'm not prepared. सबको ही होता है ना, no matter which exam you take. Now, some students cave in and then they defer, right? So which is sizable. कितना fee है अभी? $250. So 25,000 रुपया deferral and then another 3 months, 6. Deferral is more, no? Now, yeah, it's increased now. Now I think it's $400 or something. So it's about 40,000 rupees. The thing is, if you those of you who've not planned your attempt yet, plan it with a margin of 3 months. If you feel I can finish it in Feb, sign up for May. If I can finish in May, sign up in August. So give yourself some wiggle room to make errors, because things will happen. But once you've planned, then don't think that deferral is an option. Just keep on going at it very, very aggressively. I think our delivery is going to come.
Sir, question.
एक मिनट रुको. हाँ जी सर.
सर
जी सर, सेकंड फ्लोर पे आना है आपको. सेकंड फ्लोर पे लिफ्ट से आएंगे ना, तो राइट साइड पे आना, आपको FinTree वाला बोर्ड दिखेगा. हाँ जी, अशोक संकुल 2 में ICICI बैंक के ऊपर सेकंड फ्लोर पे. Will you keep an eye? This guy will come. Okay. ब्रेक टाइम में ब्रेक लेना चाहिए या ब्रांड इंटीग्रेशन. चलो भाई, पढ़ ले थोड़ा अभी. It's 9:30 in the night. We need another. We've done about 20 pages, 37 to go. I will try to highlight the important words, important concepts for you as much as I can. The first one is LBO. LBO is leverage buyout. I told you it's the most common way of doing a private equity deal. Now, there's a concept called MBO as well. MBO is management buyout. The existing management takes over the business. Okay, so management pools in a little bit of money, takes some loan, and then they acquire the business. There is another concept called management buy-in, where a team, a ready-made management team, comes and acquires an existing business. So these are called MBIs, MBOs. MBIs are generally more common in the tech space, especially tech products. MBOs are very common across this vertical. Sorry guys. हाँ जी. Can you please, Siddesh, can you if couple of you can go, बस मैं आ रहा हूँ. LBO versus क्या था? MBO versus MBI. ठीक है. प्राइवेट इक्विटी, पब्लिक इक्विटी, व्हाट्स द डिफरेंस? यार वो उनको थोड़ा सा बोलेंगे, थोड़ा सा कंट्रोल कर सकते हैं? थैंक यू. Which one of these two is more liquid, private or public? Public is obviously more liquid, right? ownership, if you're private equity, then you have control over decisions. Public equity, the control is typically limited. Management, private equity requires industry-specific knowledge managed by public company executives. There's some general points between the two. Then venture capital, we've already discussed. These are the stages of VC, by the way. Someone came to me asking, what is Y Combinator? कौन था Y Combinator पूछने वाला? And I told him Y Combinator is an incubator. Right? So then he asked me, what is an incubator? So incubator is someone who would incubate a startup in a very, it's like you have an idea, you have a PPT maybe. If you go to an incubator, they will give you a place to sit, they will help you set up the company, maybe give you a little bit of money, but more than money, they'll give you a lot of other support. There would be a tech team, legal team, they'll bounce off your ideas. So those are incubator for which they will take some ownership in your company. A lot of times we have also non-profit incubators. But when you go to VC, VCs mean business. They don't care, they don't want to help you. They want to make money out of you. Right? It's simple. So VCs now will come in different stage. Pre-seed stage, this is, I feel this in India is a trap zone. Okay, we call it as a angel investing. Some people call it friends and family round. I call it friends, family and fools round. Right? This is where you sell dreams and get money in return. And 95% of the startups typically fail at this stage. People will have kick-ass ideas but no execution. Ideas are worth a penny. Ideas are useless. There's no benefit of having an idea. Have you heard people saying, oh, I had a great idea, मैं किसी को नहीं बताऊंगा? These are the, I feel in my opinion, the stupidest startup founders who feel कि मैं अपना idea किसी को नहीं बताऊंगा. Ideas are plentiful. The real skill lies in execution. These are the places where you generally lose significant money unless you get lucky, right, and build a large company. Seed is where now you are focusing more on product development. So here you just had a prototype, but here you actually start building the product. Then early stage VC, this is where you're funding pre-commercial ops, slightly more advanced. And then late stages, right before your Series A or at times even participating in Series A, where आपका business चल रहा है ना, शुरू हो गया है. Now, mezzanine stage financing, also called bridge capital. What is this? If some company is going for an IPO, in that process of applying for IPO, and just before the IPO, उसमें खर्चा होता है बहुत. You have to pay fee to the investment bankers, legal, compliance, all of it. But these companies might not have money. But they know that IPO होने वाला है, we are going to get money. So you do generally something called as a bridge financing. Bridge means a bridge to take you through pre-IPO to post-IPO stage. These are also called mezzanine financing. Okay, believe it or not, the markets are so smart. I mean, if some company is planning to do an IPO, right? Typically, the first thing a founder will do is call up an investment banker. The moment the investment banker call goes, investment banker will call 5 of his friends who are NBFCs. Will say, this guy is going for an IPO, good opportunity for you to sell him some loan. Right? Because every time you sell a loan, every time you sell something, you get commissions out of it, right? Investment banking, I told you, is commission business. Then, the moment IPO happens, okay, now think about it. The same investment banker will call his friends in wealth management space, AMC space. They will say, इनके पास पैसा आ रहा है, go and park that money into mutual funds. Because again, you get commissions, right? So, very, very evolved industry, very competitive, but very interesting. Private equity deals happen through a CPS structure, convertible preference shares, or compulsorily convertible preference shares, or optionally convertible preference shares. There are a lot of hybrids into this. Why do you want to do preference shares and not equity shares? In the event of bankruptcy, you want a preference over founders. Founders have equity shares, you have preference shares. Okay. Then I hope you know the difference, private equity versus VC. VCs are early stage. Private equities are mature stage companies. One of our students was getting interviewed for a private equity firm, but senior level, manager level. So he was given a case study where uska job tha, he had to identify an acquisition target and then build a whole model around it. Now, how do you find an acquisition target? So I remember we worked together. The company we had identified then was this company, which we thought were a fantastic acquisition target. Sula. Okay. It's India's largest wine company, but was available at very, very cheap valuation. So private equity guy can come in with 600. You don't need to have the whole 600 crores, right? You actually need to have your own 100 crores. 400 crores, 500 crores you get in the form of loan, and then you buy more than 50% ownership in Sula. Now, notice what's happening with these guys. Are they profitable and operating level? Yes. But do you see a significant growth anywhere here? No, right? So perfect target for an acquisition of a private equity firm. Private equity makes money primarily through top-notch execution of the business. They will buy a sleepy company, but they will turn it around. They will have really good management skills, operators, jo dhanda chalate hai, and that's how the business will be turned around, and a little bit of financial engineering. So conceptually, in your head, VC is very early stage. So VC is your startup, but private equity is not startup. Private equity is large, mature companies. Okay, then there is something called as a growth investing as well. Motilal does business in this domain. So these are also called mid-market PEs. So what you do is you actually go and look at large companies, but private equity will always buy a controlling stake. You don't buy a controlling stake, you buy a minority stake. And you provide strategic guidance to the company, but no control. So these are called mid-market private equity firms, or a growth investing private equity firm, where you're giving companies some growth capital. Then a structure called PIPE. PIPE stands for Private Investment in Public Entities. You buy a company and get it delisted. Okay, so in India, one example I remember is there was a company called SL ProPack or something like this, I forgot. But these guys used to make वो जो Pepsodent toothpaste होता है ना, उसका जो क्या कहते हैं can or tube. These guys used to make those tubes. Okay, they were a packaging type of a company. They were public once. A private equity guy came, bought out the company, made it private, right? Delisted. So that's your SL ProPack. There's another company I used to hold back in the day called Tasty Bites. A Japanese investor came and they bought 75% stake in the company. Right? So that time they were fear that maybe they will get the company delisted, but luckily that did not happen. All right. Now, how do you sell your portfolio in a private equity? The first thing you do is you do something called as a trade sell. Trade sell, you typically sell to a strategic buyer. Okay, so this is something you need to know. I'll probably create a flowchart for you. If I am a private equity firm, okay, and I want to explore my exit options. Exit means how do I sell? The most preferred exit option in most of the cases is what? IPO. Why is that? Because you get generally the best valuation, right? But if you're not able to exit with the best valuation, so maybe I'll show you one. I keep on forgetting the name of this company. It's a can anyone give me quickly? It's a diamond grading company. GAI, geological, gemological होगा ना? Gemological भी नहीं है. Come on, anyone knows? It's okay. It's in my tracking list. If anyone remembers the name of this company, which does certification for diamonds. GIA. जेम और एक है उसका कंपटीटर, आई से शुरू होता है उसका नाम. आई, अरे यार, IGI, right, IGI is the correct name. Okay. International Gemological Institute. So I want to show you the tables. Okay, this is Blackstone. Okay, so let's Google it. Let's see who owns this company. This is owned by Blackstone private equity firm. Okay. Now, what they did is they did IPO some time back, but in the IPO they decided to sell only 25 or % odd stake. Okay. Rest of the stake is still being held by them. But notice what you would see is over a period of time, you would see that it's transitioning from fund 1 to fund 2, fund 2 to fund 3. That kind of transition will also happen. So what these private equity folks will do is, before the first fund is over, I told you fund is of 10 years, roughly around 5th or 6th year, they'll start a second fund. Then the first fund company, instead of selling it in the market, if they feel that company is still good, they will transfer it to second fund. And the second fund will transfer it at a higher valuation to third fund, and that passing the pass will happen. At times is good, at times is very scary, because you're internally transferring a private company from one fund to another. You are the one who's deciding valuation. The smart strategy for you to do there would be to sell it at a very high valuation to new investor, because then the old investors will make money, and then sell it at even higher valuation to the third fund, right? So they keep on doing that, but most preferred route is IPO. Then second preferred route is they should do a strategic sale. Strategic sale means you sell it to a strategic buyer. So in India, maybe a good strategic buyer for IGI would be Titan. So Titan can integrate that into their existing business. A strategic buyer will pay you more compared to a financial buyer. A financial buyer is another private equity firm. Okay? And then the last preference would be that they would do a liquidation. Liquidation means shut down the business, sell off all the assets and take out the cash when the business are not doing good. So these are some of the exit strategies. Of course, in the US, you have another option of SPAC. Create a SPAC and then put that company, get it indirectly listed into the market. Okay. Now, there's another very tricky strategy. It's called recap. Now it's technical, there can be a theory question, so I want you to focus on this a little bit. How does a recap work? Okay, imagine this is a company. I am a private equity investor. I have equity of 1,000 rupees in the company, and they have PPE of maybe 500 and some inventory of 500. Okay. What you do in this company is you'd ask bank to give you your company a loan, let's say a debt of 900 rupees. Then debt means you will also get cash of 900 rupees. You will take this cash and you would refund the shareholders through a buyback or a dividend. So you pay a large amount of dividend by taking loan. The moment you do that, cash will become zero. But equity shareholders, they got 900 back. So now equity value is how much? 100. So equity shareholders got the money, but now the debt is sitting on company's books. Your ownership is still 100%, but you've taken a big chunk of cash out of the business. This is referred to as a leveraged recap. Okay? Where should you do a strategy like this? In a business where you want to take out cash, you want to keep ownership, and a business can sustain large value of debt. So those businesses where you have very good free cash flows coming in, this is a very elegant strategy. As an investor, you can take some money off the table and still retain the ownership. Understood? Leverage recap. All right. Secondary sale we've already discussed. Then venture debt, similar to giving a loan, but riskier. Therefore, you expect to get more in the return. Typically, a venture debt is a loan given to a startup. Okay, plus you expect a lot of freebies to come in. So it's like you're a startup. Instead of giving you equity, I'll give you a loan, but you give me a lot of sweeteners in the deal. One of the sweeteners is warrants. So when your company goes big, I will have a right to convert my warrants into equity shares at a very, very cheap price. So I kind of profit from both the scenarios. Okay. These are typically leverage loans. Means you come to me and say, Utkarsh, 100 रुपए का loan चाहिए. I will say fine, but I'll charge you 20%. चलेगा क्या? You say okay. Now I will go to a bank and I will take a 90 rupees loan at maybe 10%. Put in my own 10 rupees and give you 100 rupees at 20%. So I'm giving you a loan by taking a loan. Those are called leverage loans. Remember, in fixed income we were learning CLOs. CLO is a portfolio of all of these leverage loans. So it's a double leverage. As long as you don't default, I don't default, then my lender is okay. You default, I default, then my lender is in trouble, which typically is a CLO. Then what's a mezzanine debt? Anything in finance that says mezzanine is in the middle. Okay, so mezzanine is somewhere between senior and subordinate, or somewhere in that structure. Distressed debt we've discussed. Two types of approach, opportunistic and turnaround. What is opportunistic? Imagine if this is company's balance sheet. Okay, they have some equity, they have debt, and they have assets. Okay, so let's say right now the scenario is 900 rupees of debt, 100 rupees of equity, but for some reason asset value has fallen down to 100. Okay, which means the company is in trouble. Now, because of which the value of this debt has reduced so much that now the debt is available at 50 rupees. Now, if the firm goes in bankruptcy and if these assets are sold at 100 rupees, who gets paid first? The debt investor. So buy a debt of 50 and claim your rights on those assets worth 100. Right? These are some of your opportunistic investor. Or you say that, you know what, I will buy the debt, go to the courts, using the bankruptcy process, become the new owner of the company, and I will turn around the company. Okay, those are also strategies where you are a turnaround investor. You get your hands dirty, you run the business for them. Okay. This we discussed in the fixed income class, did we? One tranche which has both multiple structures together. Discuss kiya na humne unitranche loan. We discussed different tranches. At times, characteristics of multiple tranches combined into one tranche is referred to as a unitranche debt. Okay, this is again a very US specific concept. I don't know how many of you have heard of it. Have you heard of litigation finance? So, personal liability in the US. Okay, so let's assume you're walking down the street and raste mein pothole tha, gadda tha on the footpath, and you fall off. Now in India, if you fall off, 10 people will come and laugh at you. Dekh ke chal, right? But in the US, you can go and sue the city. You can actually sue the city and you can get a large payoff for it. But for that, you will have to pay fees to the lawyer. So there are specialized investors who will actually give you money for legal fees so that you go and fight your case, depending on probability of you winning, and then they will take some part of your bounty. This is called litigation finance. It's crazy. Yes, it's true. It's in the US, the consumer rights are phenomenal, maybe a little overboard. You go to a restaurant, something wrong comes in your food, you can go and sue them. You go to a restaurant and there was a wet floor and you fell off, you can sue them. And you can get crazy amount of money. कुछ भी होता है. Weirdest of things will happen. And companies also get money for litigation. Litigation can also make companies bankrupt, by the way. Legal cases. So all of this is litigation finance. Okay. You should know the term called vintage year. Vintage year means the year in which the fund started. Okay. There was a question I saw in your ecosystem, which was called, when you're diversifying, building a portfolio of private equity fund, okay, which of the following is a diversification that you'd look for? Or which of the following is not? Something like this. Should you diversify across different firms, or should you put all your money into one fund? Different funds, right? But one more important diversification is you should diversify your vintage years. Do you know what a vintage year is? The year in which you started investing, you made your first, or the fund started, that's your vintage year. So if you're going to build a portfolio of private equity, don't put all your money in 2026 fund. Put little bit of money this year, then little bit of money next year, because depending on when you enter the market, your returns can change dramatically. Okay, this is fantastic. I want you to kind of get a good sense of where this chart is in terms of risk return across different categories. Infra debt, then senior real estate debt. Look at this, lowest risk. Infra is the lowest risk, lowest return type of investment. You give loan to someone who has already built an airport, it's assured you know what kind of cash flows you're going to get, right? Senior, so safe. Senior direct lending, safer. Then unitranche debt, which is combined feature. Then mezzanine, which is between senior and subordinated. And then obviously private equity co-investing is the highest tier of risk. Now we go to real estate. Residential, commercial, mortgages. Again, within that you have single family and multifamily. Multifamily means your flats. In India, what we call flats. And in India, what we call as bungalows. These are your single family houses. Donald Trump is asking the BlackRock not to buy single family houses in the US. Okay, what some of these institutional guys have done is they have purchased the whole towns, especially university towns. So these institutional investors will go और एक university town में जितने भी घर है सब खरीद लेंगे, and then they will escalate student rental, right? Also happen in Canada. Then we have obviously commercial property, office, retail, warehouses, mortgages. Typically you can also be a mortgage investor, CMBS, RMBS. आगे? सिद्धेश? हाँ? He kept it there, okay. So अभी आपको खाना है, अभी पहले पढ़ ले थोड़ा? Okay. Yes, some of you want me to just get done with it, right? Okay. I'm just focusing on what. ठीक. बाद में क्या? ठीक. चलो, let me focus on क्या क्या आपको पढ़ना है. खाते वक्त भी स्ट्रीम रखना प्लीज. ठीक. चलो, all of you understand the concept of REITs, please? Yes, you do. एक मिनट रुकना प्लीज ना जरा. No. Hanji. Okay, let me just explain a little bit on RITs. चलो यार, some FEB candidates they have exams in a few days. At least उनको तो पढ़ने दो. Okay, what are RITs now? Should you think of RITs as a mutual fund or as a company? It's listed, right? Is it a ETF? Is it a mutual fund? It's a company. It's a company. Think of RITs as a company. Okay. How do RITs operate? A bunch of investors will sign up for their IPO maybe, and through the investor they might collect, let's say, 40 rupees. Then they will go to a lot of different banks and they will take loan of 60 rupees. This is their equity and liability side. Then they will buy a real estate worth 100 rupees. Now this real estate will give them some rent. Now typically what real estate? They might buy houses, they might buy malls, offices, whatever real estate, right? Based on the mandate. Once they get rent, the first right on the rent is obviously the debt. So they repay whatever loan they need to repay. After that, 80 to 90% of the rent is given back to the equity shareholder. So which means the execution skill of the management matters. Which kind of property they buy, what kind of tenant mix they have, right? अच्छे लोगों को भाड़े पे दे रहे हैं, किसी को भी उठा के लेके आ रहे हैं. All those things you need to evaluate. Now, if 80 to 90% of the rent they have to pass on to the shareholder, then there is no reserve left for those guys, no? So how will they grow? So these REITs will, typically in the US, they keep on doing FPOs. So they will launch one more FPO, get some equity, get some more debt. Then buy one more mall, right? And that's how they try to expand. This market is beautifully evolved in the US. There are REITs available only for New York City. That too there, वो कौन सा है जो New Manhattan area, right? There is a REIT that focuses only on Manhattan. उसका सबसे बड़ा property हो Trump का कोई, Trump Tower. They own that Trump Tower. There are some REITs which focus only on student housing. There are REITs which focus on warehouse. There are REITs that focus on senior living housing. Then in the US, they have this very cool concept. You must have seen in the movies, right? Warehousing, storage container, dekhe? Yes. So then there are warehousing REITs available. There are hospital REITs available. Each one of them has their own characteristics. So you need to understand how that property behaves, and based on that you make your investments. Okay. In India also we have some REITs, by the way. In my main videos I've shown examples. This mall that you see in Aund wala kaun sa mall? West End Mall. That is under a REIT. So technically if you buy the REIT, you're owner of that mall. You know? फिर जाके staff को थोड़ा. Now within real estate, there are some strategies that you need to know. Okay. I don't know if I've put in that graph in the juice notes. Yeah. This is very important, highly testable. I want you to know this spectrum really well from exam perspective. If you want to do real estate lending, the safest way to do is to do a debt. Right? And keep LTVs low. So कोई 100 रुपए का property है, 60 रुपए का, 40 रुपए का loan दे दो. But you would make less return. Second safe strategy is buy a core real estate. What is core? Something that's already rented. Some property you go and acquire which already has good tenants, already has a good cash flow coming in. Easy for you to value because you know what cash flows I will get. Safe because rent agreement is there, you'd keep on receiving rent. Then if you want to take a little bit of more risk in real estate, you go and do something called as a core plus. Plus means it's an old office. You'll have to do a little bit of refurbishment to get better rentals. So some refurbishment is required, or maybe the old tenant is not paying you enough or old tenant is kind of affecting the profile of other tenants. For example, you, let's say in India, unfortunately, if you rented out your property to a liquor store, that will attract the wrong type of audience. So let's say if someone wants to open a fashion store or a retail store next to it, they will not. दारू के दुकान के बाजू में नहीं खुलेगा, है ना? So you do some basic changes and you make a little extra money on that. You want to take even more risk, then buy an underdevelopment, not underdevelopment, but a vacant space. Right now there is no tenant. Now you have to put in effort in finding the right tenant, but फिर आपको property सस्ता मिलेगा. So you will be able to make more money. And you want to take even more risk, then buy something which is currently under development. So this is your spectrum, right? You as an investor need to decide what kind of, this is your risk going from low to high, this is your return low to high. From an exam perspective, you need to remember the hierarchy here. Okay. High probability questions on LTVs. In general, you should be super comfortable. LTV means what? Loan to value. So let's say you're buying a property of 100 million by taking a loan of 75. What's your LTV? 75%. If your property value drops to 92 mils and your loan value drops to 70 mils, then LTV is 70 by 72, 76%. You're breaching 75% limit. फिर अभी क्या कर रहा है वो? How much additional collateral is required? So बोलो कितना collateral चाहिए आपको? करो ना math है simple. If the limit is of 75%, then how much collateral is required?
The ratio which we got 70 to 92 plus is equal to 7.
No, you'll have to compute. See, right now the property value has dropped to 92 million. So my collateral value right now is 92 million. I need 92 million plus some X in such a way that 75% of that comes out to value of the loan, which is how much now? 70. So compute what is that X. कर पाओगे ना इसको? Move 75 on this side, move 92 on that side. So 70 divided by 75% minus 92. 1.33. So this is the additional collateral required. Are we together? Yes. Okay. Understood what happened here? Yes. Good. Okay, now infrastructure. Typically a lot of these infra projects are PPP projects, public-private partnership, or a BOT project, which is build, operate, transfer type of structure. The important document that you want to evaluate is called a concession agreement. You need to know this word. क्या बोलता है? Concession agreement. It's an agreement signed between typically the party that has a legal right government is the party that has a legal right and the infrastructure provider. So concessionaire and concessionary. That means the one who's getting the rights, the infra company versus the government. Okay, these two parties are involved. Okay, these are some of the different assets in which you can invest. Okay, if you study the investment by some of the largest people in the world, you'll notice that most of them will have heavy investment in infras. The idea of infra investing is not to compound your money fast. The idea of infra investing is to protect your capital, right? That's the whole idea. So you can buy roads, bridges, airports, all of these. Variety of different infras. Okay. Again, 3 types of infra: greenfield, brownfield, and secondary stage. What is a greenfield? Completely new. Brownfield means already exists, but you want to expand. And secondary stage means development, right? Step 2 to greenfield. Okay. How do you invest in infra? You do direct investment. Typically, infras are also consortiums. 4 or 5 people will come together. Or you buy InvITs in India. We have some very interesting InvITs available if you have time to study. I was studying about one InvIT a couple of months back. We have this Godavari gas, I forgot the name, but in the eastern part of the country, we have access to some gases. And those needs to be transported. So there is this pipeline that transports the gas, which was earlier owned by Reliance. The Reliance owned it to this InvIT. Now, every time some oil and gas is transferred from that chambers, you charge a toll gate fee. जैसे हम road use करते हैं तो fee लेता है ना, वैसे ही when the electricity is transferred or gas is transferred, you collect a fee. And then that asset is owned by the InvIT, and whatever fee they collect, that's passed on to the investors as dividends. So indirectly, you are the owner of those assets. There are also InvITs available today which own power distribution lines. So power distribution line, again, when power is distributed, you get to charge a small fee. So the whole idea of infrastructure investment is you build something that has public utility, which will keep on giving you recurring revenue. That's the whole idea of this investing. Okay. All right, then natural resources. Let's see what we have here. Okay, this you should memorize. Soft, hard commodities, industrial goods. Okay. A little bit that you need to know on differences between a farmland and timberland, which we have here. The biggest advantage you have as a part of the timberland is your harvest cycle can be flexible. See, in farming, what happens is कि मेरा harvesting season आ गया, I don't have a choice but to harvest, sell. Typically, that time the prices in the market will be lower because of supply. In timberland, you can decide कि पेड़ कब काटना है, right? So it gives you more flexibility of selling when the prices are relatively higher. Liquidity for both of them are low. Risk, climate based price, here environment risk and different growth cycles. I told you, I think in the main class, it's a 25-year investment. Then you do some pesticides or something in the first or second year. Then small pruning in the 16th or 17th year, and then harvesting in the 25th year. Okay. How do you get commodity exposure? You can buy ETFs. That's one way to do it. You need to know these guys in the US called CTAs. CTAs are authorized by the US regulator who would trade on behalf of you, typically do commodity trading. These guys are very popular in the US for doing something called as a momentum chase. Momentum chase means these are all momentum traders. They generally buy something that's going up and sell something that's going down. Now there are plenty of private equity funds also. There are also hedge funds that do some of this. Upstream, midstream, downstream. Do you know what this is? Upstream, downstream. Upstream means someone who's in extraction. Midstream is probably refining. Downstream is someone who's getting that petrol, converting oil, which is converted to petrol, getting to you HPCL, BPCL. Right? All of these are downstream players. Have you seen this formula before? Yes. If forward is lower, the market is backwardation. If forward is higher, the markets are contango. उतना ही याद है नहीं? कुछ और याद है सुबह से? Okay, now we go to hedge funds. Is cardboard industry a part of timberland? I mean, their raw material is timber, so but they're not part of timberland per se. All right, hedge funds. Last 13 pages. We're making good progress. We're there. I'll just highlight the important pieces. I think most of you know basic stuff. Hedge fund, mutual fund, we've discussed. Okay, these are different types of hedge funds. It would be nice if you know what each of the hedge fund is doing. Okay, for example, fundamental long short is almost like your mutual fund, but some of them building short position. Growth means growth, buying growth companies. Value means buying value companies. Short bias means higher weight on the short side. Therefore, typically betas will be low, at times even can be negative. Market neutral, you keep your betas equal to 0. So long and short is managed. Merger arbitrage, if there's a merger happening, generally you buy, acquire, buy what? Buy target, sell, acquirer. Okay, let me show you an example. There's a merger play available right now in the market, though the spread is very thin. It's called Orient Cement. Okay, this company is getting acquired by, anyone knows? Ambuja. Now, the ratio is roughly 0.33, which means 3 shares of Orient will give you 1 share of Ambuja. So Orient right now is available at a price of 167. Ambuja is available at a price of, Ambuja is by the way who? Adani's. Ambuja is Adani's. It's available at a price of 547. Okay. So please take 547, multiply with 0.33. 180. So 185. And Orient is available at a price of 167. So there's a spread of that 17-18 rupees, but it's not a free spread because it's subject to regulatory risk. The merger needs to be approved in NCLT. Then by then, Ambuja shares should not fall. Correct? So none of the spread in anywhere are free. Even though it's called arbitrage, you're exposed to a little bit of risk there. So this is your merger arbitrage. Distressed investing by someone who's going bankrupt. Special situation, spin-offs. A lot of spin-off opportunities keep on coming where a small company is spun off from a large company. These days I'm studying 2-3 spun-off companies. One is called Shankara Building Products. This is spun off from the larger Shankara group, but they've had some historical corporate governance issues. Then there's another one that all of you would know, Hindware. This company I'm sure you've heard of. Hindware Sunana? Yes. This company, they separated the business of home improvements with their traditional business. So these are some of the spin-off opportunities market will have. Activists, you know? Yes. What?
They'll try to control the way.
Not control, but influence how the company is doing business. Convertible bonds, buy bonds, convert to equities. That's one way to do it. Then fixed income strategies, variety of different strategies here. Then a multi-strategy hedge fund will do everything. Macro strategy means? Yeah, you take macro view. There is a gentleman, I recently listened to him for the first time, looks very smart. He was in a CFA conference. His name is Ritesh Jain. He's started a hedge fund based out of Canada, Indian, called FinTree Macro. You can go and listen to him, but very interesting. In his presentation, he talks about which assets in the world he is interested in, which assets he does not like. Right? So macro means you look at central bank and then you look at macroeconomy and then decide what to do, what not to do. CTAs we just discussed. What do these guys do? Generally futures, generally momentum. Okay. Remember some of these terms. Lockup, notice, liquidity gates means we will not allow withdrawal in one go. धीरे धीरे withdrawal मिलेगा. Soft lockup allows early redemption with a fee. So we'll let you withdraw, but we'll charge you a fee around it. Okay. This is highly testable, so I want to spend a minute here. If you want to invest in hedge fund, you can do something called as a FOF. Now, the benefit of FOF is it will take small money from you, and then it's a fund of fund, and it will invest into variety of different hedge funds. But the downside is that you will have to pay fees at both the levels. You'll have to pay fees for the hedge fund level, and then you'll also have to pay fees at the FOF level. Okay, so that's your FOF structure. Then SMAs. SMAs are very, very close to what we have in India, which we call as PMS, where you get a fund manager to run portfolio for you based on your specific requirement. Okay, so it's not a mutual fund. They manage money for you, manage money as per your own mandate. Okay, some of the biases here. Okay, done. Digital assets, you study on your own. I'm not qualified enough to teach you this. Myself don't understand much. So spend some time and study on your own. And we are done. Congratulations, you stayed through the whole thing. कितने दिन हुए हमारे?
7 days.
7 days. 7 days the whole syllabus, except ethics. Good.
नाही बट कबूतर असेल तर मजा
अरे तेवढ्यात आपण 3 तासात वैतागतो.
आहे पण मजा येते यार चालत होतं.
अरे नो लाईक गेम्स मध्ये थिअरी आल्यावर
हां
आ जाओ. All right, so before I let the online audience go, once again, thank you very much for being patient. Very proud of you for listening through the whole session. When we started in the morning, we had 106 participants. Right now, we have 81, which is not bad, right? 81 people stuck through. And it's not easy to listen this on YouTube. I've said this before. It's much more easier in a classroom. Very difficult back at home. So proud of you, all of you. Do well. Please remember the results in life generally are uncontrollable when you prepare for exams or anything in life. What is controllable is process. So do not obsess too much about what happens to me on the results or on the exam. Just enjoy the syllabus, break it down into smaller parts and keep on putting in the work. Okay, so with this, all the best. We will be sharing notes in some time, and of course classroom folks, can we have few volunteers to serve everyone? I don't know how is that going to work. Okay, so or maybe self-serve, right? Just go and get whatever you need. We have Coke hai? Coke mangaya na? It's in the refrigerator mein rakha hai. Okay. क्या?
टाइफन है
Thank you for the crash course. I'm working professional, appearing in Feb attempt without any prior study, fully relying on crash course. All the best, Pranav. I hope you do well. सर मेरे गली में भंडारा चल रहा है पर मैं नहीं गया. Okay. Please attach the pizza in the description tomorrow. Okay, sure. Show classroom. Classroom is visible. Sir, pizza तो दिखा दो. Okay, Anuj, love you back. Thank you very much. I'm shifting to Mumbai for level 2 to join FinTree. Sure, you're welcome. We're in Pune, Devan, by the way. Yeah, just in case. Can Feb attempt candidates get a Q&A on Zoom? Yeah, we can do a Q&A on Zoom. I don't know if I'll see if maybe Monday I can try. Of course, you always have my blessings. All the best, all the best. I'm in Ajao. Okay. All right. Thank you very much. Have a good one. I'm ending the stream now. As in, let these folks eat in peace. Sir, with you, Crash Course got the conference. Okay, good. Thank you very much, Nagesh. Thank you, Gabriel. Shriyansh, you're welcome. Anirudh, you're welcome. Okay, love you back, all of you guys. Thank you very much. दगड़ू शेठ गणपति को बहुत भीड़ होगी क्या? क्यों आज क्या है? अच्छा गणेश चतुर्थी. कल चले जाओ. I used to go to Dagru Shed for years on the day of results. पहले when we used to have 2 exams a year, no? So मैं morning में my old colleagues know, one of them is still with us. So we used to do a mandir circuit. Start with Dagru Shed, then go to all the mandirs on the day of results. Okay, thank you guys. Ending the stream now. We'll share notes in about 30 minutes time. Thank you, Namit.
I should not have given that attempt actually, but I was prepared. अरे ते तर काहीच नाही आहे. एक्झाम फीस फक्त 2700 रुपये. They are very economical, but I should have. But